and welcome to today's morning market on close. My name's Will from The Officials. In the window today, Trafi remained the main buyer alongside Glencore and Totsa. The Chinese were really still active, driving that sell side, with Unipec and Hengley both offering and indeed selling partials. Mercuria also remained sell side along with Exxon. We, at the end of the session, netted 3 more convergences, with Trafi getting 2 upper Zacums, 1 from Mercuria and 1 from Exxon, whilst Totsa also got an upper Zacum from Mercuria. At the close of the window, Dubai partials were assessed at $65.83.5, implying a physical premium of 73.5 cents. But that collapsing premium is largely driven by the DEC-Jan spread. As we can see, the Balmo M1 spread here, 35 cents, were actually up on the day. But taking a look at the Brent Dubai box, the Brent Dubai box has rallied, so we're really kind of following this uptrend here, trading at around minus 19 cents today as Dubai structures take a hit. Brent Dubai out, even when Brent Dubai outrights remain pretty range bound. So looking at flat price, after yesterday's rally, we saw flat price peak above $65 a barrel, and today we've started to drift lower again, falling back under that $65 handle. And that trend has maintained through the morning. We're seeing a little bit of support here, but it looks like the broader market is softening, and that's reflected in Brent spreads too. Looking at the front Brent spread, that started to soften again, facing a lot of resistance around the 30 cents a barrel level, now trading at about 28 cents a barrel. But elsewhere in the news, the IEA has flipped its view. In its 2025 World Energy Outlook, the IEA now expects oil demand to keep rising, reaching 113 million barrels a day by 2050, largely driven by transport, petrochemicals, and aviation in emerging economies. Under its current policy scenario, consumption growth 1.3% annually over the next decade, and that's mirroring the past decade's pace as industrial activity mobility expands, but efficiency gains lag. And this marks a pretty stark reversal from its 2024 outlook, which had forecast fossil fuel demand peaking before 2030. And a lot of that was explained by clean energy and a lack of new demand. That's it from me today. Thanks for listening, and tune in for the European market on close later.
into Trading Corner. We're just going to debrief on the market for the last week, see where things stand and where we go from here. So margins, I mean, look at this chart.
Just flying.
That is unbelievable. This is from May we've got, but we're at yearly highs, right?
We are.
Incredible.
Yeah, it's been the single most performant trade of the year. And gas oil obviously driving an enormous amount of that.
Yeah. So this week it's been mainly gas oil, right?
Correct. Actually, you've seen some of the other products correct slightly lower. Gas oil and gasoline have been the standout performers, I would say.
Why do you think? What do you think is going on there?
Again, I mean, we're seasonally coming into the most strong season of gas oil, right? So gasoline is a separate story, but gas oil for sure. There's an enormous amount of positioning in gas oil as well. You've got
to the long side.
To the long side, which is creating an enormous amount of noise in gas oil. I mean, interestingly, the back has been relatively more stable and performing. The front is where the noise is, as is always. But I think we could see more noise. I assume there have been some stop outs on the short side with this gas oil move last week, but you don't know.
Yeah, also just looking at the charts, I mean, the behavior, it definitely looks like there's a lot of buying in the morning. Typically into the evening, we tend to trend down a little bit, but then it catches a bit right, like the next morning.
Yeah, exactly.
And just totally reverts the sell-off that you get. So we're slowly trending up, but it definitely looks Asian-led.
And actually, Asia has got a lot of strength and is showing a lot of strength on the gas side as well.
Which is unusual for this time of year, right? As in, usually India should be exporting gas oil, and it doesn't look like they're doing that.
I think it's probably due to the crude slates that are coming in, or the uncertainty around what crude is being bought. It's just my theory, to be honest, but. We're also, there's cold weather starting to come in. We've got a bit of a cold snap in the U.S. Still not that cold in Europe, but I think in about a month or so we'll be able to tell. And
it does
it's
feel
going
like
to draw.
It feels like we're having our winters later and later.
Correct.
So the classic. I think maybe 2-3 years ago we had a big Texas freeze in January.
Yes.
So it might look like actually a lot more of the cold weather will hit in the new year rather than. We're in mid-November and it's 15 degrees. It's crazy. It's crazy. So that might be why. But to be honest, like if you look at the whole complex, so margins and also what crude's doing, it just looks like refineries are not running anything.
We don't have enough capacity in the world.
Yeah.
That's the only explanation.
So obviously we had the Lukoil stuff. Some of their refineries got hit by some of the Ukraine missiles. Not that much though.
Yeah,
the only other refinery we're talking about is Dangote. So
correct, and actually, we haven't really seen refiners come fully back out of turnarounds.
No,
I suppose so. That is possibly one reason. And again, I think 2 weeks ago we talked about products trading independently as products, and it's not that everything in the margin is rallying, right? A lot of this is primarily due to gas oil. There's a decent amount of gasoline strength also, but fuel has corrected down. Fuel sold off a substantial amount in the prompt cracks. Naphtha's kind of just hanging around as well. It's not. Was up a little bit last week. It's a little bit further down now, but nothing to write home about really, because I think the light end of the margin is really what is. People are looking at.
Yeah, really performing. Yeah. It's so true. But then the report, so just back to the slates quickly, the reports that we're seeing on production, so like, global production, let's look at the US, typically a lighter slate, should be more naphthenic, potentially gas oil and distillate producing. There's a lot of production coming out of the US at the minute. I mean, I think I read that Chevron are at max production.
Correct.
So there's a lot of light sweet around, and the stuff that's not getting bought, potentially Russian, OPEC holding back, that's the fuel dominating crude barrels. So it's quite interesting to see that.
You would think the opposite, right?
Yeah, exactly. Just for the the waste barrels, the one non-middle distillates. It's quite interesting that it's happening that way round.
Yeah, and but It is interesting, and I would agree with you. You'd normally think that actually, as we discussed actually last week, we think the light heavy margin might compress a little bit, but that's the exact opposite is happening.
Very interesting.
I think on the light side, or the lighter side, I should say, naphtha is largely being driven by gasoline at the moment. The gasoline strength is the feature.
Into the blending pool.
Yes. Yeah. Yes. I mean, there is proper gas snap hedging, that's been active over the last few days, especially on this gasoline strength. And then it feels like the ARB is actually open. So with the amount of strength that we're seeing in European gasoline, I feel that there's probably going to be some fixtures going
from the US.
No, to the US.
Oh, to the US.
Yeah, to the US.
Oh, I see. So it's a US product strength that's pulling everything up?
It was the US product strength that was pulling everything up. Now I feel like it's Europe that's keeping everything up on the gasoline side.
So I guess until we start, getting these run rates back to 100, we should expect this kind of spot buying. So it's predominantly in the front, right? So we should expect that to remain. To be honest, seasonally, the refiners should be back. I think it's imminent they will be back.
I imagine so.
They should be buying, over the last week or so for kind of mid-Nov, deck for sure. Given these margins, they have to run 100%. I mean, it's a bit silly not to.
Correct.
So
is it a demand side story then?
Well, it seems like it. I mean, I think this whole year has been very whipsawy. I think, the positioning has just been crushed. I think there's not a whole lot of confidence on the curve, and so people are just a bit jittery, it seems like.
It's really interesting that you said that, just because we are coming into the new year, right? There's a lot of firms that are going to be wrapping up the end of the year. And I think it's not something to ignore, because in addition to wrapping up the end of the year, there's a lot of companies, traders, that P&Ls start flat in the new year. And there's probably a lot of planning going on for what risk is going to be put on in the market.
What Q1 will look like. Exactly.
Correct.
And
I think it's worth talking about that.
Yeah, no, it's true. I think, all year the market's been looking for a different rhetoric for next year.
Yeah.
And the closer it gets, you need to start then looking to position, etc.
Yeah.
A lot of refiners as well, they might be clearing out their crude stocks. So it might be why we're seeing a lack of buying in crude specifically. But it does seem like it's Dubai-led, to be honest. So all year, Dubai has held up the whole crude market. Really exceptionally, to be honest. And it's just totally flatlined the last week or so. We had fairly good expectations for pricing. I think the first day of pricing was around 130 on the spread. We're currently pricing 50 cents. So really, there's been a lot of subdued activity, like not aggressive,
not that spectacular, much.
No, it's really quite underwhelming, to be honest. And seeing as Dubai has been the one that's led the crude market, everything else is also quite soft. So just looking at dated quickly, I mean, we had this, I guess, bull play for October and November. Trade House took predominantly all of the cargoes for those 2 months loading. Now I think what's happened is most of those barrels have probably cleared. There are probably still a few around, and so we've got this front overhang. But despite the margins, the market is not confident enough. Given that strong rally, you need to let the market reset at some point. To be honest, I thought we had it before the sanctions. We hit quite low on all the spreads. The dips came down, and then that short. The short covering came back in, but I don't think that's how the market wanted to have that short covering rally.
Okay.
So now it's happened. You've just stopped people out on both sides. And
no man's land bit.
We're in no man's land, so it's just super sensitive to flow. If one person comes in doing something, you can just see the market gravitate whichever way that's going. It's just showing a lack of liquidity and positioning.
It does feel very liquid. It feels extremely. We discussed this last week. The market is going to be flow driven for the rest of the year.
Definitely, but right now, in crude at the least, there is a lack of flow until these refiners come back and they start purchasing. But again, it could be a contagion. As soon as one buys, the next, we'll have
A little bit of herd effect.
So I think it'll be very momentum based, which could be good for the market, to be honest.
Yeah, probably, and I think you'll see the same thing on products, and I think it's going to be thin for the next probably all the way to the end of December, I would say.
And we have Thanksgiving before that as well.
You've got Thanksgiving, and then you've got Christmas coming up. A lot of people on holiday, a lot of people unwinding books. But importantly, also, there's probably going to be a lot of positioning of the market for the new year, pre-positioning of risk and risk for the new year. And I think if you look at it psychologically, it's probably going to continue driving products up.
Yeah, it looks like it.
Yeah, and so the question really is the margin hedging sufficient to just take out? Is the product buying going to be sufficient to take out the margin hedging? And I would suspect so.
Yeah, well, that's the other thing. I think one of our fuel guys was saying last week we saw a reversal of the margin hedging from spec buyers, I assume, like funds, etc. People that don't need to actually hedge the margin. So those that were trying to catch the highs. But you go from, I mean, just quickly here, they were probably hedging around $8-9. We're now at 11.5. Hit 12 on Friday. A refiner's going to be running at 100% at 8, still 100% at 11.5. So it's kind of immaterial.
Because this is obviously deck margins, right?
This is currently it's rolling month 1, so it's
so prompt margins.
Exactly.
Right? I'd be curious to see what Q1 margins look like because if we're talking about momentum and we're talking about risk coming into the new year and what's worked this year, which has been product length, crack roll length, and those have been themes that have been working consistently over the past year. I think you'll find that there might be a lot of trade that comes in to buy, or traders rather, that come in to just reload on products, looking at a potential margin roll up.
Yeah, to be honest, we have had that. I mean, I remember looking at it last month, and the margins were around $9-10, I think. We rolled on the month, and I think we rolled to 8.
Dropped a little bit, and
then they boom, all the way back up, and through the highs.
Correct.
So yeah, totally right. We could definitely see that. But yeah, very interesting dynamic, I think.
Yeah.
It's I just don't think we can take this gas oil as like it's here to stay. It feels like it's here to stay.
The gas oil strength.
Yeah, I don't think that's.
I don't think that's going anywhere.
Yeah, I don't think.
I think
it's
in fact, I think it's not. I think you're probably going to continue to see strength all the way through to next year.
Yeah.
Which is going to keep the margin high. So what corrects on the back of it, right? Maybe naphtha a little bit, maybe fuel a little bit. But the reality is that there's any demand would probably take a lot of that out, and I think it's the prompt margins are a bit scary when they're this high to be just constantly long. But I mean, I like margins further back.
Yeah.
I think it gives
for that roll up.
Not just for their roll up, just looking at the price of product spreads further back and the price of and crude further back. I think I'm still convinced that we have to move up on crude.
Yeah.
And if anything is going to come in the balancing factor for margins, I think it should be crude strength.
I agree. I totally agree. It's just a matter of when. It's very much a timing game at the minute. So that's kind of the price action we've seen. Just quickly geopolitically, it's hard not to really talk about it, but we're still waiting for this deadline, November 21st, to come in for the Russian oil sanctions. Maybe that's what's put the market in limbo a little bit. But since over the weekend we had, China, US drop their sanctions on the ports, which it should help TI, I think. So I still like the TI Brent trade. I think that's I think that will perform, just despite, if the sanctions do go ahead, US will be bought. If the ports, and US-China tensions totally relax, US will also be bought into China, into the east. So I do think US is the barrel that you want to be buying. Currently, it's also landing very cheaply in the North Sea. So when refiners do come out and buy, it's likely that that's the barrel that they will want to purchase.
That's going to be the marginal barrel that's going to define the price.
Exactly. So freight's still a little bit toppy, but it does feel as time goes, the geopolitical premium is narrowing. So I do think that the freight will also start to come off a little bit.
Yeah, and I think tariffs are a really important factor in freight. To be honest, I know that's not the only factor, but I think we've had a lot of tariff-related headlines this year.
Yeah.
There's still a lot of uncertainty around some countries, but over the past week or so, especially with Trump's trip to Asia, there have been more and more trade deals being struck, and it does feel like things are normalizing to this tariff world. And I say that with a bit of caution because obviously we're, speculating Trump's policy on tariffs is a little bit difficult.
It does feel though the last week or so he has softened his stance quite a lot. I mean, I think I can't remember what country exactly, was it Hungary, where he's just said, don't worry about the sanctions. You can purchase Russian oil. It's all good.
Yeah.
So it does look like his stance is starting to soften. So I do totally agree with you there. But then we still have potential upside or downside risk as soon as he comes out.
Yeah.
So it's just a bit of a.
It's like I think, and the market's trading that way, both crude and products. I mean, a lot of people are just a bit. I'm going to stay
skittish,
out.
Exactly.
And wait for some high conviction moves.
Yeah.
Or I think traders can be inventorying risk further back in the curve where it's a little less volatile and maybe more high conviction. And that's my approach at the moment. I still like those back end margins.
Yeah.
Not all products, some.
Yeah.
I am not going to go short gas oil, but even gasoline, I think it's. We're in winter gasoline here.
Yeah.
I understand.
Where's the crack?
It's 15.30 in deck or something like that, and
Wow.
it's and that's I understand that we have a tight complex in gasoline. There's some tightness in Asia. We're pricing strong in November, but driving demand, any general end user gasoline demand is going to dip off as we get colder and colder across the globe, so across the West, I should say. And I'm not really convinced on the gasoline strength, and I think that could be a part of the margin that does correct.
Yeah. Well, let's see.
But like I said, it could be insignificant.
It could.
Because 11, 10, 9,
No, exactly. Yeah.
All profitable. Right.
Okay, cool. So just talking about high conviction, what's your trade into the next week then?
I'm actually gonna say short gas snaps. I like to be short some gas snaps probably in the summer, Q1 of this summer, and then still long back end margins.
Okay, perfect. And for me, I still like the TI Brent boxes, so that's definitely being kept on for 2 weeks ago. Last week was long NovDeg. That has not performed. I still do like it though. I think the risk reward is to the upside. It looks to me as though it's been oversold. If any kind of marginal refiner buying comes in, that is the contract that's going to move. Also, DEC Jan, we've got really strong margins. There's no reason that DEC should be underperforming given where the products are, potential run rates that we're going to get into December. But obviously, you need to be cautious around Christmas week, etc. So it probably looks like long DEC structure is probably the crude trade for now.
Sounds good.
Cool.
In agreement.
We'll see where we are next week. Thank you.
Thank you.
Hello and welcome to the latest episode of The Hedging Show. I'm joined as ever by Harry, and we've got Julian back with us this week.
Aren't you lucky?
So, this week, slight change of tack. So rather than talking about energy, we're going to be talking about FX risk, how you can hedge it, how you can measure it, how you can manage it. So I guess it's a sort of feature of many businesses, but it's not always a risk that people are necessarily aware of, or possibly one that sometimes people just think, okay, we'll just live with this risk because we can't really do loads about it. And I say when we're talking about FX risk, we probably most of the time mean exposure to the US dollar. So if your costs are in one currency and your revenues are in another currency, and that's particularly important in the commodities industry because almost all commodities are priced in dollars. Mm-hmm. And I suppose, we've all probably become more aware of currency strength in recent years, post-Brexit, as the pound has declined, we've noticed holidays becoming more expensive and, goods becoming more expensive because we import most of our inflation. But that's probably, been a fairly long-term trend over the last 20 years or so that the pound has been weakening. But I mean, at the start of this year, though, we have seen a little bit of strength. So I think, into the back end of last year, the pound was particularly weak. And then the start of 2025, we saw a sort of, 15-cent rally. And then ever since the kind of tariff news in April, we've been kind of moving fairly sort of sideways between a range of about 130 and 135. But I think that's certainly been one of the big themes of 2025, hasn't it? The kind of, de-dollarization and people not being so happy having exposure to the US dollar, which has traditionally been viewed as a safe haven.
Yeah. Just before we go on to that, there was something that you said at the start, which might be worth clarifying for the viewers. You said we import most of our inflation. Might worth clarifying.
So that's right. So but because so many commodities, so the kind of raw inputs for whether it's food, whether it's energy prices, are all priced in dollars, it means that if the pound is weak, then the cost of those goods goes up. And because we're a net importer of food, we're a net importer of energy, we don't really have much control over the costs of those. And then the currency adds an additional dimension to that. So people in the US would have found themselves more insulated from the cost of living crisis, even though it's still being quite a big political football that's being kicked about. They would have been way more insulated from the kind of post-COVID, post-2022 cost of living crisis, because they use the US dollar and the dollar was strengthening throughout that period. And they've also got a lot of domestic production of food and energy. Whereas for the UK, it was a double whammy because the raw prices were going up, but the sterling adjusted prices were going up even more.
Yeah. Okay. Yeah, so de-dollarizing. Well, and I guess specifically in the energy markets, you've seen like a real, since the kind of Western sanctions started in the last few years against Russia, especially, there's been like an enormous narrative of this, like, well, again, de-dollarization, but a lot of global trade, especially in the East, kind of happening outside the Western financial system.
So worth noting as well that whenever you do a transaction in dollars, it always has to be routed back via the US. So if Iran wants to do a deal with Russia or China or something like that, they can't really do it in dollars. It has to, otherwise it will be routed via the US, and they'll be made aware of it.
Exactly. Yeah. So I actually got sent an article this morning, which was from a couple of weeks, in fact, maybe like a week ago. And it was the Russian finance minister said that like over 99% of their bilateral trade with China is now priced in rubles or yuan. And I mean, you've seen, there's been a lot of articles. I mean, people who follow kind of financial news and especially in the energy markets would have seen that like more and more you're seeing like India Indonesia, Brazil are transacting a lot with Russia and China in actually their native currencies, which, as I understand it, is quite a big boost for them, not having to kind of hold like large reserves of US dollars to transact and being able to just transact in their kind of domestic currency.
Yeah, no, I think that's huge, isn't it? Especially with all the kind of tariff disruption as well.
Yeah.
So I think historically it was probably less of a problem because all of those kind of Southeast Asian countries are sort of exporters, and they would have probably been running a dollar surplus.
Yeah.
So it probably wasn't a massive issue for them to then use those dollars to buy energy. But since Trump's effectively trying to reset that balance, they don't necessarily have so many dollars swishing around anymore.
And also, well, it's on one hand they get the oil's discounted anyway because Russia is just selling discounted oil because they need to keep it moving, but also being able to pay for it in your local currency as well and kind of circumnavigate the Western financial system for them. It makes it like much more efficient. It's a big boost to the economy, basically buying cheap oil in your own currency, where they used to kind of have to go to the kind of open market and buy it in USD.
Yeah.
And also, if you're buying a lot of stuff from China, which most people are, if you can now kind of transact in energy in yuan as well, then it almost kind of makes more sense now that you hold just a big foreign reserve of Chinese yuan rather than US dollars.
Yeah, exactly. And then you kind of have to look at where you're investing those foreign reserves as well. I mean, kind of historically, people were quite happy to hold dollars as their main reserve currency, weren't they? Because, you could just plow that into US treasuries and that was seen as the kind of ultimate risk-free asset. Yeah. Whereas now with the kind of constant hiking of the debt ceiling and the kind of US government borrowing just going up and up and up, people are a bit nervous about holding US treasuries, and they'd probably be more comfortable holding Chinese bonds now, I would say.
And I think I pulled a stat for this, which was that the kind of foreign US treasuries held in custody, I think, is at the lowest level for like 15 years or something.
We should get a graph of that up because that's a really, and if you're selling those off, you're actually adding to US inflation, right? Interest rates are going up, their debt is increasing. Yeah. It really is exponentially compounding. It's kind of similar problem we've got here in the UK.
Exactly, with gilts where, you've got quantitative tightening going on.
Yes.
That's pushing yields higher. And then you've also got sort of lack of demand as well, which is just, it's a bit of a perfect storm, isn't it?
But and it's interesting, isn't it? Because this is not about Donald Trump and the US so the policies, but of course he's very keen for interest rates to go down to that, as we are here in the UK too, because public finances are out of control, right? And that hopefully that's going to get addressed shortly. But that it's really conflicting, and that lack of stability really is problematic now, isn't it? It really is.
And I think we should probably even do a whole other show about interest rate hedging.
Absolutely,
before we sort of fall down that rabbit hole.
Let's come out of that rabbit hole.
But I guess sort of in summary, it's been a major theme of this year, hasn't it?
Yes.
Kind of de-dollarization, weak US dollar generally, people looking to diversify away from the US, whether that's kind of rotating out of kind of tech stocks because there's a high valuations, not wanting to hold US treasuries, and obviously we've seen massive flows into gold. But obviously we kind of need to be cognizant that if you are investing in something like gold as a hedge against the US dollar, if that hedge itself is denominated in USD because it's an ETF, or if it's a gold future trading on COMEX or whatever, then you've still got that dollar exposure, and that's potentially going to water down your returns. But I think we'll go on to that in a little bit, where we've kind of got an example that illustrates that.
But just I suppose to summarize how it's in the energy markets, I think out of all kind of asset classes, energy's been where most of this, and oil specifically, has been where most of this kind of de-dollarization has been pronounced, especially because Russia's such a massive exporter of oil, and the East is kind of starting to transact in native currencies. That's been like an enormous theme, and like India joining in as well, like huge refining sector, them all kind of being willing to transact outside the US dollar system is like, it's a huge shift. It's like a real tectonic shift. And I think Donald Trump's quite nervous about it, given he's kind of just constantly threatening new tariffs on, people for not using US dollars. And
yeah, it's always been in the background, hasn't it? I mean, I don't think dollar supremacy is about to end.
No.
Overnight, but it's definitely at risk, isn't it?
Yeah, it is.
And there's always been a keenness to move away. And maybe now this is the impetus to accelerate that,
Which I guess is what they're worried about, right? It's a bit of a house of cards situation where it kind of looks like the start might be quite slow, but then all of a sudden, if people don't see it as a kind of the safe haven it once was, then it can be quite exponential how it all unravels.
Yeah. You get into this sort of like doom loop, don't you?
Yeah.
I mean, I remember even sort of like 20 years ago, people were talking about the euro challenging the dollar's dominance, and then the kind of sort of post-2008 sovereign debt crisis kind of put pay to that. And it's probably only just kind of coming back now to the kind of safe haven status that's starting to look attractive again versus the US dollar. But I think that narrative is more about dollar weakness than kind of euro strength, isn't it?
I mean, the reality of the consumer market in the US is just so huge, isn't it? It really is. So I can't see it ending personally. It's just, it seems to have started a slippery slope, but maybe that changes, right? And let's not forget Western politics is always quite short-termist, isn't it? So it could all change in 3 years' time, right?
Yeah, I think that's a good point actually, because I think it's worth noting that people from all around the world invest in the US, whether that's holding US stocks or US bonds.
They really do. Yes.
US people only invest in US assets. They got no interest whatsoever in owning kind of European stocks, foreign government bonds. They it's just not on their radar.
And if you think about it this year, just again, not really related to what we were supposed to talk about, but the S&P return has been phenomenal this year, hasn't it?
You
obviously just as a massive correction. Sorry. Yeah.
But anyway, so I think that's a kind of good sort of geopolitical overview, and we've kind of highlighting the fact that there is FX risk out there. That there's the chance that you will get significant moves, but it's all about risk tolerance, really. Some people, to some firms, a 10-cent move could be manageable. For others, a 1-cent move could be problematic. Going back to what we've discussed in previous shows, it's all about your margins, isn't it? And if they're wafer thin, then you're more sensitive. So I guess kind of going back to the topic of hedging, it's if you're a company or you're an individual even, it's first of all, are you aware that you even have this FX risk? And then where does that come from? It's we talked about this before. Just because you don't have a physical position that you can see, it doesn't mean that you don't have exposure, right? So going back, I think Onyx as a company is quite a good example of that, because obviously all of their revenue from trading activities would be in US dollars, but most of their costs would be in pounds. So that just gives them a natural short position in cable, because they're effectively long dollars and short pounds all of the time. And then how do you then kind of construct a hedge around that? Because some of those things might be quite easy to measure. Probably your cost base is probably quite stable and predictable, but your revenues might be a lot more volatile. And then also, you've got to think about, are you hedging against a specific timeline, whether that's, just you're hedging 12 months out, or are you hedging against a specific transaction? So you might get an example where, say a UK company wants to buy a company in Japan or something like that, so that they know that they're going to be doing a sterling yen transaction in 12 months time. So they know precisely what their yen exposure is, and they know precisely the length of time that they need to hedge. Whereas if you're a company like Onyx, for example, then you've almost got this requirement for a perpetual hedge, and the size of each leg might be kind of going up and down all the time. So it becomes a lot more.
You kind of don't really know till after the fact.
Function, right? Yeah.
But I think it's one of these things that
you just mentioned the word cable. And I just conscious that I don't actually know where that term came from. But when you mention cable, you mean US dollar versus
that's
sterling.
An interesting point. Yes, so that's kind of the industry term for pound versus the dollar.
Yeah.
And the reason it's called cable was because the first transatlantic cable that was laid was specifically laid so that it could transmit the FX rate back and forth across the Atlantic. So yeah, that's why it's called cable. And yeah, so interesting bit of that.
Just threw you off your flow there. Sorry,
no,
Tom.
that's fine. So I think kind of going back to what we were saying though, it's even if you've got a very complex FX exposure to manage, like we were saying, where it might be kind of perpetual, it might have different size or variable size on each leg. I think the first step along that journey is just being aware that you have it, isn't it? It's just recognizing that you have a position. And then it might be that you say, okay, we're just going to, risk accept that volatility in our earnings. But I think, the second natural step is, okay, well, how do we measure that? How do we measure the impact that it's having? And then we can then make a decision to say, are we okay with that? And if not, then the third step is, okay, well, how do we kind of, mitigate the impact of that?
Tools, yeah.
And I think, we kind of touched on gold a little bit earlier, but I think that's a kind of prime example because money's been flowing into gold as a safe haven asset, but that is very tied to the value of the US dollar. I mean, it's typically priced in dollars, and as the dollar weakens, it's kind of bullish for all commodities really, because it effectively makes it cheaper for anyone who's not paying in dollars as their base currency, but you're still having to kind of convert into dollars and then purchase the asset. So you've still got some exposure. And it's worth noting that if you look at the price in gold in sterling terms versus the price in dollars terms, that rally has been far less
it's more muted, isn't it?
Yeah. And I think we'll just go on to I've got a kind of just a mock-up here, illustration of how FX risk can really eat into your returns over time. So this is a fictitious company here called ABC Inc. And we've just assumed that you're a UK individual and you've purchased shares at $2 in January. And then at the time you purchased those shares, the cable rate is 1.2. And then over time, I've assumed it's gone up in a fairly straight line to almost 1.5. That's the orange line on the graph there. And then, so you can see that over time, over the course of that year, the share price in US dollars has doubled from $2 to $4. But so you've made 100% return in dollar terms. But because of that strengthening in cable, so it's basically gone up by 25% over the course of the year. That's wiped nearly a third off your GBP return. So that although you're up 100% in dollar terms, and that's those two sort of stacked bars. That the green one is your percentage return in dollars. The blue sort of turquoisey one is your return in sterling. So you can see here that effect, it's kind of completely decimated your returns really, hasn't it? And even if we look at that first bar where you can see that in February the share price has actually dipped by 10%. It's because sterling has just been constantly appreciating, it's making your losses worse and making your losses bigger and your profits smaller. So definitely something to be aware of if investing in foreign assets, that you've got that FX risk that can eat into your returns.
I think I get it. That's a really interesting slide. I think the other important thing to say there is all hedging is about trying to match your financial cash flows at the end of the day, isn't it? Which is what you're really highlighting here at the end of the day.
Yeah, and I think actually you've got quite an interesting case study, which we'll go on to in a minute. But I think I'll just probably useful at this stage to kind of highlight the kind of thinking process that we want, the kind of mindset that we want people to get into when they're kind of structuring a hedge or thinking about a hedge. And that's, okay, step one, identify your current position. Okay, step two, what's your size? Can you measure the size? Is it fixed? Is it variable? Think about the duration. Is it perpetual, or are you just hedging up to a specific point? And then, think about the instrument that you want to use for your hedging. Should you hedge in spot FX, or should you trade a forward? So I think we would always say, if you've got a long-term hedge, you should use the forward, because that's also pricing in interest rate expectations, which is something we haven't really touched upon, about the kind of dynamics of FX pricing. But I guess this kind of simplest way to think about an FX rate, which is always just the relative value of one currency against another, is it's effectively the kind of share price of a country, isn't it? It's a much better reflection of people's economic assumptions about that country than maybe the stock index, which probably consists of a lot of companies that have got a very international focus. I know I've always said that the kind of FTSE 100 is a very poor reflection of the UK, because you've got lots of internationally focused firms, lots of energy firms. They're all of the main firms are dollar earners, so they're not that exposed to the UK economy. Whereas the FX rate is really kind of pricing in expectations about interest rates, which in itself you can infer the kind of state of the economy by what the interest rate is doing. But it's also moving based on kind of relative demand for imports and exports. So if the currency is strengthening, you can kind of bet that the economy is doing well, because interest rates are rising. Probably to try and kind of put the brakes on economic growth a little bit, and probably demand for your currency is going up because your exports are doing well. So that's something that's worth bearing in mind. And if you're just hedging in the spot market, you've got exposure to if assumptions about interest rates change, you've got exposure to that in the same way that you don't if you're trading the forward.
So really the difference there on your sort of third point, that duration piece, if you're going on holiday, you're going to make an exchange rate, you could do it now or then. It's when that payment date's actually due, but sometimes you don't always know that, right? So you might use a perpetual process. I think your last point here, beyond your execution piece, is really important. We should just say, this is all kind of wrapped in the game plan, is the policy, that what the company internally is comfortable taking a risk, as you were saying earlier, and has it got the money to fund that hedge should it go really negative against the market, which we'll come back to in a minute.
Exactly. So execute the plan and then stick to the plan. But before you execute, make sure you're actually
is sensible.
Make sure you're able to stick to it. So it's worth bearing in mind that as we always say, your hedge can go massively offside, but that shouldn't theoretically matter, because it should be a zero-sum game, right? Where whatever you're losing on your hedge, you're making on the other side. But as long as you can kind of account for that in your P&L, and also just make sure that you don't have some kind of liquidity mismatch where you're kind of having to fund the losses on the hedge in real time, but the revenue from the other side isn't going to be realized for a year's time. So it's worth it's always worth highlighting that. Make sure that you can afford to fund the losses on the hedge. And that's why I guess options are quite an attractive proposition, which is the kind of third type of product you might want to use. So you've got kind of spot FX, forward FX, but you could choose to buy an option, and you're probably not going to use that as a sort of direct hedge to kind of lock in the full value. You're probably using that to kind of as a defense mechanism against a kind of catastrophic move. So you're probably buying an option that's out the money, and then that kind of kicks in in the event of a significant move. But obviously the advantage of using a call option or a put option is you're just paying for that premium.
Your cost base is quite
your cost of hedging is defined.
Your cost base is very well defined.
Yeah. Okay. Which kind of brings us neatly on actually to the case study that you were alluding to, Julian, where their company didn't do that very well.
Absolutely. I mean, there's a whole raft of examples, Metcalfe, Shaft, Enron, so on and so forth. But this one, South African Airways, back in 2003, really interesting one. Wasn't directly involved in this, just researched this for this show. And obviously it's particularly relevant because international, flag carrying airlines low-cost carriers in the past have on and off hedged different risks, including FX, including oil risk, right? So it's a really pertinent sort of example. And let's just think of the first couple of things here. They absolutely, in 2003, they had just committed to buy 41 Airbuses over a period of 10 years. And so they're going to be paying these off over 10 years. And they might have been renting them, but essentially giving themselves a large exposure to US dollar payments over 10 years. And of course, South African Airways are their sort of core currency, internationally fine, but their core currency is Rand, South African Rand or ZAR. So they've got this risk to dollar, and if the dollar was going to strengthen, this would effectively push their costs up dramatically for these 41 Airbuses that were due to be delivered.
It's worth highlighting as well that you know that the Rand is an emerging market currency, it is you know, the volatility compared to something like cable or euro dollar is off the chart.
It is much more extreme, isn't it?
Yeah,
2, 3, 4-fold. Right, yeah, you're absolutely right, because actually those major currencies, the volatility tends to be relatively muted, right? 10% there or thereabouts, maybe varies, right? So actually someone in South African Airways, don't know who, I guess someone in the Treasury team, read some bank research saying the dollar's going to strengthen. So they said, right, okay, let's put a hedge on for the 10 years. So as I understand it, wasn't there, don't know the full details. They went off and bought this dollar Rand hedge for 10 years forward. So firstly, that's a very long-term hedge, very, very long-term. Most budgeting for companies, PLCs, South African Airways wasn't a PLC then, is normally a year, maybe 2 years.
Yeah.
So 10-year hedge is a long time.
It's a hell of a long time, because even that's probably normally what you'd expect to be like an entire economic cycle. So if there's a downturn in that time, you might decide actually we don't want 41 new planes anymore, right?
Yeah.
Or simply the company may not be operating in 10 years' time, right? So the hedging so it might be, it's a very long window. However, just in the context of buying those Airbuses, that's a 10-year. So, we are talking about actually an aligned hedge here, right? So important that the hedge, the process that hedge was going to do what it's meant to do, right? Effectively. Now, what actually happened, contrary to the bank research they read, actually the dollar weakened by 28% versus the Rand, as you were saying, right? So in 2023, literally within a few months of putting this hedge on, it had completely gone the other way. So this hedge is now deeply out of the money, creating a massive negative cash flow for them. Now, the hedge is theoretically operating well, but actually they've run past their credit lines and had a 6 billion Rand mark-to-market loss, almost $1 billion. That's a lot of money for any airline, any company, right? It's a lot of money to have that impact and find that cash when I actually haven't got these airlines operating yet. These airplanes in my portfolio operating, generating cash, right? So we're really offside. So the key things there, if we just break that down, just really want to remind people, the hedge is actually a reasonable hedge. What appears not to have gone on is they've acted on impulse. On this bank research, the bank's going to be right. Let's hedge. And so that's a first big risk. And it appears, having read about this, that there was no internal risk analysis. If we do this hedge, what's the cash flow impact? What happens? What if the market goes down 50%, 60%, 100%? Those real disaster scenarios, unlikely to happen, but let's just plan that out. Could we afford it? So that didn't happen. It's a very long-term rigid instrument. So to your point earlier, no, there's no linear. This is completely linear. They completely fixed everything. They didn't do 10%, 20% layer in slowly. It was sort of replicating an option or buy an option for that period, which would have been very expensive, of course.
True.
They wouldn't have wanted to have done it when they looked at it, I suspect. But they got this long-term rigid, I'm completely hedged in one go because the day is the day, which is often not the case.
And I think that's, I think that's a very good point, isn't it? If you're ever thinking that you need to execute a hedge with that much urgency, I think that sounds like kind of FOMO.
Stand back, stand back for a second.
But I think that's always great advice. If you're new to hedging, then just dip your toe into the water. You don't actually have to hedge the full size, in one fell swoop. Just
And most don't.
Exactly. We even talked about Ryanair, who've got a very well-established, very successful hedging policy.
Yes.
Even they're only doing sort of 80 to 70 to 90% or something like that.
In one day.
Yeah,
exactly.
They layer in.
Dip your toe in. At least at least that's going to have some mitigating impact, and you can see the effect of it on your cash flow. See whether it's kind of fit for purpose, and then just constantly reevaluate. Okay, is this working? If yes, okay, well, maybe we're comfortable increasing the size. If not, maybe we need to, change our approach.
And I'm sure those companies are marketing and saying, well, what if it goes down? Are my cash reserves enough to fund, beyond my credit line? If I go beyond my credit line, can I withstand a shock on my hedge? To be able to pay for it. So what really appears here, and you at the bottom of your list, you had here that there was actually no defined hedging policy. And in my experience of 25 years in this market, I am staggered how many companies I have worked with in the past that don't have a clear defined hedging policy. Really important. What is my internal business risk? What are my internal business limitations? Can I fund this hedge? And I've worked for companies where the CFO was called and said, whatever you guys are doing, stop, because we can't fund it anymore. And that's not because we're outside of policy. It's just left hand and right hand weren't necessarily linked, right? And people weren't monitoring things the way they should be. So it really is a real risk, a ubiquitous risk. So internal controls. Is this hedge fit for purpose for my company's limitations? Really important.
Great. Well, a lot to unpack there, and I think we can probably revisit that in future episodes for sure. But I think that's about all for this week. But thanks once again for joining us, and we look forward to speaking again soon for another episode of the Hedging Show.
Cool. Nice one.
Oh, thank you.
Thank you.
My name's Will.
And I'm Ed.
We work on the officials. We produce fair value curves at the end of Singapore and European sessions every day and provide market commentary on what's driving the market at the moment. Today, we're going to be discussing the Dubai benchmark. There's been some interesting developments there in terms of how Murban's pricing recent OSPs, as well as recent OPEC cut unwind. So we'll dive into that. So what have you been seeing recently in the window, in the spot window?
Well, in the window, the key thing that we've been looking at recently is the monthly change. So the change from April trading to the change to the May trading average physical premium, because that's important for the OSP setting mechanically. So if you
check our Dubai explainer video.
Yes,
if
our
you
previous video
if you
for
want
some more explainers on how the structure of the window and the Dubai benchmark. But on the screen now, we can see that the average line, this dotted line throughout April trading was around $1.64.5. And then in the May trading sessions, it dropped to 126.5. So what that's telling you is that the backwardation in the Dubai structure and the physical strength has come off considerably month on month. And now the Saudis use this structure as their kind of indicator for where they're going to set their OSPs, their official selling prices each month. So this gives you the ballpark figure. However, they do have an element of discretion over that exact number.
Exactly. So recently, in previous months, we've seen the Saudis actually decrease OSPs by more than the structure would imply, or hike OSPs by less than the structure would imply. So in that way, they're kind of giving a bit of a gift to the market. If we look at this table, the OSPs into Asia were cut.
The Asia OSP is kind of the important one. That's the biggest market. It's the one that people look at.
OSPs into Asia, they were cut down 20 cents for that kind of Arab light, which is kind of like your benchmark grade from Saudi. But structures implied a cut of 45 cents.
So the structure's change was 38 cents month on month.
38 cents.
So you'd expect somewhere in the region of 35, 40, according to that move. But evidently they've looked at the market and decided not to be quite so kind this month. So there are a few factors. Do you want to explain a couple of those and why perhaps they haven't cut as heavily?
So for one, I think previous generosity is maybe starting to be unwound here a little bit.
You think they're cashing in on the previous kind OSP prints?
Yeah, they could be doing that, kind of making up a little bit of lost ground there. But then the big thing has been the influx of Murban, and at the start of the month, almost all of the convergences in the Dubai spot market were Murban.
We have a chart here to show that. So the light blue bars that you can see at the beginning of the month up until about the 21st of May, 21st even, they're all Murban convergences. So obviously in the Dubai window, the seller has the right to declare a given grade within the basket. So up to this point, all of the sellers were declaring Murban exclusively before we got to move into the Oman and Upper Zakhams.
Exactly. And that's kind of the whole premise of the Dubai window, is you declare the most competitive grade. The difficulty comes when the Murban is a different grade, as we discussed last week. It's a little bit lighter, it's a little bit sweeter. We had a huge influx of Murban into the spot market, which then is deliverable into IFAD, and ADNOC set their OSPs based off of the Murban futures in IFAD. So there's a discontinuity here, because you have Murban, a relatively lighter, sweeter crude, setting the Dubai benchmark, which is then used to set OSPs for Saudi grades, but it's not reflective of those benchmark Saudi grades. So naturally, the Saudis thought, well, we should probably cut by less. If you have Murban setting the floor here and Upper Zakham and Oman trading at a premium above that, and those are more reflective of the Saudi grades, that makes sense.
The other issue with Murban is really the IFAD aspect of it, because IFAD is the exchange where you can trade Murban futures, and they have a physically delivered Murban contract. So if you're say somebody who's been in the spot market, you've been buying in spot market, you've got a load of Murban cargoes that you don't really know what to do with. an easy way to get them off your hands is go to IFAD and sell Merben futures.
Yeah.
Hold them to expiry, deliver them to whoever's bought, and then job's done. You've got rid of your Merben, and it's a very simple way of getting it off your hands.
Yeah, exactly. And that has led to Merben futures pricing under Oman futures throughout the majority of May. The difficulty there is that ADNOC set their OSPs based off of the time spread structure in Merben futures.
Yeah.
So when you have a relaxing of the curve there, that directly impacts the amount of premium they can charge over above the benchmark for their cargoes.
Yeah. It also means that rather unpopularly for ADNOC, they have to then set their Upper Zakum, Lulu, DAS OSPs as a delta to the Merben.
Yeah.
So normally you'd expect them to, Merben is kind of their flagship, their premier grade. So you'd expect that to price at a premium to Upper Zakum, etc. However, what you're expecting now is to see Upper Zakum at a premium to Merben, which isn't normal in terms of the general kind of the previous historic expectations.
Yeah, the pricing hierarchies flipped.
Exactly. So you'll see perhaps a bit of a disgruntlement among ADNOC for that reason.
Yeah, so there's been a lot of kind of chatter about, okay, so what can we do about this? How can we rectify the issue? A lot of people have been suggesting, why isn't there a negative quality premium on Merben? So at the moment there is a quality premium.
And by the way, if you want an explanation on what a quality premium is, how it works, look back to our North Sea dated Brent explainer from a few weeks ago.
Exactly. And the positive quality premium on Merben is set at 50% of the net difference between Platts Merben M+2 and Platts Oman M+2 over the 15 business days prior to the day of publication. Quite crucially is that if that is less than 50 cents per barrel, the quality premium becomes zero, but it's bound at zero. It cannot go negative, which means if Merben falls below Upper Zakum or Oman, it will set the floor in Dubai. The negative quality premium would enable Merben to price under the benchmark, which would then lead to an appreciation in Dubai. And Merben would clear with a negative quality premium, i.e. the seller pays the buyer at delivery.
Yeah, although there are a few drawbacks with this, because you could say that this is merely a reactive response or solution to a market dynamic where we've got a lot more Merben available on the market because of high production, high export quotas for Merben. Plus the fuel oil strength that has really strengthened the Upper Zakum crude.
Exactly.
So if you're going to introduce this negative quality premium now because you don't like the fact that Merben is setting Dubai, that to me doesn't suggest that it's kind of a solution to the intrinsic problem. It's more of a reactive way of resolving this thing that this aspect of Dubai that you don't like.
Quality premiums are lagging. They're set as the average of 15 business days prior. So they don't react particularly quickly to market fundamentals. And we've seen in the case of Merben, a lot of supply coming out and a lot of supply blended with condensate as well, which means that it yields high naphtha content. And we all know how naphtha feedstock for petrochemicals is looking at the moment. Petrochemicals are very, very bloated. A lot of excess supply there in Asia.
China.
Exactly. So it's not unsurprising that Merben has been setting the Dubai benchmark, but recently we have seen that switch a little bit.
There's been a significant change because every month ADNOC releases its forecast for exports from the Merben field, and it had originally on the 28th of May published a forecast for around 1.75 million barrels per day across the next 12 months, fairly steady. But they've since revised it early this week to have that export schedule drop off towards 1.5 million barrels per day towards the late summer, early autumn, and then come back up towards 1.75 again next spring. So what we've seen already is Merben price jump. So you saw Merben futures immediately jump well above the Dubai benchmark because it's now being set by the other grades in the basket. And that has kind of, I think, soothed some of the concerns about the Merben price.
I mean, we've seen that ADNOC are going to be running more Merben in the Ruwais refinery, substituting out some of that Upper Zakum before. So, we're going to see that tightness in medium sour probably probably alleviate a little bit.
We're also beginning to see fuel oil start to weaken slightly. The cracks in fuel oil have come off slightly, so there could be more
direct crude burn.
Exactly, and more loose medium sour as well if Upper Zakum begins to become a bit less value due to that fuel oil dynamic.
Definitely. But then there's also the question of OPEC, at least the voluntary cut on wine that we got last weekend. What's your thoughts on this? I mean, I think it's pretty clear from our side.
Yeah, I mean, as we've said in many of our reports, the 411,000 barrels per day isn't going to materialize on the market.
No.
So what this is doing is improving compliance. However, it does improve the optics and make the market look a bit like there's a bit more supply available. Perhaps there will be some more from the Saudis, for instance, but from the other members, it's unlikely to make any significant difference. So
And
in that respect, it's minimal impact, I think.
Yeah, and they're likely to increase production ahead of summer
naturally
burn season, because they're going to be burning crude for power generation. But realistically, this is going to be pretty immaterial in the grand scheme of things. We've seen, 7% of Canada's oil capacity come offline recently because of wildfires there. And that was about 350,000 barrels per day. And they're still disrupting supply there. So there's a lot of drivers at the moment. The OPEC unwind, for us at least, it seems immaterial.
At present,
There's varying analyst expectations about future cuts. There will naturally come a point, if you cut so far, you will come up to production. And
in terms of the quota compliance.
Exactly. And at that point, the Saudis could release more crude. The UAE have a little bit extra in the tank. But the
real story here of extra capacity is the Saudis, though, really, isn't it? They're the ones with the millions of barrels back in the tank that they could bring out. But
and the key indicator of their intention is the OSPs. And the fact that they're being a little bit less generous on the OSPs goes against the idea of a price war.
It's telling the market that they're not perhaps interested in that massive market share battle, the price war, etc.
They're not willing to really cut back prices to reclaim that market share. If we see them start to really underprice their OSPs relative to structure, that would suggest that they're going to be turning on the taps, i.e. making more room for barrels. But we haven't yet seen that. So that's what we've been.
It's one to watch, but for now, not a major concern.
For sure.
Okay.
So to wrap up, do you want to just talk us through a quick summary of what we've discussed today?
So really the key thing has been the Dubai developments, the Murban pricing issues, and how people are thinking about perhaps rectifying or compensating for Murban setting the Dubai benchmark. The influence of that on the Saudi OSPs that have just come out, the upcoming ADNOC OSPs as well. And finally, what we think about the OPEC cuts and how, in fact, they're not as significant as perhaps some market commentators are suggesting.
Hi, my name's Will.
And I'm Ed.
We work on the officials. We publish fair value curves at the close of Singapore and European sessions daily, as well as providing market commentary, dissecting what's driving price action. Today, we're going to be looking at the North Sea physical market, as well as taking a look at the CFD structure and how that's evolved in recent sessions, and then put all of that in a global context. Dated Brent and the North Sea physical market is really, really important. It's the market that prices around 70% of physical barrels traded globally. So that's 70 million barrels per day, all priced as a differential to Dated Brent. That's worth about $5 billion at $70 barrels. So it's really important to understand what's driving the prices there, not just from an oil market perspective, but from a global economy perspective. So we've seen a big softening really in physical Dated Brent. So what have you been seeing there, Ed?
So the key metric you need to pay attention to here in the physical market is the physical differential, which similarly to the physical premium in Dubai, works as a measure of how much you have to pay in order to get your hands on a physical barrel of crude oil. Now, in recent sessions, and when we did our previous video on dated Brent, which you can go back and watch when you finish with this one, we'd seen that the physical premium, as we can see on the chart here, was very, very high, up around this 90 cents to $1 kind of area, until we get to this point. And then suddenly we plummet into the negatives. Now, this is largely a function of the window dynamics, because in the window you have, like we explained last time, traders coming in, bidding and offering, buying and selling their cargoes.
Yeah.
And throughout this period, we had towards the end, one trade house in particular, Trafigura, was lifting a lot of Midland cargoes, and that helped to support the physical differential.
Not just lifting, bidding as well.
Bidding and lifting. And that helped to support the physical differential. However, when traffic disappeared from the window entirely, suddenly, they left a kind of void of power dynamic gap where there was nobody on the other side of the sellers. And this led to a significant deterioration and plummet in the physical differential.
It was also a bit on the supply side as well. It was not just absence of buyers. It was, we had a lot more Midland cargoes coming into the dated Brent complex as well. So we had a lot more liquidity in the market with not very many people bidding. We've also seen we've also seen 40s trading really competitively. A big driver there has been the closure of Grangemouth refinery. They were taking in about 6 40s cargoes per month. So that's an extra 6 cargoes deliverable into the dated Brent complex. And so in yesterday's session, we saw Totsa lifting 40s well above the curve, but that was above the 40s curve. And this is where the distinction between lifting or bidding is quite important.
So what you can have is a seller coming in and offering a 40s cargo. Let's say it's at dated plus 50 cents, and they lower that offer to plus 30. A buyer can then come in and say, I want to buy that, lift the offer, and trade at dated plus 30 cents. That doesn't necessarily mean that the 40s curve is set at dated plus 30, because they could have lifted an offer that's still above where the 40s curve is, which is what happened with the Totsa lift.
Exactly. Crucially, a trade doesn't make a market. So you can bid below or lift offers above the curve. So, I mean, so to summarize, we had a lot of Midland coming in. We have excess 40s, and we have had an absence of aggressive buying. So that's had a big impact on the CFD structure. So this is like a mini time spread structure right at the front of the curve is the way that I'd describe it.
Yeah. So put simply, the CFD is a weekly contract, which is a weekly average of daily dated Brent. And this is primarily used as a hedging instrument because it allows more precise and more granular hedging for the physical players, because it doesn't work on the monthly structure that say Brent futures does.
Exactly. So when if you trade for physical barrels, you can trade partials of cash BFOE, which are for 2 month forward, for example. And they're in any, they don't have a date assigned. But as soon as a cargo enters the CFD kind of window, it gets a date assigned. It turns from an any to a dated cargo. So that requires, from a hedging perspective, as you say, a more granular, a more precise instrument.
Exactly. So looking at the structure here, down here in May, we have this contango structure where it's weaker at the front and increasing towards the back. However, when we get into June, it levels off and then begins to enter a backwardation, structure of backwardation. Now, this structure, for the reasons that we just explained, makes sense at the front because we have this excess of Midland, a lot of 40s are available in the North Sea window, and there isn't much buying interest. However, well, could you explain why perhaps the structure becomes suddenly a lot more backwardated in the June contracts?
Yeah, so I mean, typically backwardation is a function of storage economics. It's a function of demand and supply. So when you're looking into time spread structure, it's important to bear that in mind. And for one thing, margins are still pretty strong. So we still have relatively robust refining demand. And check out our explainer last week if you want any more information on that. But also we have the Ecofis field going into maintenance, which is going to be draining liquidity from the dated Brent benchmark through June.
Yeah, it's going to take some of the cargoes off the market. Therefore, in a simple supply and demand dynamic, that's going to decrease supply. Well, demand shouldn't be affected by that, so it likely will see prices increase.
Well, it'll support
backwardation. Yeah. And then when
there's also less Midland coming in as well.
Yeah, that's a big factor.
And so yeah, it makes sense. Contango at the front suggests basically we have a bit of an excess supply right now, and the sellers are facing a little bit of difficulty in placing their cargoes. But if you look at the implied physical diff moving forward into those more deferred contracts, that more robust backwardated structure that's more consistent with the futures curve at the moment is still in place. So it looks to me, at least, that this is largely going to be a bit of a temporary, isolated structural weakness in the very prompt of the structure. And moving forward, we might see the strengthening maintained.
Yeah, and then on the global scale, I mean, we've got. You can obviously look at this as the North Sea. So it's a defined benchmark region, the same way as Dubai is, where it's got these local grades that feed into the basket that we explained in the previous video. However, you have to consider the global context and the global market. So for instance, at the moment, there is a bit of a glut of Murban supply. And Murban is a kind of a lighter Middle Eastern grade from the UAE. So it's more of a competitor with the North Sea lighter, sweeter grades. And so that can see, it can reduce the value of light sweet crude compared on the relative basis to the medium sours. However, there are other factors like, for instance, Iran, if you want to explain that one.
Yeah. Well, I mean, just on that point, I mean, 40s very commonly clears into Asia. And obviously a lot of Dubai grades also clear into Asia. So for 40s, Murban's a direct competitor. And if we have a big supply increase in Murban, that's kind of bearish Murban, then we would expect that to translate to
bearish 40s
as well. So there's a lot driving this kind of this contango at the front of the CFD curve at the moment. And it's important to not just focus on what's happening locally to the North Sea, but also globally. How are competitive and comparable grades pricing elsewhere? And paying attention there. But yeah, you're right as well. It also depends on geopolitics as well. Like Iran at the moment are engaged in nuclear deal talks with the US. If we see an agreement made there, then that might translate into the US applying less pressure to Iran. So they're producing about 3.5 million barrels per day. A lot of the market was pricing in a pretty
aggressive maximum pressure policy from the Trump administration. But if that doesn't come to pass, then you could see that affect the medium sour compared to the light sweet grade differential, which is kind of translates into a Brent Dubai kind of differential. So if you do then have an easing of the pressure on Iran, that will make more medium sours available more freely, at least without the difficulties of going through the hoops of avoiding the sanctions. So that could see, therefore, a bit more strength in the Brent Dubai kind of spread. But so yeah, you can't just break these benchmarks down into their regional components, regional areas, because they are still global. If it's more economically viable for an Asian buyer to buy a North Sea grade and then ship it round to them in Asia than to buy a Middle Eastern grade, they'll do that. It makes sense, right? And equally the opposite way around.
If it's competitive on a delivered basis, including freight, then why would they
exactly
not choose that particular grade? So yeah, it's very important to track global dynamics, including shipping. We'll do a shipping explainer at some point.
Yeah.
Okay, so to wrap up, what have we talked about today, Ed?
So we've discussed why the physical is weak in the prompt and physical differentials dynamics. The CFD's contango structure in the earlier contracts, and then moving into a backwardation structure further down the curve, and why it's important to remember dated Brent and the North Sea in its global context.
we're talking about being in the front and center of the market, how it prices and taking on the market and dictating it. It's never happened that there's a woman, I can say very confidently. Do you think any of that's important, or have you used the femininity to your advantage in some scenarios? Or I don't know, how have you adjusted?
I mean, the way I used it when I first joined was, you know, even things like you have a different pitch, so you actually can be heard. You know, if you have 10 people...
The pit trading mentality, like the open outcry, you can hear Manny's voice.
Exactly, it's just like it's a different frequency.
Okay, Manny, you are between 30 and 55% of the dated Brent CFD market at any one time. And together with Ashley now, who starts on Axis, get to about 85% of the dated Brent market. So that's obviously huge, that's significant, and dated Brent in turn, and what you trade in particular, very much impacts the settlement of a contract that settles in turn 70% of the world's oil. So you're essentially probably one of the biggest crude traders in the world in the most important benchmark. So that with the context, you know, how do you feel about that?
Yeah, I guess, I mean, it's a big statement, but the reality is it is true. I think something that I probably wasn't aware of before I joined the market or started this job was how specific contracts can be, but then out in the real world, how they're used to price so much of the world's oil or so much of, you know, one asset, etc. But yeah, exactly that. I've been trading it for almost 9 years, and it has been a steady increase in market share, in, you know, the risks that we take, how we like to position it, etc. But I think the point is we've found how we can service the market, and how we can do that is by providing CFD liquidity. Yeah.
So just on that point then, so because this gets discussed and people always assume you trade with Manny or anyone at Onyx, but let's just focus on you. And Nick Balak, who was your broker and now works here, was very vocal about that recently as well. You know, if you trade with Manny, she must be taking some money. You're getting ripped off somehow. You must have done something wrong. And you're even trading like next week's prices, which, or even this week's prices, which are impossible to hedge, right? So how do you give that, like, what's your answer to that immediately? Like you're talking about it as a service in terms of providing liquidity. So you try to be there when you can and try to give the best price you can for anyone who asks for anything really. But how are you able to do it then if you're not hedging straight away, or not able to lock in a counter price straight away?
Yeah, I think, I mean, a lot of the people in the market that like to make these comments, they started in the industry, you know, 10, 20 years ago, where it was just a totally different environment. That probably was the case, where you'd have intermediaries like banks. To be honest, market makers went around, but so predominantly banks, and they would...
Well, I was the first stripper in dated Brent, and yeah, I can tell you I wouldn't have traded it unless there was an arbitrage. So you're right, it was definitely that to begin with.
No, exactly. So, you know, they came from that kind of time where, yeah, exactly, you were kind of getting risk neutral using different contracts, essentially, and you collect the bid offer. Immediately.
But the market gets so tight, so efficient, you can't do that. So generally now, as of now, not so much the journey, like how do you answer it right now?
Now, I would say the market is so smart, it does not allow for you to trade in that manner. And so really what's happened is over the last probably 5, 6, 7 years, I would say that, you know, we've slowly developed internal risk strategies, hedging tools, etc. And also, you know, we do trade on a medium-term basis. So when I say medium-term, usually anything from like 3 to 4 days to probably a month. That's how long I typically hold positions. And a lot of the market is like anything else, you know, it's not just one-dimensional or two-dimensional. It's having a view on forward prices. It's putting it together with fundamentals, recent price action, positioning in the market. There are so many things at play that tell me where the price I should be buying or selling
be a politician.
essentially.
But I think now that we had this conversation with Omar, and I'm trying to ask in these things like some consistency in the questions so people can see like the similarities but also the differences. Would you agree that ultimately, because your job is to provide liquidity when someone wants it, in effect you have to predict what they're going to want? You
do, and also I think the market just assumes that we make money all the time. That's not the case. You know, last year I had a couple of months where, from taking down these contracts from trade houses, etc., I lost a lot of money very quickly. Sometimes I make a lot of money very quickly as well. So on balance, you know, it's all about how you manage the risk yourself. I have certain protocols in place which help me.
Yeah, but let's say, is it fair to say you're trying to read the market's narrative, preempt what it could do in certain scenarios, but ultimately I think the crux of it is finding ways to put on risk that gives the industry what they need, and you can even have similar risk to them but done in a very different way. So you're kind of finding an alternative way to put on the same risk as the market.
Yeah.
And there's loads of, I'm not going to go into that too much because obviously that's your IP, but there's of course a lot of work with correlations, and there's like the work on what the physical market's really doing. And one thing I would do, because I was a dated Brent trader as well, we always got accused of, how can you have a view? What do you know about the physical? Like there's, of all the markets that trade in oil, dated Brent in particular is definitely the most old school, definitely the most governed by the smallest number of players who dictate real physical barrels in the North Sea. Is that our job is to know what's happening with those physical cargoes, and it's information's king. If you have information and if you can actually buy and sell those actual physical cargoes, those specific ones, then you're done. That's your game closed. Whereas you come in with absolutely none of that, yet you're still able to have a view. And they go, how is that possible?
Yeah, I think you're totally right. I think, you know, for physical traders or trade houses, etc., their number one most important piece of information is what's going on with the cargoes.
But you would say that's fair in some respects, right? Compared to, say, gasoline, which can move like a lot on RBOB, which is like a very paper-driven contract. Dated Brent contracts, in particular CFDs, these niche weekly dated Brent contracts, it is it moves with the physical.
It does move with the physical, and often what you'll find is, because of that, you know, bids and offers get stacked really aggressively. So the you know, ranges in a lot of these contracts we trade are really tight. But for me, it'd be quite frankly stupid to use the physical as the number one driver on my decision making, because I don't only hear it third hand. Sometimes I hear it fifth, sixth, or seventh hand. Sometimes when it's actually currently, you know, come into pricing and I'm at the mercy of it. So,
well, I'm surprised you said that, because my counter was always, you guys count your cargoes, you guys think what you think is going to happen with the physical, and you have your models. I see you react. So as in that you buy, that's the material impact of all your analysis, and I get to see that. So early on it was like, okay, well, Greg, what have you seen? Why are you so concentrated on this week? And what's going on here? What's going on there? Effectively, what they're asking is, what's everyone else doing and why? And they expect you to know because you're doing so much of the trading. So you do have the physical information, and it's not secondhand. That's kind of my take on it.
To some degree, but then also, you know, a lot of these desks that trade dated, as you said, at price starts 70% of the market. So sometimes you don't know if they're hedging their LATAM, they're hedging their WAF, or they're hedging North Sea. So you don't want to place too much emphasis on what everyone else in the market is doing, because it could just be a false signal.
That's very interesting, actually, because there is generally, again, I can only relate it back to my times, but we traded together for a long time as well. And it was like, well, if you are a big player, like at the time it was Glencore, Vitol in particular, Trafigura, actually BP, Shell were a lot more active than they are now, from my understanding, than they are now.
Yeah.
You assumed, or I assumed, that every single one of their trades was because of their view on pricing. But you're absolutely right. The false signals, when it's hedging, it must have been a huge evolution in your strategy. Because I remember when the market moved like from a deep contango structure for years to a deep backwardation, which has been for the last 6 years.
I think all I've really known is backward.
There's a lot of hedging, right? There's hedging coming in from WTI Midland. There's hedging coming in from, obviously, you know, the refinery hedging is typically there. But this whole, like, do you remember when we talked about the amount of volume going through as DFLs? Is actually a good indication that people are hedging ahead of time their Brent spreads, and that's where their risk is. And it took us a while to get a handle on that, because we're like, oh, they're selling DFLs, this must be bearish. There's so much volume going on. And you're like, actually, no, it's got nothing to do with it.
Exactly.
So that's a big
and you have
evolution.
no idea what they're doing, you know, on the screen or in contracts like spreads.
So I guess that's your point. You don't know, so you can't hold too much weight on it.
Yeah, and you learn it the hard way, obviously, like with everything. But and also the importance of, you know, particular refiners or majors, etc. It has also evolved over time. So like you said, Vitol, Glencore, they were big, you know, powerhouses.
In
10
pricing,
years,
whatever.
Yeah, 10 years ago. It's now shifted to the majors because of this TI outlet. So they're in control of like the global ARBs, which has totally changed the framework of the market, to be honest.
There's also the appetite to be in pricing. Like again, like if we could talk about the years, Shell in 2016, when you first started, and certainly a couple of years before that, before you traded, was the guy, right?
Yeah.
Like Huan Dong at Shell, he had a mandate, it seemed, and he traded very differently to the people before him. And he was the first one to explore this Chinese arbitrage for 40s. It didn't exist. It was all about South Koreans before that, and suddenly the Chinese were this big outlet that just impacted everything. And he had a seemingly endless risk appetite.
Yeah,
so,
and
but
he
then
was
that
the first
suddenly
one.
went away.
Exactly, and he was the first one to do it, though. So with anything, you know, I think he deserves the success he got. His first mover, he kind of paved that arb for a lot of people. Made the connections. You know, it's not that easy to put everything into a certain refinery. So, yeah, since then, I mean, I think they got in a bit of trouble as well for.
Did they?
Yeah, I think it was.
No, it's reported, but you can
plastered
report.
all over the news,
So
yeah.
what?
But anyway, since then, you know, Shell have really pulled back on how aggressive they are in trading.
And that's always a different player at any one time. And so when you're basically what we're talking about is profiling flow, profiling trade houses and how they act. But that changes. It's the person, it's the model that they have internally.
Yeah.
And you've got to keep evolving, right? You've seen maybe what, like 3 major evolutions, I would say.
Yeah, but to be frank, like this is the reason why I enjoy trading dated Brent over any other product. I don't think that aspect of profiling exists in any other market.
Yeah. It's not as much of a poker game, is it?
No, exactly. And, you know, a lot of people just, you know, they don't want to show their hand. They want their names quiet. You know, there's a big thing of being front run in our market as well. You know, if you catch wind of a big trade house doing something, it's very easy that, you know, brokers can leak a name and then everyone buys ahead of them and they get nothing done. So it's a big problem for them. Whereas in product markets, it's a bit different. You're doing small clip sizes. The market's a lot more volatile. You've got 50 million curves that you can potentially trade. It's just a whole different landscape.
I think the front running thing is something we should definitely talk about, because it's not a word that people like to hear, and the FCA certainly don't like to hear, but it's what people generally accuse market makers of doing. But let's discuss it a bit, because there's one thing that comes to mind straight away is, the reason why I think people move in herds in dated Brent as opposed to other markets still, as in like it's maybe a bit less in other markets, is because you're trading such prompt contracts, and the anticipation is that you will price it. That's not like other markets. They will put stuff into pricing, but generally speaking, they prefer to be in the deferred months. When you're in the weekly contracts, you have to have an appetite to price it. So if you price something out and let it expire, you don't need to get out of it. So it's this weird thing, like if something big's going to happen on the physical, you want the liquidity to get exposure to it, and you want to let it expire. So it's a fight for liquidity, is what I'm saying.
Yeah, and also.
So the second part of my point was, and if you distort the market like that, and it doesn't function well, and people can't get their liquidity, they won't then do the thing in the pricing.
Exactly. So it's so true. You know, you do that. Let's say you move the price of contract or something, or some structure, 25 cents or 30 cents from this, you know, short-term momentum thing. The economics don't work anymore. They'll turn the ship around. They'll literally turn the ship around.
Yeah.
So this is why actually it's a great market to range trade as well. You know, it's not like the product markets where you can sometimes literally not have enough gasoline or whatever it is, and you know the cracks can go to the moon. For us, it's very well defined, and another reason for that is because now all the crudes are so interchangeable. The refinery industry has just totally changed. It was a very, you know, geographically kind of
structured, defined.
Yeah,
market,
now everywhere is complex, so they
it's
can
been
take any.
Would you agree it's been democratized with the WTI Midland edition?
I think there's been a lot of change in the power has moved from different hands. I don't think it's necessarily democratized, because it just means now that the people that have US contacts or US flow or whatever it is, they can move the market more than before it was just people in North Sea.
I guess where I was coming from was the barrel counting that existed before WTI Midland. So just to explain that quickly for people who don't know, there's a finite number of parcels or cargoes that are due to be loaded every month. People count them up and know who's got whatever, and they say, oh, where have you booked it? And they get their all information. They go, well, the market's going to go up or down. When they added WTI Midland, there was a variable. Suddenly there was all this oil that could come in and set the price, almost making, in some cases, the other grades irrelevant, and no one actually knew when it was going to happen. So what becomes important? The arbitrage economics, which are kind of visible, right? TI Brent, TI Houston versus dated. And basically, it's not as inside information anymore.
No, it's true,
What I'm saying is your best guess on what the future imports of Midland are going to be are actually as good as anyone else's. That's maybe the generic read I've got on it, and that's kind of what I meant by democratized. Before, do you remember, like someone would book some VLCC out of nowhere, and suddenly everyone's buying, and you're like, what the hell happened?
Yeah.
When was the last time that happened?
No, it's true, yeah. I mean, you do still get a bit of it, but it's no way as aggressive.
But you're predicting those these days, because you can say it's gotten to a certain level. I'm very confident when it's like this, someone's going to come out and do a bull play.
Yeah.
I don't think you would have been able to say that before, because you just didn't know. It was very random. It was always based on someone's kind of random appetite or someone's random mandate. It was more random. I'm not trying to put words in your mouth. That's my read on it from the outside.
Yeah, I mean, by literally doubling the amount of cargoes, by default is, exactly, a lot harder to do those kind of big bull plays or bear plays.
Or localized bull plays. You know what I mean? Like in one particular week.
It's true, but now what we've had is actually a huge increase in volatility in the pricing contracts. One day you could be pricing plus 20, the next day minus 20.
Oh, really?
The day after plus 40. We didn't see that before.
Okay.
So yeah, perhaps it is more democratized, but it's actually a bit more dangerous into pricing.
I know. It's funny. These two, they stack off because you've taken increasingly more pricing risk and more of your understanding. So it's either like the market's got more level playing field, or you've just risen in your experience and used it. But either way, it's like, I just can't think of a scenario in 2018 where it would have been like someone's buying next week and I go, get lost, I'm selling that. You'd be crazy to do that, right?
Yeah.
But now you would do that.
No, it's true. Yeah.
That is pretty. I mean, come on, you don't have any physical. That's
yeah.
It's interesting.
No, it's true. Yeah. I mean, sometimes I talk to some trade houses, refiners, etc., and they're always interested.
Oh, who are you fronting for?
Yeah.
What are you
that's
doing?
one exactly. But the reality is, my swing on pricing position is huge. I can be like within plus or minus 1,000 kb, which
at least, right?
At least, no, as in that's residual risk.
Yeah.
If I want to put something on, it might be 2-3 times that, but they're always quite surprised. I think I was talking to Glencore last year, and they went, most weeks you probably have the biggest pricing position on in the market. But it is, to me, sometimes obviously it works in my favor. Sometimes it is just a cost to my business.
Yeah. You factor in the positive expected value of getting it right and wrong sometimes.
Exactly. Yeah. Like I said, it just means...
The price you pay for providing liquidity.
The price, exactly, yeah.
So I think the next part of this is, again, I feel very intertwined with this market is where I started, and certainly when I started, it was definitely the last one to go even slightly screen based, right? Even now, CFDs aren't on the screen. You need to know the players, and it was closed off, right? And you need to know about Brent expiry, and it just felt like there was this thing going on that literally no one knew about, apart from like 5 proper companies, people at companies, and even within those companies, only the people on the North Sea desk knew, and it's kind of still a little bit like that, but it was the people. Now, again, very macho, all that kind of stuff, and we went through that period. Since you've joined, you're definitely the first female to trade, right, as a market maker, and certainly in the volume. I think there's 1 or 2. I think there was someone at Shell back in the day. I think it was just an execution trader. I think there's someone execution trader right now. But come on, we're talking about being in the front and center of the market, how it prices and taking on the market and dictating it. it's never happened that there's a woman. I can say very confidently, and certainly doesn't look like there ever will be. I mean, there's no one else like that. So I guess it's like exploring that a bit. The cliche people want to hear, like, girl power, yeah. It's like, no, as in like, it's impressive, obviously, and people know why it's impressive, because male dominated and a voice market and whatever, and a club mentality. How does a woman deal with that? And let's be honest, when you came in, you were tepid, right? It's not like you weren't some like bolshy female. Like,
no.
You weren't like yeah, and you can get those types of females, and you say, oh, you'll do all right in the oil market, because no, you weren't like that. So let's talk a bit about that transition. So do you think any of that's important, or have you used the femininity to your advantage in some scenarios? Or I don't know, how have you adjusted?
Yeah, I mean, God, going back, when I first started, I mean, the way I used it when I first joined was, you know, even things like you have a different pitch, so you actually can be heard. You know, if you have 10 people...
The pit trading mentality, like the open outcry, you can hear Manny's voice.
Exactly. It's just like it's a different frequency.
Again, I think it's interesting to explain that, because for other markets, it's like, it's just a voice, it's a broker and his voice. In the North Sea window, there's an open outcry with PVM still. They're the main ones. Everyone tunes in for that window, and you just hear mayhem.
Yeah.
And all the brokers are getting orders from their traders, and everyone can hear every other trader. So you're right, if they hear a high-pitched voice, that's definitely Manny. Okay, go on, that's a good one, yeah.
So there was that initially, and then also, you know, you go to these events, people would host for our market specifically, and you'd have 30, 40 men in suits in a room, and I'd be the only female. So it's quite easy to spot me, understand where I'm from, my name, etc. So but, you know, my identity was quick.
Bad parts. You're saying that's a good thing because you've owned it. Some people hate being in the spotlight, right?
No, I also was very uncomfortable. You know, even things like, you know, a lot of the hosting would be in venues that I hadn't been to or I wasn't necessarily comfortable in. Yeah. You know, I think I've got used to being in pubs a bit more, but I'm definitely not a beer drinker. So it's just somewhere that I'm not that comfortable.
What's your go-to drink? I should know really, but gin and tonic.
Probably, yeah. Depends what day it is, but definitely not beer. That's
okay, but don't act like you don't drink, right? I mean,
no,
you definitely
drink,
keep up with the guys drinking. And if you didn't, would that have been an issue, do you think?
No, I don't think so.
Okay.
I think you have to go to these events to put a face to your name. I think it's really good for your own personal brand. So I did do as much of that as I could, and a lot of it, you know, obviously I started under your desk, so you helped introduce me to that world. I wasn't necessarily used to it, but I'm from a big family. I played a lot of sports, so I was comfortable being around a lot of people and like
you didn't get threatened by the aggression and like I'll be honest, like I know I was a very aggressive trader, and I see the open out.
I say boss then, but yeah.
No, I'm very calm and relaxed as a boss. No, so basically when the in the open outcry, I just loved it. I would have loved to be in the pit trading days. You're screaming down the box, like, I want
so
that
I
trade.
would have hated it. I know I would have got trampled all over.
You say that, but like you're now doing that, and I think it was developed. So as you said, you've got a distinctive voice.
But I probably would have not lasted up until now.
Well, what I was going to say was, for me, my strategy was small player, big personalities, big market, meet fire with fire. I'll shout louder than you, but I'm not getting bullied. You want to do something, you know, I'll give it to you. And I was always that way, right? I mean, you didn't apply that strategy, but just as if not more effective, which I was kind of trying to allude to. And this is one of those things that maybe you're not aware you do it, but you remember some of the brokers have said, you know, Greg will just rip me one if I do something and it's getting screamed out, whatever. Manny won't do that, but it's worse.
Yeah.
She's like, she's disappointed in me. And it's like your mum has told you off. And you're playing into these guys like mummy issues. Do you know what I mean? And I think that works like a dream, right?
Yeah, no, it's true. I think when I first started, it was very much like that. Yeah, if, you know, I remember this specific incident when I said, you know, I'm just a bit disappointed. This is how it played out. And I had heard silence back. So yeah, it definitely hit a nerve.
Yeah.
But no, to be honest, you know, a lot of it is...
Let's not act like these aren't important. This is people. This is an OTC industry. And it's aggression and it's people, how a woman handles that. I guess you could say it's the motherly approach in a way.
I guess so.
Not from a caring, but authoritative mother type approach.
Yeah, but it's hard. It's difficult to do that when you're new in a job and you don't really know anything. Mm-hmm. So with time, I've become a lot more confident, and I'm happy to give it back now.
But now you're very authoritative. I would say that's how
but
people see you. Yeah.
It's because
What's your nickname? What's your nickname in the market?
Oh, it's gonna sound ridiculous.
Yeah, you didn't even know what it was the other day.
No, apparently it's the Queen, which
makes sense, right?
Yeah. No,
does that make me the king? Right. That's perfect.
You've been dethroned, actually.
I've been dethroned, yeah. Yeah, more like the Queen Victoria, and I'm like the non-king, yeah. But either way, like that I don't think you didn't do that. That wasn't calculated. That was something you figured out in this kind of market, and it's worked wonders for you. And I think people would find that interesting, but I would caution that doesn't mean it's a good place for women and it's very balanced. And
no, I was going to say, for me, a lot of why I think I personally am successful in this job is because of my background. So yeah, sports, but not just being good at sports, it's being able to compete when there's a lot going on around you. I've come from a big family, as I said. I played a lot of football with, my cousins. I joined a team.
I understand what you're trying to portray, but that you are feminine, though.
I am feminine, but what I mean is, I was competitive enough when I was young that's where you want to be. That's what's more important.
But you're not acting like a man, are you, in a traditional sense? You're acting like a woman, but it's in a what is just a male environment. Nothing you can do about it. But what I'm trying to allude to is a strength of character there, basically. And the great thing about trading is meritocratic. We all know that. You're right or wrong or whatever. You're heard, you're unheard. And so that is just the way it is. So I guess what I'm getting at is, we've talked about how you deal with stress before. You cry, you do things, you are effeminate and all that kind of stuff, but it has no impact on your job. So if you then take that out and you stop that excuse being that's what makes someone good or bad at trading, because I can never do it because it's all male dominated. Well, how about my wife who's 5 foot tall and feminine, and she has no issues. It's a way of thinking.
Yeah.
You don't get sensitive with certain things. You don't, you've never been offended. It's like, I choose to be in this industry and I choose to set my boundaries and play by what I think are the governing rules, and you've had no problem. But there are people who just couldn't handle that because they'd be reading too much into things and they'd want the excuses. And the big thing about trading is the accountability element, right? And you do sometimes struggle with accountability in your work life. I think as a junior, it's obviously gotten better, but you clearly don't have that issue on a macro sense because the trading would just spit you out. You don't lose money and go, it's such a male-dominated industry, right? It's got nothing to do with that in your mind. You never let that come into play.
No, I think...
And people should respect that.
But this is what I mean about being competitive. Yeah. I think to be honest, I'm too stubborn for this to have not worked. And then you get to a point where you've done it for so long and you've become such an expert that, quite frankly, it's stupid to give it up. So I've been trading for 9 years. Arguably, I'm the best trader I've ever been.
Of course, yeah.
And my input is the lowest.
Yeah, which makes sense. Yeah.
Makes sense. So, a lot of the things I've learned over repetition, etc. But I could have stopped at many different points. I didn't have the easiest start. Mm-hmm. Even last year I said I lost a bit of money. I was not in a great place. I kept going, but ultimately I think it's because I'm stubborn. I enjoy succeeding, and I think I got a lot of that from being young, being competitive, and learning what it means to win. So.
But would you agree with me then? Would you say to someone like Anya, a female trader on gasoline, we've got Taros on naphtha, we've got more and more females. I don't think they'd ever even say this, but would you say to another people, don't let the female thing be an excuse? Would you say that?
100%. Okay. I think it's just so irrelevant now. I think maybe 10 years ago it was different, as you were literally the only person there.
You were trading 10 years ago.
Yeah, but as in I had no role models at Onyx, female role models at Onyx. Now, I would hope they have me, they have a lot of other people around them, a lot of other women around them that can help support them. Yeah. But it's true, the first time, I definitely do cry when I get frustrated. The first time I cried in the office, not the last, it was a bit embarrassing. I was like, these men around me aren't used to me behaving this way or anyone behaving this way.
But they are though.
Now they are.
Yeah,
but
I've seen men cry as well.
No, but it's a bit awkward in a working environment, You don't want to show that vulnerability.
Yeah. Well, I don't think you were the type to just cry on the trading floor. You would go away and
No,
cry.
Exactly. But, it was still a lot to understand about myself, and also here, you know, people weren't used to having women around.
I think another thing is, like, just to play on that, I guess we've kind of talked about this a lot, so I'll move on, but just that, you know, how do people express frustration? It's a big thing. You're sitting behind a screen, and any gamer would understand this as well. You know, you smash a control, or you just get angry, right? This is such a frustrating thing to do, screen-based anything, right? Or like high frequency, whatever, high stimulus things. But you don't do that, or do you? I mean, what is your, like, frustrated kind of mode, if you know what I mean?
Yeah, I think it is really important to get rid of that kind of energy surge, cortisol, whatever it is. But yeah, for me, I don't really let it out physically, I would say. Like, even now, like, I wouldn't say that I necessarily am as sensitive anymore. I've done so many reps now, so there's very little
but
I
things get
haven't
you frustrated.
seen. Things
you
get
miss
me
a number or
frustrated.
whatever, so what do you do?
So for example, earlier today, I missed a number on the screen. I went, oh, for God's sake. Okay. And then you move on. Like, for me, there's no, I've never been that outwardly aggressive though, or like needed to hit anything or whatever.
I would ask the brokers if they agree.
Oh yeah, I'm sure a few names have been called, but I do actually pride myself on being able to let go of things very easily as well. So as I said, you know, you get frustrated and you're like, okay, it's done, move on. Otherwise, it's just like this toxin that stays in you.
Oh yeah, big time.
It's a horrible feeling.
So I guess it's a good segue into philosophy of risk, right? Because, you know, what is your thinking? And again, not necessarily set in stone like you always knew it, but having had the experience, and again, you said last year and things like that. Let me ask you this: Would you say that frustration and that stress, where does it really come from? Is it because you don't feel in control? So, for example, have you found that you've been most stressed or most found it hard when you've been out of control of your risk, and you believe in very tight risk management, or are you more of a you need to experiment, you need to kind of, do you know what I'm getting at? What's your philosophy?
Yeah,
there?
I definitely think you need to push your boundaries. And so if I just traded in the same way I did from year 5 to now, I think it'd be pointless. I shouldn't be in this job.
By the way, there
that.
are a lot of traders who do that. What works, they repeat, and they get slowly arbitraged out in some way.
Exactly.
Yeah.
So you will get priced out, especially with, you know, a lot smarter new talent coming in.
And technologies and systems and whatever.
Yeah, exactly. So for me, I mean, the main thing is what really gets me annoyed. It's when my thinking is slower than it should be. So the risks that I put on, that's something different. It's, you know, it's more often than not, it's within my model. As I say, if I've made a bad decision, it still means I've made a decision. I've thought about it. I've weighed up the pros and cons, etc. So I can take it. It's thoughtful, so I don't mind. When I miss deals or do something that I guess the opposite, haven't thought through. Not so much, but it's more when I'm slow. So it just puts you on a back foot.
Mm-hmm. So how do you try and stay sharp
mentally,
then?
but also in your risk? I'm a routine gal, for sure. For me, that's the number one thing. You know, I go to sleep at the same time every night. Usually I wake up at the same time every day, pretty much eat at the same time of day. I have this, you know, rely on my team for certain things. I have this pattern of behavior, which I rely on very heavily.
So if something gets pushed out of whack, does that screw you up?
Yeah, for sure. Sometimes I don't even need to have a drink the night before. If I go to sleep too late, I feel hungover the next day. And so obviously your decision making, your fatigue, all these things fall in, and it will impact your trading.
But, you know, inevitably you can't avoid that all the time. So what do you try and do to stay sharp when you're hungover or something like impacted?
I mean, luckily now a lot of it is subconscious, but to be honest, I probably just lean on my team a lot more. So, I mean,
okay, so you take yourself out of it. You don't want to be in the moment and say, look, you know, throw cold water on you, let's get stuck in, or you want to, look, it's not there.
No, that usually doesn't work for me. Luckily as well, you know, our market is a bit slower, so I don't need to be on the desk all the time every day. I'll tell my desk, this is like generally what I want to do. I trust your execution a bit better than mine at the minute, so happy to do it.
Okay.
But it's not always been like that. I'm very lucky now I have a good team. It's taken me 5-6 years to find a good secondary trader. And
there's so much that goes into that, isn't there?
Yeah, this time 2 years ago, I would have been micromanaging it. So it's definitely a new thing.
And that in turn probably makes you less stressed because you have genuinely good support. So also something because obviously I've overseen your development in particular with the Data Brent desk. And if I go way back to 2019, which is when you really were kind of had to take over the desk, because I was pulling out to be chief executive, it's like you just have to, basically. And you took a while to get into it, right? But do you remember the moment, do you remember the moment that I feel that you suddenly kind of made that step change and then it moved on from there? How do you remember it?
Yeah, I mean, for me, it was, again, I'd made a thoughtful decision to put on a particular risk on a Friday evening, probably not the best time. And over the weekend, we had the Saudi bomb attacks. Saudi oil fields, they got bombed. Of course, my position was short, which was not great in that scenario. But we came in on Sunday night to trade it, and I was really nervous. I remember saying to you, if I have to stop out of these spreads, can you just stand behind me? So I have that kind of comfort of, this is how you're stopping out is
but you didn't, I don't think.
No, I did. So, for me, it was a big deal to put on that short position on that Friday. We came in and we day traded on the Monday. Everyone was in a very similar environment where they just needed to get things done, so they needed to execute. So it's a great market making space for us.
How I remember it is, similar to that, but it was an important moment because you were struggling to put on your view, to be like, this is my conviction and this is what I'm going to do. So you'd finally done it. And then the first time you'd done it with genuinely owning it, you had literally the worst case scenario. Because someone could say, a war is the worst case scenario. It's like, but is it? Because a war is like, modern day wars, it's some kind of attack and you don't know, and it's all about the escalation. It doesn't really necessarily impact the physical. This was the biggest producing country in the world at the time, or close to, with the US. The biggest swing producer, let's say, or owner of OPEC's decision making, had been bombed and 10 million barrels were taken offline. It's like, if you had to think of a scenario like Cushing blows up, it's like, that was pretty much what happened, right? So imagine that psychology. It happens over the weekend. You think, oh God, this is it, whatever. But you were only down a couple $100,000.
Yeah,
right?
I think it was.
Which for us was manageable at the time. And it was like, I remember thinking, like, you've now lived the experience of high conviction, it going as wrong as it could go wrong. And it's not that bad.
Yeah.
The position sizing was okay. Mm-hmm. And I could tell you didn't tell at the time. I could tell you, this is typical. But it was a completely different thing. I was like, from now on, it can't get worse than that. You can't have how much tail of a risk can you get? You were at the tip of the tail, right? So therefore you'd had that calibration. And from then on, you were able to calibrate within that, and the rest was history.
Yeah, no, it's true, exactly. Like, everyone always, a lot of the juniors, etc., they always ask, like, what is the top day that you remember? Typically they expect you to say when you'd made the most money. Yeah. But for me, it's always that day.
Yeah, great. So, okay, what is the trade you're most proud of?
Oh God, that's a hard one.
Is it that one?
It'd have to be, no, I wouldn't say it's that one. It would have to be when I was a junior. So I was
this is a good one.
You. Yeah. So obviously, I mean, for dated, there's sometimes not enough room for multiple people to trade and learn at the same time, etc. So you tasked me with trading Brent futures, essentially, and gave me a 10K drawdown. And I was playing around a list.
It was all about the risk management framework, right? Forming a trade craft, and you embraced that a lot, right?
Yeah, for sure. No, I remember, I think you went away to New York for the weekend or for a couple of days when we were trading. Yeah. And I'd created this risk framework. So I'd put on, I think it was something like June deck or June step deck.
It was sorry, yeah, okay. I thought it was June deck, but go on.
I think it might have been June step deck. I think it was a fly, but it was quite deferred. So it moved quite a lot with flat price. And over this 2 weeks before, I'd slowly scaled in. So I think by this point we had around 500 KB of a fly on. No. I think it was something like this.
The funny thing about that trade was you had 10K to risk. On that trade, you as a contrarian trade, you split it up into 1.5K risk, and you were going to do it 3 or 4 times. That was the plan, and then scale in.
Yeah.
You only risked 1.5 grand, and the trade went in the money. You scaled in, stuck to the plan, you had this big move. You made 150 grand.
Yeah.
Yeah. On 1.5 grand.
I know, it was crazy.
So, and the thing is that when people say, oh, what do you expect me to do with Brent futures? What do you expect? It's like, stick to this process, believe in it, embrace it, try and get stuck in. There you go.
Yeah.
Because if someone, you could have traded that now and make, let's just say it was deck, you risk 100 grand and make 200, and you'd be like, what a trade. What about making, what was it, 150x? You can only do that through clever risk management, right?
No, exactly. And I remember, you know, we were working a lot of weekends, etc. And I would agonize over these trade graphs.
Which is amazing. But why did you do
in.
that and no one else did? Like, on the team, like, this complete refusal to do it. And even now, do you think people do that enough? Do they obsess about the trade craft?
I don't think so, to be honest. I think for me at that point in time, it was the only place I felt I could add value. Yeah. So I kind of had no choice. It is what it felt like. And I've always been quite studious, so I didn't mind putting in the work. It was actually a lot more nerve-wracking to execute and put it on and see how I moved. You know, I remember dreaming about it at some point.
Yeah, well, that's learning.
Yeah.
It's real repetitions. And look, you thank yourself for doing that, because anyone else could have said, you're not training me, you know, like, what's going on in your market, you're not telling me. But you just sat and did what we told, and we discussed every so often. You have to take credit for that. But just a funny anecdote on that. There's other trades you did. Remember, you had this one at minute markers where you would just short it. There was some pattern. Yeah. And you shorted like 2 KB.
Yeah.
And it went so in the money so quickly, you actually panicked that you were making so much money. You were like, so what do I do now? And that was hilarious. So usually it's like you panic because you're losing money. You're like, Greg, I've just made like 5 times the P&L in like 1 minute. I'm like, okay. Anyway, that's a good one. So, all right, what about, so you talk about being studious. Favorite trading book then?
Definitely I don't know if it's necessarily a trading book, but How I Lost $1 Million.
I didn't realize you read that properly.
Yeah, that was when I was really struggling. What I learned losing $1 million.
Yeah.
No, it was the first book that really resonated with me. When I
did not know that.
You did know that. I think you.
Because it was certainly mine. It's my favourite one.
No, it's absolutely my favourite one.
Okay, good. Good for you.
I remember I would read it on the way to work on the tube. And I was reading a few around that time because for me, it was a point of inflection. I think it was after this trade, and then the next trade I found it quite difficult to see my place in how I was going to move forward. It was probably in between the discussions of should you move on or should you not, and I wasn't personally there in terms of conducting in the market, you know, talking to creating this like risk.
You didn't know what your identity was going to be in the market.
Exactly. Yeah. I was just a bit lost for maybe 6 months, I'd say. I was just figuring out what it was that I thought I could bring to the business. So yeah, I sought solace, I guess, in these books, and that one in particular I found really interesting because I've always thought that the majority of trading is 90% psychology. So being able to understand how someone thinks when they're losing money.
So what do you, in a nutshell, what did it say that resonated?
It's always like a comeback story. So he lost the money, yeah, fine. It wasn't necessarily through bad decision making or anything like that.
Well, you said a lot of it was luck, right? And he only realized after the fact that it was luck, and then he started diving into the process and understanding himself, and then came back stronger. Exactly.
So he came back from it, which, I mean, yeah, maybe it's a bit romanticized, but it was the part that I could see in myself as well. I think because I was in a bit of a pit, so I just resonated that if you keep going, you keep trying to develop yourself and how you're trading. A lot of it is synonymous with your own identity, you know. You do something, 10, 12 hours a day, it's going to have your personality in. So yeah, it was a great time for me to find those books, and it's definitely one that stayed with me.
Favorite trading film?
So I quite like margin call, probably because I've seen it most recently, but also I think it gives the reality of trading. Like
of losing money,
the
and being in
depiction
a
of it,
scary scenario.
Yeah, it's a bit dystopian, isn't it? You know, when they all get fired and all these desks are empty and everyone just looks miserable.
Yeah.
So, you know, it's the reality of part of this job. It can be pretty lonely.
It could be over one day, overnight.
Yeah, one bad decision and who knows?
Yeah. Favorite technical indicator?
I don't really like technical indicators, but
maybe not the defined technical, but like how you look at markets.
I mean, I typically use ATR.
You look at volatility a lot.
Yeah, when I'm constructing any trade plan.
What about when you're market making though?
When I'm market making, I try to envisage how the market's stacked. So, exactly. So like the last few days, we've had maybe 50 bids on a particular structure, and the only sellers are market makers and, you know, a couple of people that are getting rid of a bit of risk.
Yeah.
Versus other yeah.
That's the curve and all that. Don't give too much away, but that's cool.
Yeah.
All right. Most important economic. What are you looking for data-wise to be released? Like, what do you pay attention to most consistently?
As in day-to-day, or?
Yeah, as in like, some people would obsess about the production program, like we were saying. Like
I see.
Freight, you know, whatever.
For me, it's all about margins. I love looking at margins.
Yeah, you do. Yeah, that's a big one for you, right?
Yeah.
Okay. What's one word to describe your trading style?
Ooh.
Kind of
what
said
did
it,
Omar
right?
say?
I think he called himself the Don or something like that. No, I think he was kind of like explaining market making, I think.
I would say it's decisive. I don't like getting bullied into trading.
Yeah, okay. If you were to have a trading nickname, what would it be? We know that.
Obviously the Queen.
Nice. Anything else?
I
remember saying to you, like, definitely no brokers, and they would never say anything to your face. But the way you have to talk to them, the way you do talk to them, don't think they're not going to be slagging you off, calling you a bitch, calling you whatever. But it's all about how you. But you're going to be called something bad. What bad thing do you like being called? Would you rather be like, oh, she's a nice person, but completely like weak and wet?
Yeah.
Or like, what a bitch, but like strong, never bully her. And that's obviously more your thing, right?
Yeah, absolutely.
Okay, if you weren't a trader, what would you be?
Probably a portfolio manager.
Well, you had JP Morgan, you were going to do that, right? That was your first thing, asset management.
Asset management. So,
but you gave it up, so obviously not.
Well, because I didn't know really
you wouldn't
that
have
this
gone
is
back
what
to
a trading role was.
But let's say trading didn't work, would you have gone back to asset management?
No, I probably would have tried to find trading in something else.
Okay, let's just say you can't do finance then.
Okay. A doctor. I mean, I was very close to...
But you gave that up as well,
I know,
so you wouldn't have been a doctor.
But if finance is totally ruled out, the only reason I didn't do medicine is because I did finance. So if we weren't able to do that, like now, if I was to, knowing what I know about trading and how my personality is, I think I probably could have gone to be a detective.
What, like crime scene, obviously, and like homicide?
Or maybe a bit more high level, like MI5.
I think you just watch too much TV, that's what you want to do. But yeah, fair enough. Okay, what about a quote that you live by, right? Not necessarily a specific trading quote, because, I mean, you don't say things like Gartman rules every day in your head, right? So as in like, what governs you? Is it that, you know, it could even just be like, keep going or whatever, or like...
I see. For me, I probably don't flap. Like, if you've done something before, the idea of having self-doubt is just pointless. You know, you've made the decision, move on.
Or make a decision.
That's but
good.
The idea of flapping, it's just...
Is there anything, do you think of anyone when you're thinking that, or a quote, or like, does anything work to inspire that?
Not really. So you know where... The thing that keeps telling me to do it is my juniors. Sometimes I see them doing really nervous behavior.
And it gives you strength.
And for me, it feels like they're not in control. So I'm like, don't behave like that. You know, how you conduct yourself is almost as important as your body language.
There is a quote from that, which is, there's nothing like someone's fear to give you strength. Because it's a very leadership-driven thing. So you see people flapping, scared, or whatever, and it's like, right, get into protector mode, right? Like, I need to therefore step up.
Yeah.
And if you're feeling a bit flappy, but they are, you can actually get strength from it. So it's ironic. But
yeah, exactly. So, yeah, there we go.
Cool. What's one sporting event that you would go to that you haven't been to yet? That is so random, but I think I asked Omar that, so yeah.
I've been, to be fair, I'm lucky that I've been to quite a lot, but one that's
Or do you even like sport?
I do like sport, yeah. I prefer to play it than to watch it, but I would quite like to go see the darts. I've heard it's quite fun.
Are you serious?
Yeah.
You like the basketball, I thought. You've done that already.
Oh, sorry, yeah. My dream would be to go see the NBA, like a final or something, courtside.
Right, brokers out there listening, he's keen. Right,
if not, you can take me to Ali Pali.
Yeah, exactly. So what about an event in general, like a bucket list thing? What about, what's on your bucket list?
I mean, the NBA is pretty bucket list, but aside from sporting, I'm becoming a bit more interested in kind of fashion shows, etc. So maybe going to one of the like high-end fashion shows in Paris, probably.
Just going, or?
Yeah, not walking it, Christ.
Well, yeah, like maybe a VIP back end.
Yeah.
All right, finally then, what's one skill every trader should master?
Just one. Discipline. For sure. Every time.
Of yourself, of the
Everything.
process, of everything.
Of everything. Discipline, adhering to your own belief system, your own trading views, your own tradecraft, your schedule, you know, in anything. You have to have discipline.
Okay. We'll leave it there. Thank you.
Hello and welcome to another episode of Macro Mondays. My name's James Brodie. I'm Head of Learning Development here at Flux Institute.
I'm James Todd, Trader Performance Manager here at Onyx Commodities.
And I'm Will Cunliffe, a Research Analyst here at Flux.
Plenty of charts, risks and trends to discuss this week. Firstly, news out over the weekend, again, that Donald Trump is pledging $2,000 stimulus to over 85% of the population. That's certainly supporting gold and equities this morning. We're also close to the end of the government shutdown. It looks like the end of that is nearing. US layoffs are surging. There's bad economic data, and also University of Michigan consumer confidence in the United States is now the second lowest levels ever. Looking at equities, we'll discuss the fact that earnings are growing at the fastest pace in 4 years. That will support, of course, equities. At the same time, last week, Michael Burry started to go aggressively short of particularly Palantir and Nvidia. So we're seeing much more volatility and a more aggressive sell-off last week in the AI stocks. So let's start with the news of Donald Trump announcing a tariff dividend up to $2,000 for up to 85% of Americans. Again, this is going to be inflationary. It's going to be more of a debt burden. It will put the Federal Reserve into more of a quandary. Inflation versus should they be cutting rates? This morning, gold is up 2%. Equities, the Nasdaq's up 1.2%. Yields are up 5 basis points and the dollar is down. As Paul Tudor Jones has said, all roads lead to inflation. And you can see the gold chart here. That's a clear fall from the peak. It's gone sideways and it's ticking up.
Yeah, it's an interesting idea. My question is obviously going to be, what will the pass-through of this $2,000, if it were actually to be enacted and handed out to 85% of the population, what would the pass-through of that be on, US produced manufactured goods, the sort of key areas that Trump is trying to target with the tariffs overall? Ultimately, if you're seeing demand substitution from cheaper imports to more expensive domestic supply, having a $2,000 windfall is probably going to be, in theory, in a purely economic scenario, quite good for that domestic demand. But in reality, I think a lot of people might look at that and think, well, equities keep going up. Maybe I can pass, my $2,000 just into a one-time purchase in, the S&P ETFs and that sort of thing. I think it's no surprise to my mind that we have seen equities up and gold up off the back of that, rather than because of an underlying belief in the US economy. Do you see equities going up more? Well, there are going to be more buyers than sellers for a little bit. And yeah, it's going to be interesting to see whether this $2,000 tariff dividend does actually happen. I was looking at Polymarket this morning, and yeah, over the weekend, the odds of a 2025 tariff dividend jumped from about a 5-6% chance to over 20% chance. It's still quite volatile, but yeah, I don't think there's a clear conclusion that Trump definitely will do this, especially within 2025. So it might be a case of buying the headline rather than buying the actual truth.
Yeah, for sure. I mean, I would probably second that I think it's going to be pretty challenging for him to actually implement it. He says that it will be funded by tariffs. If you look at kind of data from the Treasury, tariffs have yielded about $195 billion worth of tax revenue during the fiscal year 2025. About $30 billion a month now at the kind of the higher tariff levels. But this package would cost in the region of $600 billion. So that's a pretty big shortfall that's going to have to be funded through issuance. And, part of the reason we are in this US government shutdown is because fiscal strategy is not something that the government is able to productively debate. And both sides of the discourse are still remaining gridlock. It looks like they might be able to sort stuff out, but it's still tenuous, and there's still a lot to be worked out on the kind of fiscal side.
And call me a cynic, but last week Donald Trump did particularly badly in the elections, and his ratings are falling. So clearly this is trying to support his ratings somewhat.
Yeah.
And the other point is, it's another example of how he's making it extremely difficult to trade markets because he comes out with these either just Twitter headlines or just false promises.
Yeah, definitely. And I mean, to me, it screams, COVID stimulus, just kind of throw money at a problem. And funnily enough, 2 years down the road, you've got pretty persistent non-transitory inflation that the Fed is going to have to deal with. And
one thing clearly is the winner is gold again. The gold trade is back on, as we can see from the chart. You can see it's clearly breaking higher again. Clear levels to have a stop loss as well, just below 4,000. Again, the market will be jumping on that trade, especially the shorts that were getting extremely nervous by the sell-off. If we move on to US layoffs, the Challenger Gray announcements last week. US-based employees announced 153,000 job cuts in October, the highest for any October since 2003, even including financial crisis and COVID. And there's been over 1 million layoffs announced to date. So although we don't have the official government data coming out for payrolls, you can see that there's clearly weakness in the market. Clearly the Fed will be focusing on this. But again, if there's going to be a stimulus package, that just throws more. What's the word? What do the Fed do? You've got inflation on one side, weaker data on the other. More unknowns, and Donald Trump trying to get them to cut aggressively. Yeah, and I mean, if we look at recent history, Powell's response to that kind of tension in the dual mandate has been to wait and see. So, I mean, I think the market is looking for the Fed to cut. I think at the moment they're pricing as if they want the Fed to cut. And I think this will obviously fuel the fire. I think the market's also having to adapt with the lack of national data, with the lack of data from the BLS. We don't have payrolls that we can look at. Perhaps that's a good thing, given the amount of revisions there have been in recent years. It's woefully inaccurate.
Yeah. That's been a long time criticism of the likes of the ADPs or Challengers, is that they vary massively from the payrolls. But if payrolls are constantly revised, then maybe it's a good thing that the market's shifting its focus. But it's concerning for sure as to where that puts the path of the Fed funds rate. I wouldn't be surprised if we're holding a little bit longer.
Also, if unemployment is going to creep up, this is bad news for Treasury Secretary Bessent, because they're trying to inflate and grow their way out of debt, and clearly this is all bad news.
It's also, I mean, it's why I think it's always good to have multiple sources of data to help you get an accurate picture of how things are. Because I saw another chart similarly saying, job openings are at all-time lows. And whilst job openings at all-time lows, you can sort of think, okay, well, that's not necessarily going to be bullish. To some extent, you can see job openings drop when capacity is full and people are, going at full berth. Whereas with this, you can see that job openings are low and sackings are high. So you've got a clear, you've got A plus B equaling C here. You've got low job openings, you've got high sackings, so you are going to see unemployment pass through. It's not a question of if one, the other. The two combining makes it quite clear what's going on.
And one thing I don't see governments discussing is the impact of AI on jobs. I mean, Bernie Sanders came out and he talked about 100 million job losses over the next 10 years is pretty extreme one way.
Yeah.
But AI will have an impact on jobs for sure.
Definitely. I think that's going to be most pronounced in the likes of the Indian economy. So if you look at service sectors broadly in the West, they've already kind of extradited a lot of those more manual, menial jobs to India and places like that. Now, those are the first jobs I think that are going to be hit by AI. So yeah, if I was India, I'd be looking at that pretty closely.
Yep. If we move on now to US consumer sentiment, it fell to 50.3 in October. You can see from the chart here, that's the second lowest reading ever. Now, Donald Trump, not to pick on him, but he says it's a great economy, and equities are at high levels, which is good for equity holders. That's normally a sign of confidence, but clearly confidence is low here. More bad news for the economy, more bad news for Donald Trump. And the Fed have to look at this.
Yeah, I'm not surprised that consumer confidence is low. Especially considering how chronically online a lot of the US population are, etc. Like, I spend my time on Twitter and X or whatever, and I just see bad headline after bad headline after bad headline. So of course that will get passed through. And as you're seeing more and more unemployment, less security over people's jobs in the future, it's not surprising to me at all that we're seeing consumer confidence falling off a cliff.
A good point on what you say there. Do you think actually social media polarizes views even more? So that's why we have a worse reading now?
Yeah, I'm certain that it does. There are a lot of things that, like we talk about equities, the fundamental landscape of the equities market has changed over the past 30 years because the ease and accessibility of retail to go and sort of buy means that historic facts and figures, whilst they hold some non-zero value, they're not necessarily the best forecaster of future equity prices. Similarly, in terms of public opinion, even if you look back at the 2016 Cambridge Analytica stuff, in a US election, you saw something that had never been done before because of the social media craze. Yep. I think it would be naive to think that hasn't, been exacerbated and continued further over the previous 9 years. So we live in a world where social media really does dictate a lot of people's moods and opinions on a day-to-day basis.
Definitely. And I think, a lot of people are attributing the kind of rally in broader US equities to kind of flow story, right? So retail will just buy and hold. Instead of savings going into sort of, in the UK, we have a cash ISA, people are putting it in their stocks and shares ISA or their 401k, they're allocating to equities. Now that was true during COVID, they did hold, but consumer sentiment, as you can see, was quite a lot higher there. So I wonder if kind of we're reaching those levels now where maybe retail will start to pull out of equities, and that flow might reverse. And as we've discussed before, that's a pretty leveraged position, which if it unwinds could be pretty aggressive.
And that would push consumer confidence lower,
exactly,
along with job losses going.
Yeah, and it becomes a kind of snowball effect,
yep,
almost self-fulfilling.
Okay, let's move on to equities. As we say, I've been fairly bearish talking about equities, and the fact that we looked at retail traders have been adding over the last few months, hedge funds have been going short. But US earnings are growing at the fastest pace in 4 years. That will definitely support stocks. Here you can see data from the FT. But if we go on to the next chart, you can see the NASDAQ here. So the NASDAQ, that would be typically seen, that's a rising wedge pattern. Typically when it breaks, you'd start to get an aggressive sell-off. Short-term moving averages started to roll over, but on Friday we did get a bounce, and we're going to get a bounce today. It's already up 1.2% over this potential added stimulus. But why is to my view, that means what we're seeing more volatility, and again, Michael Burry selling, looking at buying puts, so going short of the big AI stocks. To me, this would see a rotation out of the AI and the tech back into the more Russell 2000 and the S&P stocks. If we go on to AI data center borrowings exploded in September, raising debt and power concerns. Sam Altman came out last week saying he wanted the US government to backstop their over $1 trillion of potential investment, which I don't think the taxpayers can be too excited about. And over the weekend, the CEO of Microsoft says they have thousands of GPUs that are sitting idle because they simply haven't got the power to run them.
Yeah, I mean, Microsoft, I think in one of their, maybe an internal memo that was circulated about data centers, said that, looking at 2028, 2029, it is going to be impossible to overinvest in these data centers, indicating how fundamental they see these data centers in being, to their future business and I suppose the future of the AI world. It seems absolutely crazy. I think I don't see it as sustainable, but I also am not an expert in the field. I mean, it's as pure and simple as that. It's entirely different, and the sheer strain on like a national grid that data centers will be by 2030. You're looking at OpenAI projected to have more power demand than the UK by 2030, which doesn't seem sustainable to me.
And you're already seeing in states with data centers the cost of electricity going up, which is going to be inflationary. But surely now the smart money is to move out of AI and into power generation stocks.
Yeah, I mean, I suppose it's derived demand in that sense. But if you do have, a fundamental buyer perennially, then you're going to be well to be operating in that space.
If we move on, we mentioned Michael Burry, famous for his role in The Big Short. He's actually always looking to short markets. He typically goes in too early, but he announced last week he's gone aggressively into shorting with puts, particularly Palantir and Nvidia. Apparently he's put 80% of his worth of his fund, $1.4 billion, into this. Again, it's not that much risk he's risking because he's in there via options. But we've seen Microsoft fall nearly 11% in the last 8 days, Nvidia fall 12% in 4 days, Palantir falling 16% in 4 days, and Meta falling nearly 19% in 7 days. So these stocks that have had all the huge flows, these big AI stocks, the Magnificent Seven, are now certainly seeing some volatility and struggling.
Yeah, the classic quip about Michael Burry is he's successfully called 17 of the past two recessions. Yes. So, he's a perma bear, and to some extent, the market doesn't always adhere to his positions and go the same way as him. But one of the things to note, especially in the past week, is he does, a trick that I suppose Musk has done a few times. And if you look at the US senators, they seem to always pull this rabbit out of the hat. He goes on Twitter, or he goes on X, and he mentioned something about a bubble just after having put on a massive short position. And a lot of speculators look at that and they look at what he's saying, and so they either take length off or they actively get short. So it becomes a bit of a self-fulfilling prophecy. I think ultimately a lot of the softening in these Mag 7 companies, part of it will just be a knee-jerk reaction to that. So it wouldn't necessarily signal a wider realization in the sort of trading zeitgeist that everything's a bubble and it's overdone. But these are the sort of cracks that do appear every now and then. And yeah, ultimately, because everything is so overextended in equities, when this goes, it will go really fast. And the fact that we've seen, Palantir off 16% in 4 days, that's a sign that we are. I suspect that this will go, and it will be very sudden when it does.
And there's a huge amount of leverage and there's a huge amount of retail, and that would hit consumer confidence even more, which hits retail spending. Yep. It's a knock-on effect. If we actually look at the chart here, Palantir against other S&P stocks, you can see it's recently traded over 240 times forward earnings. You can see where it stands out, forward price to sales ratio and forward price to earnings. It's a clear standout here. Highest valuation for a company of its size, 491 billion in history. And if we move on to the next chart, you can see the actual chart of Palantir. Actually, it's had a sell-off, but you can see where it's come from. It looks to me like the trend is still upwards. Support, you can see the white line. To me, I would say that's the first real line of support, $173. It's holding above that. The next level of support will be $147. To me, that's still an uptrend for now.
Don't disagree. Yeah, I mean, it is, ultimately quite a volatile stock as well, which will mean that if you're looking at having scale in, similar to what we're going to be talking about with Bitcoin here, but if you're someone that missed, 147 before, you're probably going to be putting a buy order in at 147. And similarly, scale back buying at like 120, yada, yada, yada. So you will see scale in buying at these sort of key sticky levels. And as a result, it will face resistance when going down.
Support. I would say also,
as in when the equity is coming off, it's going to face resistance there. So it will sort of bounce off these sticky lower levels.
I would also say below those key levels, you would see some stop losses as well.
Yep.
But I agree, right now it seems to be still an uptrend. Moving on, commercial mortgage-backed security delinquency rate jumps to 11.7%, the highest level in history. It seems to be saying I'm talking about just bad news here. I mean, where's the good news? Where is the good news?
Arsenal top of the Premier League.
Okay.
I mean, this chart is clearly quite concerning. I think people have been concerned about commercial real estate for a while now, so this is not going to be coming as good news. I do think there's an element here that obviously we've been in a kind of higher for longer scenario at the Fed, which has been elevating mortgage rates, and an element of that will kind of increase delinquency. But hopefully we're going to get a cut in December, which should alleviate some concerns. There's also been tightness in broader liquidity markets, so in overnight repos have been drawn on a lot. So that should be alleviated.
Having said that, the cut's 16 basis points price, so it's nearly 50-50. So we have, I think, 9 Fed speakers speaking this week. They haven't got much data to go on, so it'll be interesting to see how that plays out, if the Fed try and steer that.
Yeah.
But fair point, commercial mortgage-backed securities don't have a big impact on the wider economy. Does have an impact on the banks, though. The banks have a lot invested here. So maybe the warning signal will be if bank stocks start to fall, particularly regional banks, where we've seen some stresses already.
Yeah.
Moving on to bonds and interest rates. We just started to discuss it there. This is the US 2-year yield. You can see clearly the lows from COVID. You can see here we have a clear support now at 3.4%. I kept saying I'm expecting this to go lower because of the economic data is appearing weaker, the data we're getting, the layoffs, unemployment going up. But now, if there's going to be more stimulus, you might see the market start to look towards two things. Firstly, inflation, so the Fed are less likely to cut. Secondly, people saying, well, we don't want to be holding bonds if debt's become an issue. They would more move down to the far end of the curve, but yields across the curve are up 5 basis points today. To me, if I had to put a trade on here, I'd sit on my hands and do nothing and wait to see which way it breaks.
I think that's, ultimately a good decision here, because especially at the moment when everything is hypothetical, talking about stimulus, we've seen Trump, chickening out time after time on these things. He will tweet something and then he'll renege on it. So this idea of, well, it might break to the upside if we see stimulus and inflation and see the Fed less likely to cut as a result. We're sort of like dealing in 4 separate orders of conditionals. Yep. So I think you just got to wait and see. And if you're making, if you're putting a trade on, if you were buying this for that logic, you should only be doing that if you have an edge that the rest of the market doesn't sort of really value correctly, i.e. you are certain that there is going to be inflation coming from this stimulus and you have an advantage over the market in that sense. Being in a position like mine, and I assume yours, where we are just sort of observing and aren't particularly close friends with Donald J. Trump, just sit and watch. And
I wish I had some inside information. Unfortunately, we're not that close yet.
No,
not yet.
A trade I do like on that, looking at yields, the US 2s 10s curve. You can see the next chart here. You can see we had the big sell-off. The market was in negative. The 2s 10s was inverted for a long time. We had a double bottom. It's rallied. We're currently at 53 basis points. It's gone sideways range for a long time now. What's that? Nearly over 6 months. The range we're in, the upper range there is 61 basis points. The lower range is, 64 and 41. So this is the curve steepness, the 10-year minus the 2-year. If we start to see more concerns about US debt, and 6 months ago, that was the big story. Yeah. It's gone off, it's gone secondary with weaker data and gold. Mm-hmm. If that comes back, then I expect the curve to steepen because it will be the long end that people don't want to hold.
Definitely. I mean, that's what we saw. That's what we saw last time. Even though the Treasury had front-loaded a lot of the issuance, we still saw that kind of shift of liquidity down to the front of the curve. I think there's going to be a couple of things that would also aid that. If we perceive the Fed to be a little bit softer on inflation, not quite so focused on that 2% target, because at the moment inflation is around 3% and they seem to be happy to cut. If they're perceived to be a little bit softer, then we could see break-evens rally at the back as well. And then if Trump is expected to be more loose fiscally, then that could also boost growth expectations down the back of the curve. But yeah, it seems like we're stuck in a range for now. I had expected this to go steeper earlier, but it seems to be pretty stuck.
Yeah, the other point, there's a long end, but also the front of the curve. Do the Fed, do they or don't they in December? Yeah. Say it's 16 basis points priced. The market's, 50-50.
Yeah.
Pretty much. Moving on to the UK 2-year yield, you can see there's a similar support line coming there at 375. And we don't have any stimulus coming out of the UK. I very much doubt the budget Rachel Reeves will be giving a £2,000 stimulus to everybody. I can hope, but it's not going to happen. We're going to get tax hikes instead. And pay-as-you-go driving charges for electric vehicle drivers and all sorts of others, perhaps even a mansion house tax.
Changes to national insurance, changes to ISA contributions. Yeah, I think a lot of people, it's hard to know exactly what she will do, because she does sometimes almost Trojan horse a softer landing by, the last major budget. It was softer than people had.
There was rumours of huge capital gains tax hikes, and then it came out a little bit softer. Yeah.
Clearly here, they're giving out all the potentials, all the possible bad news. So when we get it, it won't be as bad.
Yeah.
It's not going to be good, though.
I would think it unlikely.
And let's move on to Brent.
Yeah, I mean, you want to take us?
Yeah, so I mean, we've been kind of consolidating, drifting towards that kind of $60 handle over the past week or so.
Sorry to interrupt you. This is just a long-term chart here. This is a 5-year chart.
Yeah, and I think there's a lot kind of driving flat price Brent price action. We've had obviously sanctions drive concerns of like trade rerouting, especially regarding India. Are they going to keep lifting Russian barrels, or are they going to have to go to PG to kind of rotate their feedstock? There's a little bit of a scramble, but that seems to have been dissipated. We saw them offering PG grades back again. So that it doesn't seem like the market's scrambling for barrels right now, especially on the time spreads. We've seen them soften dramatically. So front spread in Brent is now at like 20 cents. And I think the market still seems concerned about oversupply, and everyone still seems concerned about these bearish balances. But then at the same time, we've got like refinery margins are at yearly highs, especially in Asia and Europe. We've got really strong margins. We've had a bit of refinery outage kind of across Europe and Asia. Dangote's RFCC is down and their CDU is down. That won't surprise many people, but that's been constructive in the product cracks. We are yet to see refinery utilization tick up off the back of that, but that should pass through with time. I mean, there's a lot of spare capacity, especially in China. I think Shandong are running at about 55% utilization.
But a lot of refineries are in maintenance as well at the moment, aren't they? So that's a typical seasonal pattern you see where they go offline for this part of the year. And so if a refinery is not purchasing crude, you see less sort of upward support.
Exactly.
To my mind, the major story in crude is just still about, like, yes, oversupply to the downside, but that headline last week about the sanctions on Russian barrels, and particularly the sort of parties purchasing from Litasco, Lukoil, sorry.
Yeah.
And
Rosneft,
Yeah, what amazes me looking at this chart, away from the fundamentals, is just we've been in such a narrow range for 3 years now. We've seen gold surging, we've seen other commodities, copper surging, but this has gone sideways. Tough one to trade. And we had a few of the big trading companies talking about next year's prices, and they're all anticipating it in the 50s, aren't they?
Yeah, I mean, I think the consensus is pretty bearish. I think a lot of that is to do with the kind of anticipation of unwind from OPEC. But I mean, if we look at the most recent set of OSPs, official selling prices from Saudi Aramco, they were pretty firm. Like, market structures had implied a cut of about $1.60 for Arab light into Asia. Instead, we got $1.20. So that's kind of indicative, at least in my mind, that there is still firm demand from Asia. They can still charge a little bit more than structures imply. And that also suggests that they're not just going to release the taps and start pumping more. Because typically, if they were to do that, they'd need to make space in the market by offering a slightly cheaper price. So yeah, it's a confusing one at the moment, I think, for a lot of participants, but yeah.
I like the fact when I mentioned predictions, Toddy, you pull a face. The value of predictions is close to zero, isn't it? Because we have all these predictions where S&P will be at year end they mean absolutely nothing. I don't even know what I'm having for dinner tonight, let alone predicting the future. The only thing that matters at the end of the day is the price. Moving on to currencies, the dollar index, you can see here it's stalled at key level. It looked like the dollar was getting stronger. It was. There was a clear double bottom around 96 level. We can use with a more potential stimulus coming out. And if we look at that on the next chart, the dollar yen, here you can see a clear trend line support, clear resistance. We're up at the top end of resistance. In theory, this should go down if the Fed are cutting, the Bank of Japan are raising rates. But now again, it looks like it's a straight dollar trade. Is it going to go up on inflation or weaker on US data? But clearly, again, a good one to trade. Trend lines like this, there will be stops just above the upper resistance. There will be stops just below support. And to be honest, I'd wait and trade the break. And the last currency, the pound, you can see on the next chart, the pound sold off pretty aggressively the last few weeks. It's broken key support levels. It's come back to retest it. To me, it'll be interesting to see if the short-term trend, the downtrend, continues from here. You can see where the clear resistance is, but the pound's looking weaker than the dollar.
Yeah, and I'm not sure, as and when Rachel Reeves comes out with her budget, I'm not sure we're going to be seeing the pound strengthening at all much there. Wouldn't be surprised if we see that downward trajectory.
Although that being said, I think a lot of the kind of the talk about fiscal restraint and hiking taxes has driven flight to gilts, and gilts have benefited quite a lot from all of this rhetoric. And if we see a kind of a pair back in their pro-tax agenda, we may see a bit of selling in the gilts, which could aid the pound on an interest rate differential basis.
Yep, interesting. Onto Bitcoin. Bitcoin, you can see it's bounced off key support there, right on $100,000. Round numbers tend to be key good support and resistance levels. But it looks to me it's been going sideways literally for the last year, a small up bias. But again, if this closes below 100,000, then that would be pretty bearish, I'd say. Any view here?
Yeah, I think my point earlier in the show just about people scaling in order to reduce volatility. If you're on one of your dealing apps, you will most likely be given the opportunity to, purchase at a level as and when it hits it. So you will just see stickiness around these $100,000 or these sort of quite nice psychological levels. And I think Bitcoin, much like FX, you see so many things on YouTube saying, learn how to trade with me. And, people pay a lot of attention to key levels and also to, the nature of charts ultimately in both FX and crypto. So yeah, I wouldn't be surprised if you do see proper support here.
One chart I didn't put in, actually, I meant to, the correlation between the NASDAQ and the Bitcoin for the last year and a half has been really close. It's broken down though in the last couple of months with NASDAQ going higher, Bitcoin breaking lower. That would concern me actually if I was a crypto long.
Yeah, I think, a lot of the kind of retracement there's been a huge amount of kind of whale wallet liquidations. So we've seen some big players liquidate a lot of their Bitcoin, which has contributed to that aggressive move down. And you can't write off that not happening again. It's one of those, a lot of Bitcoin is concentrated in a few wallets because it's had such an aggressive move up. So there's a lot of Bitcoin to be liquidated still.
Excellent. And on to the LYS, what the market's pricing for central bank movements over the next 12 months. The Fed, we mentioned 16 basis points of cuts priced for the next meeting. Not far off 12.5, 50-50. But there's just over 3 hikes priced over the next year, which is just 10 basis points from the ECB. Again, I think that's a bit lean. But what that has is the base rate in a year's time. The US, it has it at 3.1%, at 1.83 for the ECB. But again, if we get more signs of weak inflation in the ECB, I see them cutting more aggressively, even talk potential deflation next year. And Another standout there, RBA, just 16 points of cuts priced. RBNZ 31. That has the terminal rates in Australia of 3.44%, in New Zealand at 2.19. That would have Aussie rates well over 1% above New Zealand. Historically, New Zealand's always been much higher. But again, they didn't hike rates as quickly. They had a huge housing bubble, and now the housing bubble actually is falling. One of the fastest countries it's falling in is New Zealand. So they are cutting rates particularly hard there. The Bank of Japan, 49 basis points of cuts priced over the next year.
Hikes.
Yep, sorry. That should be supportive of the yen, but of course, with the debt they have, the market's pretty nervous about touching that. Data for the next week, or this week. Coming Tuesday, we have the UK British Retail Consortium's retail sales. We also have UK employment data tomorrow. German ZEW, US ADP we will get, and National Federation of Independent Businesses Small Business Index. Wednesday, German inflation and the OPEC monthly report. Thursday, UK GDP, UK industrial production and Australian employment. On Friday, French inflation, US PPI we should be getting, even if the government is still in shutdown. And we also have 9 Fed speakers this week. Just before we go, just to remind you, we do now have some online training. We have Trading with Discipline, looking at technical analysis, fundamental analysis, and behavioral finance. This week, we also have a training course from gas, trading gas, going live. In the next couple of weeks, we'll have trader psychology from our Formula One psychologist, Chris Gooder. And we also have the first full week of January, the 5th to the 9th, we have internal training for our traders. You can also join that. We have discounts online. Take a look at that. You can also email us for that. We had some internal training last week with new traders, and we had some external clients joining us for that. Do take a look, and we look forward to joining you next week. Thank you very much.
Thank you.
Thank you.
Hi everyone, I'm James Brodie, Head of Learning and Development here at Onyx Capital Group, and I'm delighted to welcome you to this immersive course on commodities and financial markets called Trading with Discipline, where we take a deep look into fundamental analysis, technical analysis, behavioural finance and risk management, all based on our one-day accredited programme with the Singapore Institute of Banking and Finance. Across a series of webinars, we'll explore the fundamentals of global markets, starting with an introduction to commodities and energy trading, before moving into key drivers of market prices through fundamental analysis. We'll also provide a clear overview of bonds, equities, and foreign exchange markets, ensuring you have a strong cross-asset understanding. We'll then dive into technical analysis, including trend following, mean reversion, risk management, and program trading strategies. We'll also examine the increasingly vital role of behavioral finance, helping you understand trader psychology and emotional discipline in real-world trading. The course includes interactive trading simulations powered by Amplify Me, multiple choice review tests throughout, a final end-of-course exam, and a certificate of completion. This program is ideal for anyone looking to develop a deeper understanding of financial markets, sharpen their trading instincts, and build real practical skills for the industry. I look forward to seeing you on the course.
Hi everyone, I'm joined with Vincent from Flux Insights. We're going to discuss the major themes in crude this year, 2025, and some of the things maybe going forward. This is about the narratives, the themes, the positioning, some of the more nuances in Brent Dubai, Dated Brent, and all the rest of it, and just give a general overview, right? So Vincent, take it away.
For sure, let's get started. So talking about the key crude themes this year, you can't go without talking about the overarching narrative, which is OPEC unwinding their voluntary cuts.
Absolutely.
Which that has, the first tranche has been completed in September, and they're beginning their next tranche, the 9-member voluntary cut and the collective group cut that's supposedly ending by the end of 2026. Of course, that is quite, the market has a bearish interpretation, whether that's actually bearish for the physical, that's very much up.
That's what's been up in the air. So I think, yeah, coming into this year, they were actively unwinding on paper. They were calling for it. We're working through this kind of volume triangle, whatever you want to call it. We're about here, right? We're starting to get towards the end of this in theory, right? And we're starting to get to the last 2 million. But really, like as Jorge has been going on about, the officials have been going on about, the data is so spurious. The ideas, the talk of the super glut has been, you know, just banded everywhere. Every trade house, every consultancy is looking at their supply and demand balances and saying, on this, in theory, data, this is what the result is, but we just haven't seen any evidence of that in the physical market, in the benchmark pricing. But then we're into that dichotomy of like how are benchmark contracts priced? They're priced by freely available oil and or traded oil, and of course sanctioned oil can build and build and build and be oversupplied, but not filter its way into the price. So that would be like, just to like lay it like straight away, this will drive hedge fund narratives. This will drive kind of tourist narratives. The market should come off because OPEC is supplying more. But really, I mean, just immediately from a crude trader myself, it's like, okay, I'm only ever going to position, if I really believe in this, and I really believe there's a lot more supply to come back, I'm only ever going to look at Brent Dubai as a proxy for, is it really happening? Brent Dubai has been negative for the majority of the year, certainly weak for the majority of the year, and actually went shockingly low, like -3, -4 levels in the prompt, after they announced the latest cuts. So it really doesn't really add up. But yeah, anything to add on that generically or about the narrative?
No, in terms of the physical market, we haven't really seen that weakness as you mentioned. And
well, the physical market, oil and water, like we could get into that, but it's more the physical pricing of the benchmarks. We haven't really seen it.
Yeah, and for the Saudis, they have a bit of spare capacity, but other producers, they were overproducing initially, so maybe they are maxed out in terms of their production, as well as Saudi, they're sacrificing their revenues for market share, so that's another big theme as well.
Do you think there's enough information out there, Financial Times, Bloomberg, etc., more generic, bigger media, have they reported enough on the fact that this data seems spurious that could filter into more of the touristy hedge fund narrative?
To be fair, Reuters did come out with a headline mentioning that only 75% of the supply hikes have been actually completed out of the stated amount. So a lot of the hikes is just notional, just the numbers only. Hasn't really. Not many countries can actually have the capacity to raise that output. So it's actually more bullish than stated.
Sure. But as you said, that's been the leading theme. Hedge funds have been shorting all year. CTAs have obviously been going with it. We've got Max short there. I'm sure you'll go into all this. And it has worked, largely speaking, right? We got down to almost, I think it was 60.07 on the very low of Brent. Yes. You've got the price, nice.
So this is in early April, and another big catalyst was the Trump's Liberation Day announcements, which also catalyzed a big sell-off too. So confirming prices down into the $60 range.
So going into, this is April. God, it's crazy to think back now it was at that level. But this is the Liberation Day tariffs and the carnage on that day. I know the market was positioned generally bearish as a kind of sentiment, as a kind of a discretionary trade, CTAs, and people holding puts. I think there was quite a lot of interest in holding some of the options, trying to see this like move down throughout the rest of the year. You got really paid aggressively on this move if you were owning puts in particular, because volatility absolutely split out. It's such a big move. Volatility roofed and the price obviously moved down quite aggressively. So these kind of 60 puts did very well for a time. But what was immediately obvious there when the sell-off happened was, when you compare it to other years, you're getting negative refinery margins, negative crude differentials, negative time spreads. And it's kind of flat price has to go because it's just a house of cards. It was kind of the complete reverse. Flat price did move, generated by a big like macro sell-off. The weight of the risk-off money in the hedge fund world and all that really kind of drove this down, it seems. But once we got towards the low 60s, the front Brent spreads just wouldn't move. And it was about 35 cents from memory. And it was there. And it made you think, God, flat price moving like almost $10. And it doesn't want to budge. That is like the North Sea traders are really looking to own that time spread, which means they're really confident in the physical and holding the physical. So actually that became a buy. And then when we leveled out, that time spread went all the way back up to $1 positive. And if you're $1 positive on a time spread, that's just, you can't say anything other than that's a strong market. But that's my anecdotal thing there. Anything to add on the general theme being, bearish throughout the year because of OPEC? But is that really why it went down? I mean, who cares for a trader? But is in like all the signals whilst it went down kind of didn't really signal that we're actually oversupplied?
No, it felt like actually previously it was when Brent was trading between 70 and 80, it was always quite tentative, always felt like something was wanting to pressure prices down. And now then OPEC coming out, Trump's Liberation Day, the cat was out of the bag, gave the macro market really a reason to accept the lower prices when other players most of the market wants to be bullish. They finally accepted this lower narrative. But of course in the physical market wasn't so, didn't really indicate an oversupplied market. So it's more of a reset. Basically. Yeah,
okay. So you'd be forgiven for retail traders, investors, people who aren't oil professionals, we would just look at that and say, OPEC are producing more, oil prices down, is completely logical. But I think our initial review of this is like, it's very much a positioning thing. I'm not really sure it was about anything other than that, because nothing followed through on the physical signals. But why don't we go to the next thing?
The next part, another key thing driving the markets, that was in June, the 12-day war between Israel and Iran.
Of course.
Which those attacks saw Brent spike into the 70s, even up till the high 70s for a few days until Trump came out, until a ceasefire was announced between the two countries, which this was a moment where volatility had really spiked. There were a lot of call options being put on, but as has been a theme over the past couple of years, the market really usually intends to sell into these rallies and geopolitical risk when, as soon as it comes out that, as they realize that the disruptions to exports or supply or infrastructure wouldn't be affected, that there wouldn't be a regional spillover in the war. So that's the main key theme. So market really sells into these rallies.
Yeah, there's a time decay to these things. You know, there's high tensions and all the threat, but the tension can remain high geopolitically, but every day that real oil isn't being disrupted is a day further the market is starting to calling bullshit, basically. And so you have a kind of natural time decay in moves like this. And then you also have a natural time decay in the options that you're owning. That is real value deterioration. But we were very vocal about this. Like you just said, we had the move down to low 60s. The market was comfortable with that because it aligned up with the OPEC narrative. It was seen as the tightness in the front, I guess, was going to be fleeting. You had consultants and banks, etc., talking about their supply and demand models indicating oversupply, just not yet filtering into the benchmark pricing. So that's when this started to filter. Sorry, this is when we started to get that narrative slightly shifting. The kind of feeling of, okay, I know you haven't seen it yet, but you will. And then it was like in Q4 is when you'll see the builds. That's when this narrative started to happen. So you still had quite a bit of short positioning here. So in this rally from 65-ish up to the peak, whatever, just below 80, because the market wanted to be short, let's say, from a discretionary basis, we said it was massively an options rally, wasn't it? It was a very local to call options is where the majority of the market put that trade on, which if you think about it, made a hell of a lot of sense because options are all about insurance, right? So you're insuring against a huge price spike, but you're positioning for it to go down. So you don't think this is going to last, but you don't know. And when people start talking about closing the Straits of Hormuz, well, that's actually a new thing, as in we've talked about it a million times, but the Iran are actually threatening to do it. You've got Polymarket saying, will they close the Straits? And people are betting on it. And there's people in the Straits themselves from ships talking about it. It was genuinely a threat. So if you don't believe that oil prices should be high, but of course you recognize some huge event could be likely and cause price spikes, you're going to buy insurance. So it was a massive scramble to buy call options. It was a massive volatility rally. But when it got to its peak, which was kind of like the Sunday night, really, and you had weekend trading on IG and you had people like really thinking it was going to go on from here. As you said, that's when the market says, do you know what? They didn't close the Straits. They talked about it in government and they said they wanted to close it, but nothing really happened. I think this has reached its peak. I think it's fever pitch. And this is when we got this really aggressive sell-off, which was really a sell-off in volatility if you were looking at the volatility on the options. And then of course the direct price and that was kind of the end of that, right?
Sure. So it just ended very, very abruptly as well. That was when Iran struck one of the US airbase, US military bases in Qatar, and the market treated that as the ending of the war because as in they allowed Iran to do that to escalate to de-escalate, and then afterwards Trump came out saying that both countries had reached a ceasefire, or he forced a ceasefire on them after the next day actually swearing on TV as well, which made both sides get the point. So then abruptly Brent returned to really normal, and then the market just returned to its old narratives.
You're a fan of Trump and his narratives. You always have been. You always comment on it, make jokes, all that kind of stuff. The point is that the new age thinking, particularly for a younger guy like yourself, is to be very in tune with the temperature of the dialogue. You know, but if you go back, say, 10, 20 years, you're getting official narratives from governments and you are really, genuinely believing in what the policy statements are and the conditioned narratives. And it's very, I don't know, in retrospect, very organized. These days, people are tweeting like Trump. There's all these threats from Iran. They're sending videos at night with like pictures of bombs being like, this is it now. My question to you would be, on retrospect, where is the predictability in the chaos? Because like it kind of was, right? Like you're saying, swear on TV, you get these kind of indications and you go, See that? I think that's de-escalation. You're getting a lot of transparency and live visibility into the thinking of these people. Do you see what I'm asking?
Yeah, exactly. Similar to the attack on the airbase as well. It's very similar to last year. There was the Israel and Iran also traded attacks to when Iran returned retaliated against Israel. That was very, very telegraphed. Talked about with intelligence and military, like the US military in advance. So that was when the market interprets this as kind of like a performance. Then it means that both sides have been given an off ramp, and this was the case in the Israel and Iran 12-day war as well. So
is the answer because when I say where is the predictability in what's seeming chaos?
Yes,
is it to recognize that it's a drama?
To recognize this, yes. Well, the official narrative would be to recognize that there wouldn't be any disruption to...
No, recognize that they're all playing games. And if you're comfortable with that, you can start to look for the signals. Whereas someone more, let's say, old school or kind of not, or a bit blind to the game and the agendas, they find it harder, right? They're like, hang on, this is chaos. Like,
yeah, so kind of reading between the lines in that sense.
Yeah. But it's funny because I think particularly the newer generations are finding it very comfortable, in fact, very relatable to see people like Trump, people like even the Iranian generals and these people, the propaganda, they're actually very comfortable with it because it's immediate feedback and you can kind of weigh up the feedback and people's comments, and the interconnectivity we have around the world it's actually incredible. In an event like that, you've got people on the ground saying, yeah, look, we're trying to get out of Iran right now. I'm blocked up. I'm trying to get I've got staff saying, I've got to leave because I've got to try and get my mum to the border and things like that. And you've got information that way, like live. You've then got obviously Twitter, people tweeting like all the time, threatening, we're going to bomb tonight. And then like all this kind of stuff. It's incredible how transparent everything is and playing out in front of you, that someone like me or you just literally sitting in London, like watching from a phone, can get a very like good sense of what's actually going on, and then we can judge it. You see me? I think your generation is very comfortable with that.
Oh, for sure. They also call OSINT, open source intelligence. So, and especially, for example, the Russia-Ukraine war, just to go on a tangent, there's a lot of military footage, and then often these military analysts online, they can interpret these videos from these various Telegram channels and judge based on like how much progress each side is making. So with this is you just really using the power of the internet and like geolocating things and using that to your advantage. And
so again, if we go back retrospectively to this event, I would say with AI, it's not like it wasn't here this year. So you can't say in the future it might be difficult in these scenarios. It's happening right now. Just to add on to your thing, someone might say, okay, well, if you've got all that open source intelligence, that makes you very vulnerable to a very well done AI video to cause a price spike and all that. We actually haven't seen that, have we? We've seen people take every video and go, I don't know about that. And it's actually quite hard to convince people that something's real until they see the hard evidence. That's quite interesting, isn't it? Like, for example, the Qatar thing you just said. We were getting live streamed. People saying, look, those are the Qatar bums. People were sitting in their balconies in Dubai and going, yeah, we're watching. And it's like, people need to see that, don't they? Because of AI, because of recognizing that you can manipulate videos. Is that a fair point?
Yeah, for sure. It's especially with the advent of AI, so many deep fakes can be created, not just of events happening, but also of famous people speaking as well. You really need to verify that. For example, when Trump said at the F-bomb, they were coming out saying that was not AI. He actually said that. So it's very interesting about like verifying information. If people react to supposedly fake news, then that really has an outsized impact on really people's positions, P&Ls.
But I think you said it quite well. The industry or the professionals are looking for this. They love this false peak. We know one particular trade house, but I'm sure a few trade houses were actually short volatility, did very badly on the way up, doubled down here and then made it all back, which is kind of as you'd expect these guys to do. They get caught out fine, but they recognize what's going on. They stay calm and they're ready to sell off when it happens. So this is where you're getting the dangerous area. If you've obviously maybe just a natural long position and you catch a spike or you kind of buying into this, fine. But when you're coming into, a few days of the crisis and you got people like Andrew Tate saying, I'm buying 1 million barrels of oil because of that was more last year actually. But like, that's when you're like, ooh, we're looking peaky here. If Tate's getting long, if people like that are getting long, you're like, it's too in the narrative and not enough has happened for us to believe it can go any further. You're right. That's when the industry's starting to think, okay, what's overpriced here? Because that will be a good risk reward trade. It's scary, but nonetheless. Okay, let's move on from that then.
So onto a bit of positioning, as we've touched on a bit earlier. So onto our Flux Insight CTA model. This is for Brent futures. We've been seeing that recently, particularly recently, CTAs have been close to their max short level. So we can see the rises and falls sort of in line with the price action. So during the 12-day war, there was a brief increase and then position slowly coming off. But what I wanted to touch on is that recently, as there's been more and more talks of the oil glut narrative, Brent potentially collapsing below 60. There's also a bit of technical analysis on that, but we've been seeing the CTAs were close to being max short. So what this means is there's not that much capacity for them to add new short positions.
It also creates a vulnerable market for spikes every time.
Which is what we saw recently in the last couple of days. So.
Exactly. So absolutely bang on. I mean, that's what I would emphasize too. But I think I would just say the theme of 2025 has been a saturation of this information. 2024, this was hot information. This was, everyone wants their data. Everyone kind of wants, from Bridgerton or Flux or whatever to be like, where are people actually going to sell this stuff? Sorry, where are the CTAs going to get their sell signals or buy signals? Because it's all relatively transparent. That's why we have these models. There's pre-programmed, momentum signals and data that they trade off. That's the whole point. It's transparent and methodical, so you know what you're kind of trading into, and it's just strict rules. But the point is that whilst that might have been interesting and people trade around it last year, this year everyone seems to have it, right? And everyone is thinking the same way. And this is where it can get a bit dangerous. When there's positioning information out there, or when things are too transparent, you're going, oh, well, that's at a maximum low, or that's at maximum high. Okay, take the other side, or I'm going to avoid hedging because of this, because of that. And it's like, it really can impact market dynamics. Because if I want to go and you want to go, and we both stand off, the market can't really function as it's meant to function. A massive tangent to that, but the same theme, is shale oil hedging in 2022. And end of 2021. There was a great article from the FT, and one of the shale oil producers was saying, I'm not going to hedge. Every single bank is out there saying oil's going to go to 150. Why the hell would I sell side hedge? And you're thinking, yeah, we're bullish too, or whatever. But no, that's terrible news, because if he doesn't sell, there's no liquidity for the market to orderly go up. So what's happening? That natural huge sell side volume we were getting before is now no longer there. So now everyone's just waiting for a price spike. And then when the price spike happens, people are scrambling to take advantage. Or when it comes back off, people are scrambling to get the things off. So I would say that's starting to happen. And it kind of happens with any new information, like Genscape, when it first came out way before your time. Genscape preempts the EIAs, right? So the stocks. And so everyone's trading off it, making a load of money. But then everyone wants that information. Everyone gets that information. It's leaked out there. Then everyone's trading off that. And you've just changed the trading paradigm. It basically gets absorbed in. I would say 2025 is the year where this has not become obsolete, but everyone knows it. So don't think it's not priced in or not in people's thinking or whatever else. That would be my take.
Yeah, for sure. The democratization of information, right? When everyone is aware of this, then you kind of need to see new strategies, or to kind of think to when this previously had people thinking 2 steps ahead. Now you need to think 3 steps ahead of what's happening.
That's efficiency. Okay, so let's move to the next one.
Right, just a brief rundown on the technical analysis side of things. So as we can see, this is the chart for Brent futures over the past year, and there's been a lot of support at the $60 level, as we talked about extensively. Very psychological.
Very strong floor, right?
Very strong floor. Yeah. Previously, that was the $70 floor last year, but now that's acted as resistance. But last few days, there's been a lot of narratives about the oil glut, potentially prices falling under 60 when a shale gonna be.
And again, the new theme, new narrative. But again, technically, you had that very, very strong support psychologically and technically, I guess. And the blue line is the 200-day moving average?
50. That's a 50-day moving average. And incidentally, that's where we've seen prices sort of see resistance over the past day. So what this means is that a lot of people, and at a time when narratives are driving the market, when There's a lot of algos when there's a lot of volatility. People tend to look into the fundamentals the technicals for their day-to-day trading, and these in the market as liquid as Brent futures, these moving averages, the psychological levels really play a huge role in where people buy and sell. And so looking at the moving averages, it potentially gives a signal onto where prices might see resistance in this case, or in other cases, if prices go down where they might find support. So this is just a snapshot of the latest take on where prices are going right now. But of course, overall,
we're very much at that moving average support line. I think that's incredibly important. And again, if it goes too far, we're going, what market regime are we in here? We've just flipped from a really weakening market, an acceptance that the glut is here because of the oil and water being the highest ever or close to the highest ever. The benchmarks are actually starting to feed that in. It's getting weaker and weaker in dated Brent. We've gone negative in the differentials to literally overnight, bosh. Okay. Now, we had a bit of a short covering rally in dated Brent. We had, that actually seems like that was nothing to do with the sanctions. And then the sanctions came in. We've just flipped to a 2022, beginnings of a 2022 narrative, which is insane to think about, how you can go from almost max bearish to max bullish. And it's real, and I guess we're in that scenario where that's why I brought up earlier. The market, I think, is aware, the wider market is aware that there is this dichotomy of freely available traded oil, and that being a market, and physical oil that's sanctioned, that's on water. The markets had to contend with that forever. I mean, the Iranian sanctions have been around for a long, long, long time. And that was always the case. You have these oil and water tankers that are just there. They're just constantly there. And it doesn't mean it weakens oil prices because they can't affect benchmark prices. So this is like Iran on steroids, right? So I think people are aware of it and they genuinely believe in this. It's psychologically very, very hard to make money here because if you're directionally trading and you've got into this narrative, people love to say traders shouldn't be emotional and they should be clear thinkers. It's complete and utter shit, right? The humans aren't like that. And also it's just not true. When they form stories, they form narratives, that they are obviously going to get invested. So if you're so invested and then suddenly news comes out, you've got a hell of a lot of processing to go through to accept that you're in a genuine bullish market and then go, first of all, stop out, which is a hard thing to do for a lot of people, and I'm going to get long. You can flip long short if it's short term, but when you've been investing for a whole year in a short position and you've almost got to the break and you've maybe started this huge bear run, 30, 40 cents of Brent spreads to suddenly be highly backwardated, I don't think a lot of people made money there. I think the people who were already long in the North Sea, okay, they've done fantastically well, but that's more luck than anything else or insider information. But for the general market, I think this hasn't been a good thing. Now that we've got this like nice support line here, maybe it's a sign that we could steady for a bit. The market could kind of take a breath. And if this is real or people are starting to believe this is long-term real, then maybe they can start investing here and there could be some decent money. But we know, obviously, Trump could go, sanctions over. So anything else in generic technical basis? I mean, has the RSI been useful this year? I mean, what's been useful technically?
I think the most useful thing is psychological levels and the moving averages, especially if prices diverge too far away from these average lines, then there's bigger potential for mean reversion. But in the sense that in the very short term, it's a good guideline for price action or for day-to-day trading in terms of informing when to enter or like position sizing, as well as when to stop out. Because if you want to, a lot of people probably may have placed stops just below 60, but we saw there was clear support at this level, and towards the moving average, we might expect prices to stabilize a bit more. So in a time when the markets are so volatile, chaotic, Trump can come in saying anything, reversing sentiment. Technicals are sort of a little a haven of sorts. Not that it's predictive of price action, but really helps with informing or providing a framework for risk management.
I agree. It's been quite effective because even if you look at this market, CTAs have been short all year. Well, they must have done okay. I'm sure it was very hard here because they were max short around here and then they had to cover. But, they're relatively slow to cover and then they were getting short again. And you have generally performed. It'd be amazing if CTAs haven't net done okay in oil this year. And from technical traders, they've probably done okay, because if you're absolutely agnostic to the physical, you're not getting blindsided by the physical narrative, the gluts. You go, look, it's trending down. There's some quite nice patterns going on here. And I think it's generally been quite useful. It's traded quite faithfully to some of the core principles here. So yeah, all right, let's do the next one.
Next one, we move on to Brent to buy. So touched on this a bit earlier. This is on an M1 basis, just quite volatile, but it's reached all-time lows.
Incredibly volatile. This is just for your sake. You know, I've been trading Brent Dubai for a long time, right? 13 years, and the range is typically 50 cents being very much the low, really, to plus $4 being the generic kind of high. That's been a very solid range, and it's never really going through that range. It's either in a regime of low Brent Dubai or high Brent Dubai, and then you kind of have a regime shift, which takes a while to reprice, and then you stay there for a while. This has been, I mean, these ranges, you're talking about going from $2.50 to $1. So imagine that was 1 to 4. That's a considerable regime shift. But you're doing that from a negative to a small positive. This is like unheard of, right? So it was undeniably volatile, very difficult for the market. And I think the tourist trade, unfortunately for me, because I was always talking in the bull game on this differential, OPEC supply hikes, it was very low. Actually, we can go back here. And then you should expect a long-term rally as the market reprices, because OPEC are back. It's pretty generically generic narrative, but it obviously should hold. What happened? It tubed, and it tubed again. And you say this is the announcement, right? OPEC announced, and then it tubed again. What's happening here? Well, you can say fundamental narratives, you can say physical narratives, and people love to do that. At the end of the day, this unfortunately is what makes trading the prompt very, very difficult, because if you'd held the back end this entire time, it's kind of been exactly what I'm saying, low positive and just kind of stayed there. I think we're max high 1 on the Cal 26 down to what, minus 20 now roughly. But that's not too bad. That's kind of what you'd expect. In the prompt, you have to stay away a lot of the time, unless you're going to be very, very careful on your position sizing, because literally anything can happen. And the narrative was Chinese SPR buying. We've got all the Chinese buying SPRs. Look, it turns out that was bullshit, right? Of course they're buying the SPR, but they always buy for their SPR. It was a pocket of concentrated buying that trade houses were able to use as an excuse to run all the tourists out of the market. All these massive longs that I think people were building up on this generic OPEC narrative, bang, like let's just clear them all out, get them to all stop out, and then into the pricing month, just take everyone unawares. To get to minus $2, it makes no sense, right? There's no justification. This is all about pricing dynamics and the trade house games. And look, what can you say? That's what they can do. That's how the Platts have set up that benchmark. You have to stay out of it. Easier said than done. And I didn't in some scenarios. But I think that at the end of the day, that's the only real message here. If you expect rationality, it's not going to happen. But just to finish off my ramble, I still think this proxy, this Brent Dubai differential, you can get it on Flux. Even if you're listening to this and you're a retail trader, you can still get Flux for free if you have an account and you're trading with us. Even if you aren't going to trade this differential, you should watch it like a hawk. Because if your leading narrative was OPEC this year, then I'm telling you, you can't short flat price, or you can't get mega bearish until Brent Dubai really rallies. Why? Because if OPEC is overproducing, Brent Dubai has to rally, because the Dubai has to reflect the weakness. Well, it has to be stronger than fucking negative, because that is suggesting quite clearly a very tight Dubai market. So if OPEC are going to bring back all this oil, you have to see that Brent Dubai correct for there to be even the suggestion that there could be oversupply in the physical market, and sustainably so, into the pricing. If not, and actually that kind of proved right. I was very surprised we were selling off as much as we were when the Brent Dubai wouldn't rally. So it's all been a bit random, and that's kind of like, I'm glad you brought up this chart, because it's kind of signifies best the year of trading crude. Why is Brent sold off when you haven't really got any logical moves off the back of it on something like Brent Dubai? The CTAs have all been max short, and the physical traders are probably thinking this doesn't make any sense because the market's really tight. I should buy. It's been chaotic. It's not been aligned. It's not been clear. Like in 2014, we had a Brent Dubai rally. We had the physical diff sell off. We had the time spreads go negative. We had all this happen and Brent selling off. It was a very orderly rally on retrospect. It's been nothing like that this year. It's been inverted.
Yeah, very, very much so. It just goes against the logic that you would usually expect.
Basically, yeah. That's what I'm saying.
And to refer to what you were saying earlier about the Brent to buy previously trading very high, this seasonal chart from Flux really illustrates that. So the white is from 2025, and since last year, really, prices have been...
This is only for the last 4 or 5 years, but even so, it's still the case, right? Like 2022, which is the real, obviously, ridiculous moves we had. Look, it's so high, and that's with Russia being taken out of the game, right? How are we this negative? How do you create a fundamental justification for Brent Dubai being this negative? The answer is just positioning, just not to repeat myself, but yeah, that's it.
I mean, yeah, people do find fundamental reasons, but overall it is just the buy market has been super tight. Although the last couple of days we did the increased sanctions on Russia, where you would
this is actually a bit more of a logical sell-off. I agree. Is that what you were going to say?
Yes.
Yeah. So this one we kind of gapped down, didn't we, in the prompt? It made sense because, again, back to this freely available oil versus sanctioned oil. So the freely available oil, if you want to trade the Eastern, you buy, Al Shaheen, you buy Murban, you buy the local grades in the Middle East or the Saudi crude. Now, the Indians in particular were buying all this Russian oil. Now the secondary sanctions have come in that they can't even buy, or they don't want to buy that oil anymore. They have to go and buy Al Shaheen or something like that. And Al Shaheen directly prices Dubai benchmark. So that had to create a bullish impact, and Brent Dubai had to sell off, fundamentally made sense to. And I don't think people were going to stay in the way of it this time. So I think there were stop outs here. And I think there was also a lot of belief that you can't stand in the way of that. So I agree with you. And maybe now it can become a bit more logical now, who knows?
Yeah, sure. So yeah, that's just whole the Brent to buy in a nutshell. So against a bit of logic, but recently, as I said, Russia sanctions, more tightness here.
Yeah.
So that's Brent to buy. Lastly, we'll have a look at the North Sea crude market. So this is just a snapshot of the Dated Brent physical differential, as it goes ups and downs depending on the supply and demand dynamics, the trading, the positioning of the physical guys. Recently, we've seen a big
It's like a
collapse.
CTA graph.
Almost. It's just a bit of a seesaw effect going on. Recently, people...
Let's just quickly explain this for people who don't know, right? This is, again, it's not easy information to get. You can get it from us. But this is the physical differential from a Platts perspective, right? From the PRA perspective. This is what they're using to set the price for dated Brent, which in turn will set the price for all the differentials and then ultimately Brent time spreads. So generically speaking, even if you've got no interest in trading some of the dated Brent contracts we have on Flux, etc., you should still look at it to get an indication of what the physical differential is. And that will link very tightly to the Brent time spreads. And the Brent time spreads in turn will give you a good indication if the market is strong or not. So that's why that's so important. Basically, look at this like a time spread. Yeah, so we've been going from negative 3 times in the year to incredible spikes. Again, this is what's just nuts. It's like Brent Dubai. It's like you would expect in a typical regime, you're either strong and you're kind of 40 cents to $1.20, let's just say. That's a very healthy, strong physical market in my experience in 13 years.
Yep.
Then what will happen is it will reprice and the range will be $1 to 40 cents. And that's how it goes. Just like I was saying with Brent Dubai. And you see all the correlations in the wider market. It might be a bit choppy, but ultimately the market's either strong or weak, basically. This year, we've gone from pretty damn weak. 50 cents. It got down to 50 cents again a couple of times more recently. Okay, genuinely a regime of bearishness.
Yep.
To a flip to unbelievably bullish. It honestly does blow my mind a bit because it just shows you flipping from so bullish to so bearish and flat price kind of nicely trending down didn't really make sense. It just shows the chaos again. We're kind of repeating ourselves, but that's what I get from this graph. What else would you say?
Yeah, it's just lots of ebbing and flowing. It's just more recently in the last 2 months as talks of the oil glut, the increased supply narrative comes back online. As our viewers might recall, for October, November, Brent futures expired. Vitol took on a lot of barrels, and then also, so in recent weeks, the physical was quite supported up to $1, and you had headlines coming out from Bloomberg saying, it kind of almost goes against the narrative of a supply glut. But then the physical differentials came off into the last 2 weeks as as the market became a bit more oversupplied, cargoes were struggling to clear. And but then all of a sudden recently, we still need to update this, but the physical has been rallying again. It might be a bit of a short covering.
It's on its way up, and you can get an indication from the CFDs, Data Brent CFDs, not to be mistaken with retail CFDs. This is the CFDs and Data Brent, and they're interesting to track because you can get a forward indication of what the physical differential is going to be, or at least the market's interpretation of what the physical differential is going to be. And that is looking strong. That's looking like it's going to bounce back up, which does make logical sense. But I massively agree with you. The supply gut story has always been here. It was concentrating in the last few weeks. And one of the major reasons was this sell-off here. This sell-off in physical differentials, one down to negative, was the more classic repricing you would expect. And I was really genuinely expecting, right, here we go. This goes down negative. Every time spread in Brent is not deeply backwardated, deeply contango, but meaningfully contango, minus 10, 15 cents, 20 cents a spread. And there was only one spread, or maybe Jan Feb as well, slightly. Two spreads to go. And it's over. It's a contango market. We're in a regime. That is what you'd expect. And it did look like Brent Dubai it kind of started to make sense. Brent selling off, Brent Dubai picking up, physical differential selling off, and then bang. Yeah. For fuck's sake. That's why I say I struggle to believe that people made a lot of money on this, because you are looking to trade this repricing and it's all making logical sense. Then you get a black swan event. So you pick up again. The question's going to be, in everyone's mind, do you get long? So to your point, Vitol buying a hell of a lot of cargoes expiry, other trade houses owning oil here, they've gotten super lucky, right? They're gonna do very well. Fine, that's the way the game goes. But having said that, once it prices and you've made your money, are you going to get long again? Are you going to genuinely take on the physical again and expect this market when you know how vulnerable it is to a sell-off? And all you need is to Trump to tweet at 12 p.m. or 12 a.m., whatever, and say, I've agreed to remove sanctions. All that oil and water, like I said, Iran on steroids. Whenever it would be announced back in the day that Iran sanctions were going to be relieved, you knew all that oil was going to go find homes. It was unequivocally a bearish event. It's that so much more. We've got so much oil and water. If you remove the sanctions or a peace deal is made, I mean, it's like 1 billion barrels. I don't see how oil doesn't go negative again, or at least threaten to in a short period of time whilst the market reprices and clears this oil. You might not see oil negative in the benchmark prices, but you will for sure see a lot of people struggling to get rid of the oil and paying people ultimately to get it cleared so we can start again. So honestly, I wouldn't put it past the market to price incredibly strongly in the next few weeks, rest of the year, but then also be vulnerable to an incredible price dump. So I mean, buy volatility, I guess, is the only thing left to really say on that side of things.
Yeah, for sure. Buying volatility and the post-sanctions trade, there's going to be a lot of adjustments being made. That's for sure.
Yeah, and you know what? Even as we're saying this, it's a Friday. What's the date? Whatever we are. We're launching next week. This will be online and part of Flux News. Man, think how much could have changed in the next 3 days. So look, just so the audience knows, we were on a Friday, just only a day after the sanctions were announced, or a couple of days after. So we don't know, but it could literally be the weakest market ever or the strongest market ever next week, which is nuts. But yeah,
for sure. Another really important, some interesting, a bit more niche chart I want to bring your attention to is looking at the actual physical differential versus how the Data Brent, how the forward curve was priced a week prior to expiry. So that's for the weeks.
This is Data Brent implied. You're looking at the CFD curve, right?
Yeah.
CFD curve, the market anticipation of Data Brent versus actual. This is a great graph. Yeah, thanks. Sorry, just wanted to make that clear. Go on.
Yeah, so on the left side, that's what was implied on the CFDs, and that's blue bars, and the orange bars was the actual physical differential, how the actual market was priced. And over the period of summer, there was a period where refinery margins were super, super strong off the back of stronger distillate cracks, gas oil cracks. And so the narrative was that triggered a lot of refinery buying, especially in July and August. So hedging the cargoes on paper. So the paper implied was really high, but when it came to the actual physical pricing,
but when is the snapshot? So is it like 3 weeks forward?
1 week forwards.
1 week forward, but you could even go 3 weeks forward. That would be very interesting as well, because 3 weeks forward, and if you go to like 13, 17 week in October, people were pricing that at plus $1. It priced minus 50. So that's when, again, that's another signal to be like, bosh, the market's cracked.
Oh yeah.
So
sure.
yeah, but your point is what? That it just struggled to actually reach the heights.
Yeah, for sure. So during a full period between July until September, it's if I have the numbers right, the actual physical was weaker than implied for 14 weeks in a row. So in theory, if you were to short the 1 week roll into pricing, every single week would have made money for 3 months straight.
That's a very nice physical signal. Sorry, a bearish signal. I'd be looking at it's really struggling to keep up here. And it just re-emphasizes the same thing we're saying, but there's great analysis. Like, I think it's a shame you don't have that week, because I could show you that. But other than that, like, you need to get this out more in the reports. Like, people should be clambering over you for this information. It's not easy to obtain, but you'll supply it, won't you, Vincent?
Oh, for sure.
For a cost.
For sure. So lastly, refinery margins looking forward. Of course, it's closely linked to how the demand dynamics in the data Brent market, and margins have been creeping higher since the start of the year. This is the M1, and gasoline cracks, diesel cracks have all been really, really supported. So, and in line with this, we've seen physical strengthening off the back of the sanctions news, and margins are pretty strong as well. So this makes, at least from my perspective, a bit more bullish going into the winter time, especially refiners coming back out of maintenance. There's going to be a bit of demand coming online, as well as the fact that if margins are in a high environment, then some refiners may be looking to defer their maintenance schedules come spring. So there's very much a bullish thesis for data going forward if you come.
Well, and as you saw on your previous slide, like you said, the refiners are buying those CFDs to hedge this kind of thing. And you get the indications, it's got real paper impact on the dated, which then impacts the Brent spread. So don't think that that's irrelevant. Like, that's super important. I agree with you. I just wanted to add, going into the year, reasonable margins. This spike, the market's been pricing on a refinery margin basis as if the market has, or the world has, a lack of refinery capacity. And to some extent, that's probably true because of Russia being bombed, maybe that kind of thing. And China probably not running their refiners anywhere near what they're capable of doing, like more like 50%. So it kind of makes sense, but it's also pretty crazy. And I agree with you. It's hard. It's a very bullish signal to have such strong margins. And for them to be up in this is European, remember, not Asia with the sophistication. This is European crappy refiners making a hell of a lot of money. They've all been wanting to sell their refiners for like the last 10 years, but you've held on to them. You would have made money, quite a bit of money. And I think when it's as high as $9, it's so hard to look at that and say, are we actually in a bearish market? And then, but to challenge that a little bit, we were selling off. This sell-off, the latest sell-off from 950 down to close to 7 was happening with the physical diffs coming off. Just to repeat myself, everything was coming in as you'd expect. And the problem with margins is if the demand is relatively healthy, but you've got an oversupply story, then you can justify having low crude prices and high margins because the products just are a bit more sticky, but the crude is getting, so it kind of makes sense. So you justify to yourself, it's okay. It makes sense that margins are high because crude's weak. But the problem is, can you really get a proper sell-off if their demand is still kind of sticky? And we've seen a considerable amount of consumer hedging at every point at every major sell-off. The tariffs, that sell-off we talked about earlier. Do you remember we were talking about this podcast earlier on in the year? Like insane amount of consumer buying from fuel oil. Then we got to recently with the sell-off when we got close to the 60 figure, the most ever jet fuel consumer buying, people are saying, from a hedging basis, like really, really concentrated buying, like quite unusually so. And that does have a bullish impact on the margins and the overall flat price. So what I'm saying is a real sell-off, if you like, will be completely undeniable on a margin basis and on a flat price basis if there is a demand shock. So that's maybe been the problem, if you like, for the market to not really follow through on this bearish move. I think we've got to see the recession that people are talking about. Yeah, UBS was saying it's like a 93% chance of recession now in the US. Okay, well, if that's the case, then you will get demand destruction and you will see these margins weaken. And once these margins are down into negative territory, it's going to be the complete flip. There's going to be a lot of reasons to sell off and to not hold up, but we're nowhere near that right now.
Yeah, for sure. So very much an oversupply story. That's the narrative of the past year. So demand has been keeping up, but there's just been more supply coming online.
Yeah, but like you say, like when you have shocks and you have maintenance being over and you've got refiners for reasons to buy the paper, it's hard for there not to be a big bullish impact. And then when you have CTAs max short and the market's so short, it creates vulnerability to these market roofers that we've periodically seen. And that's, I mean, I think we've done hopefully a relatively good job there over the course of this podcast to really emphasize when people say it's been a difficult market, this is why. Because you get it a lot. You know, it's been volatile. Surely it's been easy to make money trading. And the CEOs of Gunvor and Vitol and stuff were asked this as well. Like, how's the market been? They say it's just been very difficult. And people generically don't understand what that means. This is why you get this bullish signal versus this bearish signal. You've got oil and water versus very tight free markets. You've got all these things going on. You need kind of, yes, volatility, but volatility around kind of correlated indicators that over time can create a regime shift or a repricing. That's what the market was looking for. It didn't get it. So you're getting winged and wanged everywhere, and it's very difficult.
Yeah, I suppose like the difficult kind of volatility, especially with the US administration comments and stuff as well.
Yeah,
usual
100%.
Yeah, all these changes.
Yeah. Cool. So should we finish maybe just quickly? You know, as I said, we are doing this podcast only very recently after the sanctions have been announced, the latest sanctions, and a lot could change. But going into next week, should we put some predictions in place? What do we think is going to happen? How do we think things are going to pan out?
Yeah.
Go on then. So we've got the CTAs probably still need a lot to buy back. There's a lot of capacity for them to buy back. We've got refining margins, very strong. We've got the Russian refiners still getting bombed. We've got a lot of bullish reasons, and we've got a big paper unwind from the market being so bearish for so long. The longer these sanctions maintain, the longer the market believes in them, the more time the market has to flip their positioning materially long. So I think it's obviously contingent on that, but I think we can easily go back up to the 70s here, and it could be a very decent bull run. Brent spreads, basically a full bull narrative. That would be my prediction if things are going to stay as they are.
I think so, yeah. But to speak of what might happen on the opposite end, if Putin comes to the table quickly and US have mentioned publicly that potentially sanctions relief for freezing the front line, all of that as negotiating tools. So if that comes out, these headlines come out, then we could also see a rapid unwind as well. So as to we need to look at, like, the traders need to set stop out levels very cautiously.
I think so, and I think momentum trading could work. But remember, when you get bullish and you get volatile, it's tough.
Yeah,
you get chopped in and out of trades. My take would be trading from the long side, but the higher we go, start to pick up cheap put options. Because there's no, it's like a COVID event, right? If imagine being told COVID could happen. You're like, okay, I'm going to buy some fucking $20 puts, because if it does happen, it's going to really aggressively get there. I think the market is signaling that to us. It's saying, right, trading for the long side. But if Putin makes a deal with Trump and like it's happened overnight, then you really can, with all that oil and water, go from 75, 80, I don't know how high we're going to get, 85. You can genuinely go down to $30 with how much we've got, and how much positioning and how much carnage can happen all at once. So the only trade there is long volatility. So you have to own an option, you have to own an out the money put, and you have to, obviously, when that happens, price in the volatility roofer, maybe at that point, take it off and have a short position, whatever. The point is that could very easily happen. That might become a crowded trade, but basically long outright, the higher we get, the more you're buying out the money puts, will be my thing. And you could do the same with time splits. You can buy CSOs on Brent spread puts. You can say, you know, as we get to $1, $2 backwardated on Brent, if that's going to happen, you can start to look at the deferred curve that's been dragged up and start to buy, you know, minus 60 or minus 40 put options on the spreads. That would be my take. I wouldn't do it in Gasol, because Gasol's still got that Russia situation. It's still got all that consumer buying, clearly there's still demand. But at the same time, if there's a macro sell-off and there is a recession that comes in and all this gold unwind and everything, that kind of stuff, then yeah, you could get washouts everywhere. But that would be my take. Anything else to add?
Yeah, I think with these hypothetical trades, one would be covered on both sides for sure. So you can, like, on the rally, flat price, right? And then if things go the opposite side, then the puts will have you covered.
Yeah, I'm not trying to say buy when the market goes up and sell when it goes down.
No,
I think the market will go up as it is right now.
Yeah.
But because of the shock decision, the best way to trade a shock decision is to have a put option. And actually, if you had them in the tariffs, like I was saying, you got paid very quickly in 2 days, and then you're out of it and you start again. That if you're not in it, you'll lose it. You know what I mean? There won't be time to sell on the way down. It will be too aggressive. So you're going to need that insurance. Great, Vincent. Thanks very much. That was very thorough, and thanks again, viewers out there. See you again soon.
Hello, welcome. This is the first and the only magazine show with the latest news and information from the UK energy scene. Oil or diesel, wind or solar. It's all here in the next 30 minutes. Welcome to the UK Energy Show. So, this week we're talking about COP. COP30 got underway in Brazil with a clarion call from the hosts. We need roadmaps, they say, which will enable humankind in a fair and planned manner to overcome its dependence on fossil fuels, halt and reverse deforestation, and mobilize resources to achieve those goals. We'll discuss what's been discussed in Brazil so far. Also this week, diesel prices are on the rise again, particularly at the pump in your town. Why should that be when the world has a glut of crude oil? And never mind the future, wind power has already saved the UK over £100 billion. We hear from a former market trader turned academic. That's all a bit later on. Joining me to discuss this week's events, Julian Keats from the Flux markets. Julian, welcome to you. Let's get into some of the news of the week, shall we? COP30. Now, COP30 is the United Nations Climate Change Conference. It takes place in Brazil from the 10th to the 21st of November this year. These climate change conferences take place every year. They're the world's only multilateral decision-making forum on climate change that brings together almost every country on Earth.
And it's great to have the head of state so committed with this COP. And I believe this was a really wonderful opening session. Then I have to thank here in front of all of you, all the delegations for the fantastic agreement that they reached regarding the agenda yesterday night, late at night. And this agreement is, I believe, going not only to allow us to start working today already very intensively, but it will also allow us to explain to the world why these additional issues that had been raised really matter.
That's a clip from the opening press conference. So, Julian, let's talk about COP. Let's go back.
Yeah.
What are they all about?
Yeah, I think that's a really important place to start. So just think, COP30, as it's often referred to, COP29 last year, it's the 30th annual United Nations Climate Change Conference, and it's taking place, as you said, it started on Monday and it runs all the way through to the 21st of November, so roughly 2 weeks. And it typically, right at the end, it doesn't always end on the date that they think it's going to end, because there's a bit of wrangling and gerrymandering and deciding actually what's going to be achieved and announced. So on and around the 21st of this month, and as you say, Belém, which of course is the gateway to the Amazon. So this year, hosted in Brazil, and I'm sure they've chosen that site for a specific reason, deforestation, so on and so forth. So this global summit brings together nearly 195 countries, the world's countries together. Okay, collectively, they're going to negotiate and advance climate action, aiming to limit global warming and adapt to climate impacts, whatever might be happening. And of course, this just in the last few weeks, we've had Jamaica, the hurricane there, the strongest hurricane ever landing in the Atlantic basin. Okay, so again, you know, climate activists would say that's absolutely down to climate change. The Conference of Parties, COP, Conference of Parties, is the main decision-making body, okay, for the UN framework of Convention on Climate Change, UNFCCC, which was established back in 1992. So it's been running for a long, long time, and they created a global framework to address climate change and impacts. So COP30 builds on 30 years of climate negotiations, including landmark agreements like the 1997 Kyoto Protocol, which had some real issues in being able to allow countries to agree, because it was a more draconian approach. You will do this. So actually, the Paris Agreement that's often referred to, 2015, COP 21, I think it was, that decided that actually we would lead this on an individual country basis, NDCs, and allow countries to decide what they're going to do, and actually celebrate the UK. The UK really embraced that, in actual fact, and has led the charge. I believe. Okay, so that's a really positive thing for the UK. We should congratulate ourselves about that. And what's this all about, the Paris Agreement specifically? It's about limiting, and you can see on the screen here, limiting climate change from pre-industrial levels. That's 1850 to 1900. Climate change annual temperature changes to 1.5 degrees to 2 degrees, somewhere between that range. And as you can see on the chart here, and we'll play it over the course as we're discussing COP30 here, at the moment, we really are threatening 1.5 to 2 degrees. And this is, the limit is due, that maximum limit is due by 2030. We want to limit climate change below 2 degrees come 2030.
But that ambition, which was set, as you said, and reiterated many times, looks like it's going to miss the target. As a globe, we're going to miss the target.
Yeah, some people say, because it's a 10-year average, so we're not 10 years beyond, of course. Yeah. So, you know, and climate change, we have spikes and in terms of temperature and reductions as well, as predicted by climate change scientists. So we're not really there to say, you know, undeniably we have breached it, but it does look like last year was the warmest year on record. So what are we going to do about it? That's the key thing, really.
Yeah. What are you hearing from your colleagues and in the market generally about the Americans not being there? I mean, we know Donald Trump is a climate, if not a denier. He's not a fan of climate change. Absolutely. He doesn't really believe in it. He's not sending a delegation. Does that really matter?
Yeah, I think it does send a signal to people that are in that camp. And, you know, I can understand why we've really benefited, and we'll hear from Colm O'Shea later, right? We've really benefited from what I call low rent energy. Very relatively cheap energy, right? And the reality is that that should we want to reduce our emissions, we need to build different infrastructure, and that has a cost to it, of course. So with Donald Trump not being there, actually the US Senator for California, Gary Newsom, is at Berlin.
And he's very concerned.
And he's very concerned, of course. Yeah. And of course, he's making a political statement, of course, by doing this. And I personally believe we're in a transition, right? So we need to think about both. We need to be sensible with our policy, and we'll hear this from Colm O'Shea as well. We need to be really sensible how we enact and transition, because policy, as we're going to see, as we discussed today, really does impact the price. And this is all about, this show's about affordability. So we really want to do things in a sensible way, because actually, when we see that spiral on the screen just now, it's really intangible, isn't it? Okay, if I was in Jamaica, it wouldn't be intangible.
We can acknowledge it. It's knowing what to do about
it,
isn't it? Okay.
Yes.
Let me bring you right to our second talking point this week, which is here in the UK, as we record this show, we're still 2 weeks out from our budget.
Yeah.
But I've never known a budget with more speculation about what a chancellor will or will not do. What's the buzz around energy and what it's going to cost you and me as consumers? Are you hearing anything?
Yeah, absolutely. And we've got on screen here the FT's response or prediction that Rachel Reeves is going to very seriously look at bringing energy bills down. And again, I think it's very important. Energy bills at the moment, the tariff, the price cap for energy bills is around about £1,700 per annum for electricity and heating for a standard 3-bedroom house in this country. That is almost double what it was 15, 20 years ago. That really is important. It's politically important. It's important for individuals. It's unaffordable. So,
and a portion of that is tax, right? Which is her thing. So she does have a lever she can pull. Make it worse, make it better.
Yep, absolutely.
By a measure.
Absolutely. And I think...
What's your sense, Julian? Is she going to do it or not?
I think she will cut back VAT, because Labour's big mandate is to run the renewables, because long term it should be cheaper, but in the near term we've seen costs come in to the bill. So VAT, I think, will be reduced. And I think green levies will be reduced. And if we think about VAT on that £1,700, that's about £90 a year, right? So that's not insignificant. And then the green levies are around about £170 a year. So those two things combined, if she was to reduce them completely, and we are speculating here, that's £250. So we bring that price cap down effectively to £1,500 a year. So it's a substantial decrease, but it's not back to where we were 15 years ago.
Okay. Let's talk about diesel prices, shall we? Because right now, diesel prices are going higher at the pumps. I don't know if you've noticed, because they creep up, don't they, by a penny or two a week. Why is that going on? I thought there's lots of crude lying around the world.
Right, yeah, that's a really good question. So actually, as part of answering your question, let me just draw watchers, listeners to the slide we've got on the screen here. This is freely available on our website, and you can track your diesel prices and gasoline prices here in the UK at the pump price. And prices last week, the average price was £1.43 at the pump. On average, varies depending which pump you're going to, where you are in the United Kingdom, but on average, £1.43. At the moment, spot markets are around about £1.48 equivalent right now. And that price rise has been driven by a couple of things, I think. And it's always difficult to be absolutely definitive, but I think we're coming into winter. Winter is predicted to be very cold in the Northern Hemisphere this year.
To blame the meteorologists for that.
Yeah, we're going to blame the meteorologists for that. And you might also say, well, hang on a moment, you're just talking about global warming. Cold. But actually, global warming predicts that we'll have extreme changes as well as a trend upwards. Okay, so we're predicted to have a very cold winter this year. Who knows whether it will do, but that's had an impact to diesel prices, heating oil prices, because they're kind of very similar products. And the other key thing that we talked about last week and the week before, was the sanctions from the United States on Lukoil and Russian. And I think Greg was mentioning that's could be huge. And we're really seeing an impact on the cost of taking crude, refining that into diesel. And Lukoil has refineries in Eastern Europe, and those refineries currently aren't really selling anything. So you're finding that impact come through on diesel, and that's impacting on our diesel price here in the United Kingdom.
So the lever that's working there is the Trump sanctions, is it? It's affecting Lukoil, and that's affecting everyone.
And ostensibly they are impacting, if they are affecting this price, and it's a part of the price. I haven't said how much it is, I don't know. But it absolutely
These things have a ripple effect, don't
ripple effect
around the globe.
And what we want to add in, and Greg was saying two weeks ago, if these sanctions are really policed throughout the supply chain, and they're difficult to police that way, let's just balance that argument out. But if they are really effective, and history says they're not, right? But if they are really effective, we would start to see crude prices as well as diesel prices really escalate in value, possibly towards the $80, $90 a barrel mark. Now, I'm not saying that's going to happen. That's if policing really happens. History says they are not policed that closely.
This is the UK Energy Show, brought to you by Flux, the news, information and trading platform for world energy markets from Onyx Capital Group. Now next, wind power has saved the UK energy consumer billions of pounds over the last decade or so by reducing the cost of energy we use by over £100 billion. That is a bold claim in a new piece of research which has been co-authored by a former market trader and businessman, Colm O'Shea. Colm has recently concluded a master's degree looking at the impact of the UK's nascent wind power industry, and that's had on the price of fossil fuels, in particular, the price of gas. Now, his work is presently being peer-reviewed. It does make some surprising discoveries around the ROI of existing infrastructure. So I called up Colm and asked him if he thought the financial markets had this benefit factored in.
Financial markets like electricity markets, oil markets, gas markets, they're pretty smart. I mean, those are the kind of things I use to trade, and those kind of things work things out. Where you're talking about markets, meaning, is it good to invest in a wind company that builds turbines? That's a different kind of problem, because the big problem that I'd say the renewables sector faces is that there's a massive benefit to the renewables industry that doesn't go to the people who own renewables companies. It's like the opposite of tobacco. Like tobacco companies make loads of money, and unfortunately, other people get cancer, and other people pay for those healthcare costs. Wind's like that in reverse. Is the wind companies aren't making huge profits, but what they do is they stop us, prevent us paying much more than we need to in buying imported gas.
That rather turns the argument of people being against wind or against renewables, or believing that renewables are expensive and something is going to be a long way out of reach. It rather turns that argument on its head, doesn't it?
It does, but that's why I wanted to find out the answer, because I found these debates really frustrating to listen to, because what you'd have is a skeptical person talking about money, and then a person in favour generally talking about climate change. And I thought, those arguments don't reconcile. They're not talking about the same thing at all. If someone says, I think wind is really expensive, someone else should say, I agree, or I don't, and here's why. So I wanted to find that answer. And the answer I came up with, it means that it doesn't matter if you don't believe in net zero. It doesn't matter if you think climate change is a complete hoax. You still want to have wind energy because it's much cheaper than the alternative.
Yes, and we are, I think, I know it's stating perhaps an obvious point, but as an island nation on the edge of a vast ocean that's pretty windy, we are well placed to exploit this to our own advantage, aren't we?
Hugely. But I think the thing that confuses people, and probably used to confuse me, is someone of my age, gas has been cheap my entire life. So in the 1970s, you had all this cheap gas coming in from the North Sea. And so in the 1970s, we converted everyone's house to gas boilers. In the 90s, we converted all our power stations to gas because it's the cheap thing. It all comes to the North Sea. That's fantastic. And what people don't seem to realize is that we've kind of got it all now. I mean, we now extract 10% of what we used to. And that's just geology. So these are oil and gas fields in decline. We don't have that cheap energy anymore. Texas does. We don't live in Texas. So the local energy that's cheap, which used to be gas, now the local energy that's cheap is wind. And if you still want to have gas, you've got to go and get it from Texas. And that's really expensive.
And in doing your research to build up this case, this argument, you've just made the assertion that the North Sea is to all intents and purposes exhausted. What evidence did you find for that? Because you'll be aware there's still controversy over those who think we should carry on drilling because there's still more to get out of the North Sea. What's your view?
I think a lot of this debate about licenses is a total red herring. I mean, there is gas possibly like a mile down in the North Sea, but it's so expensive to get to it that no one's going to drill for it. So you can have a really hypothetical debate in an alternative reality where someone's going to drill for very expensive gas that no one's ever going to want to burn because it's ridiculously expensive. So the gas that's easy to get at, we've got it. Norway still has some. That will also decline over the next decades. We are already importing lots of gas. Without wind, we'd be importing loads more gas. And a few licenses here or there for people that aren't ever actually going to drill for it creates a lot of political heat and a lot of anger and noise. But on both sides, I think it's just irrelevant.
And the fracking or shale gas story, did you look at that?
Yeah, it's really big in Texas. Yeah, if you watch Landman, it's really important. It doesn't mean, I don't think, Doncaster is going to turn into Texas. There is a debate about it on heat on both sides, and I don't really want to express a strong opinion. I can see both points of view. What I'm really saying is it makes incredibly little difference to the cost of your gas bill and electricity bill, because best case, we're never going to get a lot of it. Gas, if there is cheap gas in the world, it's not here. And it costs an awful lot to move the gas halfway across the world.
A reflection that's probably outside the scope of your project, but if you'd like to venture a thought, please do. And that is the way the things have worked out at the moment. It is the electricity consumer that seems to be paying levy after levy after levy, making electricity more expensive to you and me in our homes. Gas prices go high enough, but then the government or the administrators of the day explain that that's because of all sorts of the gas consumptions and the point you've made about having less North Sea gas. Is it unfortunate, unfair, or just a necessary growing pain that electricity consumers are paying a heavy price just now?
I mean, it's totally counterproductive. It's policy that is contradictory. It makes absolutely no sense to pile all the taxes you can onto electricity bills, subsidize and the main thing you're doing renewables is bring down gas bills. So you have this double whammy that electricity users are paying all the costs, gas users actually get all the benefits. And the big problem is you make electricity really expensive while saying that you want to electrify the economy. You know, if you want people to have heat pumps, make electricity cheaper. And what they're doing, they're making the bills really expensive. Those are political choices. They don't come out of the economics or the finances. There are lots of things being pushed onto people's bills just because, frankly, the government wants to raise as much tax as they can, and people have to pay their energy bills. And so it's a way to raise tax. It's not a way to build an efficient energy system.
Paul Moshe speaking to me a little earlier. Some interesting research. As he says, it's being peer reviewed. So the exact numbers may pose out, but he's making this essential point that fact, gas prices could have been a whole lot worse had it not been for the wind infrastructure that's gone in.
Yes, that's exactly the point he's making. And you know, I really like his research because he's trying to factor over a long period of time and restructuring any major product, any major sort of infrastructure change, you need to think about it over the long term.
Yeah.
And yeah, I think he's saying he's talking about geological depletion of the North Sea, that actually that is fact. We're not Texas, where we have, and there are various basins across the United States, not just Texas, where they are fracking cheap gas. That cheap gas does make its way to the United Kingdom through LNG imports.
Okay.
But LNG imports, as Colin says in his interview there with yourself, is that's extremely expensive. Actually, it kind of sets the UK gas price today. So it costs about 2.7 pence a kilowatt to bring in here equivalently. So that's exactly where gas prices are today, right? So that actually does already happen. So we're taking cheap gas from the US and importing it from here and from Norway and also from Qatar via LNG imports, Norway via a pipeline. So that is already helping our gas network. But as he says, we've avoided having to consume that gas because to produce wind, you just need freely available wind. There is no invoice to wind once you've built the farm, right? And that's really.
And he was at pains, as I was talking to him, to point out he's not actually a campaigner for either side in this. He's not pro
He's
oil.
impartial.
He's trying to be impartial as a piece of academic work. But it's interesting that maybe, and this is a sort of note to self really, as we go through this programme, that above that political noise and some real passions about the pros and cons of all this, quietly, engineers are getting on with problem solving, like how to optimise our wind in the British Isles.
Yes, and I think he makes a point. We've got a lot of abundant wind here. I think you actually raised the question, right? We're on the Atlantic. There's a big fetch.
Yeah.
Sometimes we're very windy and probably likely to continue get more and more windy. So you know, yes, we've got that, but also we have. You know, he's talking exclusively about wind. And wind, if we do look at wind, offshore wind particularly, actually the current round of licensing to build new offshore wind is extremely expensive. It is more expensive than the current gas price. But will that stay the same long term?
It's one to watch for us.
It's one to watch.
And just an observation he made about policy. He was not getting political, but he was making a call to policy makers to make the right calls, wasn't he?
Yes, he was. And this is a really important factor. Actually, the real issues are in and around renewables, particularly in the power, the electricity renewable process, is that policies are complex, tapestry of sort of, we'll just tweak the policy here. And that filters down to the UK household buyer of electricity. So we've not done anything with gas to heat homes because our homes aren't efficient. We've left that alone. Everything's built on the electricity price. And so actually what really needs review is a very deep system-wide policy review that's updated for where we are today and where we want to go. Right.
Next up, let's have a look at what's been said on our social media channels from people who've been watching the UK Energy Show. We've got, Julian, some commentary on the Lukoil story, which loops back. A comment here about Bulgaria has only got 35 days of gasoline and some 50 days of diesel. That's just one country. But it is related to this whole Lukoil shortage we were alluding to earlier.
Yes, absolutely. There's a refinery that Lukoil own, that Lukoil are trying to sell their international assets as a result of the US sanctions. So, you know, of course, Bulgarians and Eastern Europe are impacted by that, because if it's not being able to run, there's going to be a potential shortage of refined product. And, you know, this just highlights how important refining and oil is to running economies, traveling. It lubricates economies. It's so vastly critical in terms of the energy transition, in terms of mobilization, in terms of running an economy. So yeah, I can understand their worry. What I would say in response to that is, in my experience of 35 years in the oil market, it is incredibly good at adapting. So price changes and that brings in the required. Unfortunately, that will have an affordability impact.
Okay, let's just get your take on this next post here, which is from Claire Coutinho, who happens to be, as I'm sure you know, the Conservatives' lead spokesperson, the Shadow Secretary of State for Energy. Here she is having a pop at Ed Miliband. Now he's going to lock us into higher prices for decades. She's joining a Cut My Bills campaign. The political knockabout, which we were remarking earlier in the show is not particularly helpful, continues. Inevitable, I guess.
And let's face it, it is politically sensitive. It is sensitive to UK households, 30 million households in this country, hugely important. The two things I'd really say about that is that the FT article we were looking at earlier, if it is right in its speculation that Rachel Reeves will cut VAT and adjust green levies that are on the coming through on our electricity bills, that could save up to £250 per household per year. Okay, what I would say to that, now that would get us to the £300 here, right? Almost, not far off of it. It still leaves utility bills immensely higher than they used to be. And the other key thing here is, why are we having this budget run up with the most speculation ever? Because as a country, public finances are in a dire state after the credit crunch 15 years ago, after Brexit, after COVID. We have and austerity before it, which meant we weren't really investing in infrastructure that generates tax receipts. So we don't have enough tax income. How are we going to pay for this? Is my worry, right?
Well, in 2 weeks' time, we might get a better idea. Yeah. Thank you, Julian, very much indeed, and thank you indeed for watching the programme. Any thoughts on what we've had to say, or our guests have had to say, do add them in the comments underneath this video, wherever you're watching. We'll see you next week.
one skill that every trader should master?
Discipline. I mean, I think that's what makes the difference between being profitable and not being profitable. The downside, the unfortunate thing is, even if you are disciplined, you can still lose money. You can be the most disciplined person out there, but if you're selling uptrends and buying downtrends, it's never going to work.
Welcome to another episode of Inside the Mines. Today, we are joined by a very good friend of mine, an industry veteran. He needs no introduction, and I'm very excited to get this episode started. Mr. David Jones, how are you?
I'm all right, Chris. Thanks for asking me along.
No, look, it's a pleasure. I think we're going to go straight into the episode.
Okay.
I'm interested to know how you got started. I know we touched on it briefly before, but how did you get started in the industry?
I'd always been interested in the stock market from when I was perhaps a late teenager, early 20s. But nobody in my family had any financial investment sort of experience. And in my mid-20s, I was working for a software company selling technical analysis software into major banks in the city. And the guys who owned the company were ex-traders for JP Morgan. And they said, look, if you're going to go and talk to our customers, these banks, you need to understand technical analysis. So back in 1995, I did the Society of Technical Analysts exam. And I got more and more interested in markets and trading. And then I made a career change in about 97 and went to work as a currency technical analyst. So I started, about 28 years ago was the start of me working in financial markets. And I think, I think I've been quite lucky that the thing that I'm really interested in, I get to do as a job, but it all started back then in the late 90s.
So do you think early on in your career, you had the training, right?
Yeah.
We always talk about, the foundations when people do start to learn how to trade. You had the foundations quite early on, would you say?
Yeah, I did. But I think like a lot of people, you learn a little bit and you think you know it all.
Right.
And then you start doing it and then you realize, oh, actually, the real world doesn't work how the textbooks say it should work. So, I was a qualified technical analyst back in whenever it was, 95. So you have all this theory and you think, well, actually now, surely I can beat the markets. And I'm sure plenty of people watching this, similar sort of experience, you learn a bit and think, right, let's go. Yeah. I'm going to make loads of money standing in my head. And you learn that actually it's not quite that straightforward. So I think all the way through, I think it's the important thing to understand if you're new to trading, that you're always learning. I've been doing it, like I said, for 28 years now. And just in the last few months, I've been trying something new out for trading indices. And so I think there's always stuff you can learn along the way. And it's probably where you end up as a trader. It's the stuff that you lose along the way. In the beginning, you sort of want to use everything, but then you strip it right back and get back to basics. So I think it is, I hate using the phrase a journey because it all sounds a bit X Factor, but it is that, I think, isn't it? From where you start to where you end up.
So what would you say one of the biggest challenges that you faced early on was? You mentioned about, you learned the theory, now put it into practical.
Yeah.
Was that one of the biggest, challenges that you faced early on? It's not all following the textbook.
Yeah, I think it's that. And I think it's the losing. We know, it's no secret that, we know from the regulatory postings and what we have to say that most people lose when it comes to trading. That doesn't mean you can't be profitable, but I made all the mistakes for a few years that everyone does. And I think it's that frustration of 2 steps forward and then perhaps 2 steps back that you have in the early months and perhaps even years. That's the really hard bit. But then I think it's accepting that, again, it's part of the process, and it's understanding, well, nothing works all the time. I think we've seen an explosion in trading in the last 15 years, which is great. So now, it's really transparent. Lots of people can trade wherever they want to. There's much more engagement with financial markets. But I think also people come into it thinking, there must be something that works all the time. So I think it's the realization that it's not out there, but finding the right thing for you. I think that's the hard bit to come to terms with, and that does take a bit of time.
So early on, did you have a mentor at all? Someone that guided you through the tough stages early on?
No, because back then, this is obviously just about pre-internet. So when I first started trading, you didn't have the array of brokers like yourselves you have today. There was no online trading. So, and the job I used to work at when I was a currency analyst, you were allowed to trade, but you weren't really allowed to trade at your desk. So I used to have to go down to the toilet on the next floor down and call in my orders the old school way. So I want to buy the S&P at here, and I want to put a stop loss here, and da-da-da-da-da. So it was, I think for plenty of us who started back then, there was nowhere near the wealth of resources that there are today, both good and bad, out there on YouTube or TikTok or wherever it is you look for your stuff, so you really were, I think for a lot of us, sort of trading off in a vacuum, really, and you really had to find your own way. So it was arguably harder back then, but I think these days there's so much stuff out there that you can also get information overload, and you don't know where to go, So I think there are pros and cons, but it was very much a bit of a solo journey, I think, for me.
So would you say it was a difficult transition for you, like evolving from phone dealing, calling into your broker? How would you even decide where to put your stop if you didn't know where the price was? Would you decide right there and then, as soon as he quoted the price, you'd be like, right, bang, I want a 20 pip, 30 pip stop, put me in? I
think in those days, I used to trade off limit orders. So if the market, let's say gold is trading at 27.50, I'd put an order in to buy at 27.25 and a stop at 26.90. So you're almost trading blind, which again seems ridiculous in this day and age, where you pick up your phone and you've got every market you want in real time, which again, I think is a great thing, but I think it can perhaps make us all a bit too trigger happy. In those days, you had to sort of sit down and think about it, or I had to anyway, go downstairs, phone it in, and then go back to the desk. These days, of course, you think, do you know what, I'm going to buy portfolios. Click, done. Done. So I think there are pros and cons for both. It's definitely better now, but perhaps being disciplined back then was easier because there were more hurdles in place to actually place a trade.
I think someone else described it similar when they were trading on the life floor, where you're trading on like other people's emotions, like physically, you can see other people. So as soon as that went, from there to phone to electronic, some of those big players struggled electronically because it's just completely different. The strategy's gone. Yeah. No, I've read that in quite a few books over the years. Like you say, people make the transition from the pits to just being stuck in front of the screen in a room on your own. I'm sure it is, completely different. Was there a pivotal moment in your career that perhaps changed the way that your style of trading? Like, was there a significant loss or series of losses or even wins that made you think, do you know what, I need to change what I'm doing? I think, I've worked, I worked for a few brokers since about 2005. So I spoke to lots of clients over the years. And at that point, I was profitable, but it was really interesting speaking to all these clients and seeing the same mistakes were being made time and time again. So that was quite useful for me in my own trading. And I think, what were those mistakes? What was the top five? I'd say top five, too short term, right? It's a classic mistake for most of us. Like I say, you can have a screen in front of you, any market you want, you can make a decision like that. I think it's really easy to think that trading is all about where does the market go in the next 3 minutes rather than the next 3 days, next 3 weeks. So too short term. And I think that's just a feature of trading online. Lack of risk, I'm sure, we've all got stories of clients who've made a fortune, think they've sussed out the solution to markets, and then lose it all. So not managing risk, I think, is another one. Trading too big is another one as well. Trying to trade too many markets. I've definitely been guilty of that in the past. A big market for me now is the S&P and the NASDAQ. That's a big focus for me every day. Not trying to trade a million different things. It's hard because you have, as a retail client, when you're logging in, you have so much access to so many markets. Like especially, the retail clients that, I've spoken to throughout my career. As soon as, they've logged on, they're like, I'm brand new to trading. Yeah. And then you go, FX, it's open 24/5. That's the market I want to trade. I could be awake at 2 a.m. But you don't need to be awake at 2 a.m. to trade. And to be honest with you, nowadays, personally, the FX market isn't as, volatile as, say, the indices.
Yeah.
You know, which is why most people lean towards commodities and indices.
Yeah.
Because it's more volatile, and with, you know, volatility brings opportunity, but also brings risk. But if you do manage your risk management and you do have your stop in place and you do follow a process, you know, volatility could be, you know, the key to your trading.
Yeah.
Do you agree with that?
Absolutely. I would agree with that. And you're right, with FX, it has been relatively quiet sort of year, couple of years.
It's like watching paint dry.
Yeah, and I think, I mean, in the last few days, whenever this podcast goes out, there has been a bit of a move in the dollar index to like a 2-year high. So maybe things are going to get a bit more interesting. But I completely get what you're saying. This is going to me sounding really hypocritical, because I've had a great career in the trading industry that I've really enjoyed. But I do think the whole online trading, I think it's perhaps the wrong way. It's very hard for people to learn how trading works when they have all that information in front of them. So I think if there's lots of bits of advice I think we could give to new traders, but perhaps focusing on just one market or a couple of markets.
Jack of all trades, master.
Yeah, and taking a step back. Not if you're looking at 10-minute charts, look at hourly charts. If you're looking at hourly charts, it's not working. Look at daily charts. Look at the S&P this year. The S&P is up, I don't know, about 20-25% this year. Yeah, there's been a great trend in the S&P. Look at gold. There's been a big 30% move in gold this year. You know, the money is not made in where's it going in the next 10 minutes. The money is made in trying to catch these bigger swings. And I think it can make for a much less stressful and potentially more profitable trading experience for all of us, particularly at the beginning.
And I think most retail participants, I think you agree with this, because, you know, we've been out together and, you know, done webinars and seminars, you know, at, you know, previous places together. But most people could do that if their position sizing was correct.
Yeah.
So most people go, right, I do have this long-term view, but because I'm doing £25 a point, I can only afford to do a 20 pip stop loss or 20 point stop loss, because that's how much I can only risk.
Yeah.
Whereas if you went, all right, well, do a £2.50 per point, well, your stop's going to be wider, and that trade can last for days now.
That's a really good point. I should have mentioned that, actually, because when I started trading, you had to trade much bigger, really. You know, I was trading, when I started trading FTSE futures when I started my own personal trading adventure. And back then, the minimum tick size was 25 quid. And exactly like you say, so a 1 point move in the FTSE was 25 quid. It's a pretty big position. You know, with the FTSE at 8,000, that's a 160 grand, nearly 200 grand position in today's money, right? So, and I did not want to lose a lot of money. So I would have, like you say, 20, 30 point stop loss. It's ridiculous. You've got a market that moves 50 points in a quiet day, and you think you're going to nail the next move with that sort of accuracy. You're just asking for trouble. So now the really, really good thing about the change in trading over the last 20 years is you can trade small. You're not restricted by the exchange minimums. If you want to do 50p a point, £1 a point, you can. So you can absolutely size your trade to the right level of risk for you, so you're not shaken out if you're trying to catch a bigger move.
And then it's important to, I feel like most people go, right, I'll do 50p per point one trade. Oh, it's a winner. I'll do £1 a point now.
Yeah.
Oh, it's a winner. Right, I'm going to do £5 a point. Oh, it's a loser. Right, this one's definitely going to be a winner. I'll go £5 a point again. They'll win the next 2 trades. Then they'll go, right, I'll do £10 a point. And they keep going up until they go, right, £50 a point, because their account size can allow it.
Yeah.
And they'll just wipe out every single losing trade they've just done over the last month.
Yeah.
Because their position sizing, it's random.
Yeah.
I've won, I'll go up. I've won, I'll go up. Profitable will go up. I lose money, I'll just stay the same as the last trade. It's not consistent. Do you think that, you know, you have to be consistent in your, you know, like you said before, you can only do $25 per point.
Yeah.
Essentially, right?
Yeah.
Do you stick to that now in terms of, right, I only trade X amount?
I think I absolutely stick to the same level of risk per trade, you know. So if it's a 50, if I'm only allowing myself to lose £500 on a trade and my stop is 100 points away, then I'm doing £5 a point. If my stop is 200 points away because of what the market's doing, then I'm doing £2.50 points. So it's the same amount of loss per trade. And it's, to get a bit philosophical about it, we can't control the market. So a really good friend of mine who's been trading for much longer than I have said the market will do whatever it can to give everyone an opportunity to lose some money. Yeah. And it's true, whether you're bullish or bearish, it will 100%. Swing around and give you a chance to lose some money.
The market can stay
irrational longer than you can stay solvent.
That's the one.
So the only thing we can control is ourselves, is how we interact with the market. And that is what makes the difference. It goes back, it's all the old stuff that we all know about, but perhaps plenty of us don't put in place. It's discipline and it's risk control, so you have to decide, well, on any trade, I'm only going to risk X and not get into the position like you described after a couple of winning trades, right, I'm going to triple my accounts, my trading size, because you will get slammed when you're wrong.
How do you think, I'm interested to get your view on this, having, taught people, you'd say, well, I would say anyway, that you're a mentor to people, right? In terms of trading. I know I've, learnt a lot from you over the years, and it's a good compliment, by the way.
Thanks very much.
One of the biggest things that you taught me was, and it's so simple but effective, is follow the trend.
Yeah.
And like the trend is your friend.
Yeah.
So many people that we used to go and see, you'd show them a chart.
Yeah.
And it'd be going higher, high, higher, low, higher, high, higher, low. And they go, where do you think the market's going to go? And they go, lower.
Yeah.
And you go, but on what basis? It's topped.
But I think again, that's the psychological aspect, and it's the cruel bit of markets that it plays into our human nature completely the wrong way. So we all, I think our gut reaction, whatever it is we're looking at, if it's house prices or Bitcoin or the Dow, if it's done that, you think, it can't go any higher, can it? It can't go any higher. Yeah. I mean, look at Bitcoin. Bitcoin is a prime example, isn't it? I mean, Bitcoin is a fascinating market.
Can it go any higher?
Of course it can. It can go to
go wherever it wants to.
Infinity, can't it? It can also go down to $10, But let's see. But Bitcoin's a great example, So Bitcoin, again, at the time of recording, it's trading at just below $100,000. Not so long ago, it was, 20,000, 10, 15 years ago, it was a couple of $100s, but it doesn't matter if you didn't buy in at $200, there's still been the opportunity to make money on the way up by having that trend in your favor. The S&P this year, gold this year, there are lots of markets where absolutely going with the trend is the big thing. And the way I always look at it, because I made this mistake again for years, I used to always, if a market was going down, I'd try and be a buyer. If a market was going up, I'd try and be a seller. It's completely ridiculous. If you see a market that's gone down for 6 months, 6 weeks, 6 days, and you decide to buy, I think it's really arrogant of you to think you're going to call the bottom, isn't it? What, you got that much insight, you're going to call the bottom?
Well,
no.
A wise man once told me those who pick bottoms get smelly fingers.
You've got to, it's much less painful to go with that trend. And the irony is, of course, I mean, with certain brokers, you can see client sentiment, and it's absolutely fascinating that you look at a market. I mean, I'll use the S&Ps as a market I know, and I look at, every day. You can always get, if the S&P is breaking out to new highs, you look at client sentiment, 65, 70% will be short. Yeah. And it's crazy. Okay, there is going to be a point where Bitcoin or the S&P is going to stop going up, but it hasn't done for a few years. So I'd much rather put myself on the side of that momentum and try and ride it for as long as it carries on going in one direction. And of course, the same applies to markets are falling. Euro, US dollar, has been sliding all this year. So I'd rather be a seller of rallies in that rather than trying to call the bottom for the euro.
Is there a specific criteria or checklist that you have before entering a trade, before pulling the trigger? Like, right, it needs to have, 3 pieces of confluence to be able to be like, right, it's gone bang, 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 I can go in.
I used to have, again, I think this goes back to stripping stuff away, as you go along with trading. I used to have quite a long list of stuff. And now it's not the whole thing of my trading, but basically, if it's going up, right, where do I buy and where's my stop loss go? If it's going down, where am I going to sell and where's the stop loss going? That is, a massive part of my trading approach is going with that trend. And I think, again, going back, I'm a qualified technical analyst, so I know all about Fibonacci, RSI, Bollingers and all of that. I don't really use any of them, because it's just for me, it's just noise. I'm very much a price-driven trader. And there's something that sticks with me from a book I read in the late 90s about trading. And it said that, if you're not sure what a trend is, print off the chart. This is in the old days when we printed stuff off. Print off the chart, pin it on the wall and walk to the side of the room. And if there's a trend, it'll slap you in the face. So for me, again, it's going with obvious trends, and it is the thing I've learned over the years is to keep it simple. You don't need 5 different indicators to tell you whether to buy or sell. is to try go with that trend and manage the risk.
It's almost like if the checklist is too big, then you're almost preventing yourself from entering. You're like, oh, all 10 things on the checklist. It's only done 8 out of 10. I can't pull the trigger yet. You're preventing yourself from entering the trade.
Absolutely. I mean, if someone gave me a chart and said, right, put some indicators on there that show me to buy, or put some indicators on there that show me to sell. If you mess around for 5 minutes, you can find that. And I think that's the issue. It's none of the stuff I talk about is really original. It's analysis paralysis. If you have all these things on there, half of the stuff might say sell, half the stuff may say buy, and you end up doing nothing. In the beginning, a big part of my trading right at the beginning was oscillators, overbought, oversold. And I would wait for all the oscillators to line up before buying into a trend, for example. And the problem is, of course, if you have a strong trend, the oscillators stay overbought, for some time, you never get the buy signal. So I would miss out on so many big moves because my little squiggly lines at the bottom of the chart, and the market is saying, hello, I'm going up, but I'm waiting for the little squiggles to give the buy.
Do you find that the oscillators like the RSI, the MACD, do you think that they're lagging?
I think that they are lagging, and I can perhaps come over as being a bit dismissive of it, but I would say with trading, there are 1,000 ways to make money. There are just as many ways to lose money. Yeah. I don't think there is again, to get a bit sort of philosophical about it, there's no right or wrong way with trading. Whatever makes money for you is the right thing. But I think, again, in this day and age, with charting software being so sophisticated these days, so easy to chuck a load of things onto a chart, I think it is the area of trading and analysis that people are definitely drawn the most to when they first start trading. I think the secret must be in, an oscillator, a moving average.
It's the easiest, right? You can put these indicators on a chart and go, right, when it's oversold, you do this. When it's overbought, you do this. It's just easier than perhaps learning how the economy works, how payrolls will affect the market, CPI, the actual structure of the economy in terms of economic and fundamental data. Everyone goes to technicals first.
And because I think again, coming into it, people want to believe that it's not everybody, but some people want to believe there's a magic system, and there's enough, con artists out there who'll tell you there is a magic system. If only you give me $10,000, I'll sell you the magic system. And of course, there's not a magic system, but even if you have a system that's right half the time, if it makes £200 when you're right and loses £100 when you're wrong, happy days. Yeah, you're going to make money. So I think that's the thing. I think, and again, I would have saved myself a lot of time in the beginning if I'd have accepted that there is no absolute. It is all shades of grey, but you can still make that work for you.
How do you deal with the psychology side of trading? Especially where you're not on a trading floor anymore.
No.
You are on your own, and how do you deal with the kind of emotional highs and lows of trading? Because you're sitting on your own, it can be quite low. I mean, you've done it for years, right? You traded for years. But is there anything that you do, or anything that you do you perhaps journal, or?
I think that is important to write stuff down. But again, particularly in the beginning, I think to get your thoughts down and how you think things are going right or wrong. The biggest thing I've had the last few years is just to walk away from it, to walk away from, not sit there and watch it. Because if you sit there and watch it, it's not going to go in your favor any quicker. And it's so easy. And I'm sure we've all done it. Sit there and rather than doom scrolling through Twitter or Instagram, sit there and stare at charts for like 3 or 4 hours. Absolute waste of time.
And then you've got an open position, you'll be like, oh, it's coming towards my stop. I'll move my stop lower.
Yeah.
I'll just move it.
Yeah, that's not recommended at all.
The longer you stare at an open position,
the
more time you're giving yourself to meddle with the trade.
Yeah, exactly.
So like what you said, put the trade on, have your stop loss and you take profit. If you're wrong, you're wrong. Walk away.
Yeah. I've got 4 trades on at the moment, and by the time this goes out, they won't be on anymore. So I'm long the Nasdaq, long the dollar index, long the Bund, and long the FTSE. And I don't know where they are at the moment, but they've all got trading stop losses on. So if they carry on in my favour, it'll carry on. If it all goes wrong today, I'll get stopped out. But me watching it, all that does is cause me either the stress of, oh my God, it's going against me, or, oh, isn't this fantastic, it's going in my favour. But that could all change. So I do think if you can have the discipline, and of course, the modern world with apps on our phone make it really hard to get away from this stuff. But, if you're...
They also make it easier with technology, right? With the alerts, trading stop losses.
Yeah, absolutely. That's a really good point, actually, because I do have alerts set up. The charting software I use, I have alerts set up and it sends me an email. So I know. So I bought, what did I buy yesterday? Bought the NASDAQ yesterday, put a stop loss on. If the market gets to X, then move a stop loss. That happened 4 hours later when I was off doing something else. I didn't have to sit there and watch it 4 hours. I get an email that says, okay, it's at this level, move it. So we can, it made a very fair point there. We can use technology in our favor to get a break away from sitting there and watching stuff,
It's like wait for the market to come to you, don't chase it.
Yeah.
You're going to do more damage than good. Which a lot of people do struggle. It's hard to kind of walk away, right? Initially.
Oh,
especially
definitely.
when you've got your own money on the line in trading. It's hard to just walk away and go, what will be, if that's the right thesis on the trade.
And like you say, it's there all the time, isn't it? And I remember somebody we met together a long time ago. We met for coffee and he was sitting there with 3 screens watching the market while having a coffee. Yeah. And you think, again, if that works for you and you're fine with that, fair enough. But I think for most of us, take a break and to reduce the stress, improve our own discipline by taking a step back for it and using the technology to work for us rather than us being a slave to what's going on every second.
What would you say the biggest mistake you made in trading is?
Me personally, I think there are lots, and I've definitely made
go top 5.
The same mistakes. I think I made the same mistakes that a lot of us do in the beginning. I think in the beginning was overconfidence because I knew all the technical analysis stuff and I did the exam and did all that, and thinking that markets conform to absolute set rules when of course they don't. They do to an extent. You have trends and all of that, but there's a lot, like I said, there's a lot of shades of grey in markets. So I think an overconfidence in the beginning, definitely. Trading too big in the beginning because I had to. I'll tell you, I told this story a few times. So when I started trading with an overdraft, right? Which is what a stupid decision that is.
Do not do this.
Do not. If anybody said that to me now, I'd just be, you're an absolute idiot. But I was, in my late 20s, thought I knew it all. So I had an overdraft and lost about 65% of my account in about 3 months. Wow. And was paying about probably 24% interest on that. But I thought I was so confident, this is going to be easy. Yeah. And again, so it's that overconfidence and trading too big. If I'd have started trading like now, it'd be much better because I could trade small. You can trade fractional size. So, but I'm sure that's something that we've all been through, that overconfidence and risking too much money and not understanding how important risk is. I read loads of books. I was really, and still am today, obsessed with trading and the mechanics of it and the psychology of it. And I read loads of books about how managing risk is the most important thing. And I was like, I know that. That just doesn't apply to me. That applies to everyone else, but it doesn't apply to me. And if you have that attitude, you'll soon learn, as I did, why that applies to you.
You mentioned there about, you have to be obsessed with the markets, right? You have to have that level of competition inside, like you want to be the best. Would you say that's fair with traders?
I think it helps if you. I think it's quite hard to be short-term trading profitable, without having maybe perhaps not an obsession, but a healthy interest or maybe an unhealthy interest in markets, and I think perhaps that's the reason why, we've all seen it. People they'll get disillusioned and they'll stop, because it's not as easy as all the various con artists out there would have you believe. It's definitely going back to, it is a journey, and it's really, I find it rewarding and fascinating and all those things. But definitely in the first few years, it was really hard work. And I think unless you're that into it, it's probably quite hard to get good at it. And that's why you're probably better off looking at more medium-term stuff. Taking a view on gold or the dollar or Bitcoin over the next 6 months rather than the next few weeks or so. So I think you have to have an interest in it, and you perhaps not be obsessive about it, but definitely it takes. Don't underestimate the amount of work I think it takes in the beginning, and perhaps the toll it can take on you psychologically. You know, because it's one of the few things out there. You know, in a job, you turn up and you do your job every day. And I've worked with people, I'm sure you have as well, worked with people who are really good at their jobs and people who are really useless at their jobs, yeah? But they never get really picked up for being useless on their jobs because you don't get the results smacked in your face every day. With trading, you do.
There's no hiding.
If you're not very good at trading, you can't deny the balance of your account.
Your P&L's not going to lie.
Yeah, and that psychologically, I think is tough. You know, particularly, I think trading attracts people, or a lot of people who are perhaps successful in other areas of their life, and so are used to being successful and good at what they do. And if they start doing this and it's not going well, you know, it can be quite a blow to the ego, I think.
What would one piece of advice be to, you know, someone first starting, or you wish you heard when you first started trading? It doesn't have to be one, but what's the best bit of advice you could have heard when you first started, or what someone can hear now?
I would don't underestimate how hard it's going to be. You know, I've got a 23-year-old son, and 5 years ago, him and all his mates were all trading Bitcoin and NFTs. Remember whatever happened to NFTs, right? So suddenly you have trading has permeated into a much wider public consciousness than ever before. So lots of people are drawn to trading and perhaps don't understand how hard it is. So I think I love it. I love watching markets and seeing everything going on day by day, week by week, but don't underestimate how hard it is to make money out of it, you know? And so I'd say, if you're going to do it, don't treat it as like a 3-week wonder, you know, understand, okay, this is going to take some time, perhaps, for it to work for me. Start small. I think that, again, there's this illusion that everybody's driving around in Lambos. Yeah. I mean,
when's the Lambo season?
Yeah, I actually passed 2 Lambos driving in today. So maybe they are. Maybe it's me who's wrong. But I think there can absolutely be the illusion that everybody's making loads of money from trading. But of course, it's the people only sing when they're winning. You know, it's like Bitcoin's had a 30% move in the last couple of weeks, 2 or 3 weeks. So suddenly all the crypto world is all going, yeah, here we go again, you know. But when it's quiet and there's not much happening, everything is quiet. So don't think that only, particularly when you start, it's only you who's not doing very well. You know, don't be influenced by how big people are trading. If they say they've got, you know, $100,000 account, again, we both know people with 6-figure accounts trade just as bad as people with 75 quid accounts. Yeah. So again, just do what's the right level for you. Focus on yourself. I think the journaling thing you mentioned is really important, particularly in the beginning, and just cut off a lot of the hype and the stuff that's going on around you.
It's a lot of that information overload that you said. You could go online and go, someone's posting a picture of their account with their profits and their 6-figure balance, and you're sitting there with, you know, a less of a balance and smaller position. You're like, well, is this really for me?
Yeah.
Can I trade?
Yeah.
These guys are posting £1 million accounts with a Lamborghini.
Yeah.
It's all first of all, whoever's sitting there posting a picture of a Lamborghini with a Rolex on and their trading app, they're probably not trading.
Yeah.
Let's be serious.
Yeah.
Right?
Yeah.
So.
And it is fascinating, you know, but be skeptical. Right. I think if you're gonna see that stuff, be skeptical, because it is so easy to show a profitable account. You know, if let's say you had £200,000 lying around, like we all do, right? You open 2 accounts. You have $100,000 account and another $100,000 account. On one, go long the maximum, the S&P. The other, go short the maximum, the S&P. All it's cost you is a spread. But you've got one of those accounts. Leave it a month. It's going to do really well, and then you can show that to all your followers, you know, on social media.
Or just use a demo account.
Oh, to use a demo account,
and just
of
hide
course.
the account number and the
Absolutely.
Demo.
Yeah. So I think be skeptical, because it is possible to be profitable, absolutely, but have realistic expectations about it. And if you can, just sort of insulate yourself from all of that hype and nonsense that we see, particularly around trading, you know.
Fascinating answers. Before we get into the quick fire round, just a reminder for everyone out there, please do like, share and subscribe. Please do leave comments. And if you do want anyone else sitting in this chair, please do let us know. We're happy to reach out to them and film an episode. So David, 10 questions.
Okay.
Or just over, depending how quick we get through them. But first thing that comes to your mind.
Okay.
Favorite trading book?
Favorite trading book? Okay. So the first one I read, the Technical Analysis Bible, is Technical Analysis of the Financial Markets by John J. Murphy. Yeah. So if you want to be a real geek about technical analysis, that's the book to go for. And that's the book I read for the qualification I did way back when. But in terms of, so that's a good textbook. A book that I read really early on in trading and I did not get at all is The Disciplined Trader. And I've forgotten the guy's name. I'm sure we can put it down below, but he sadly died, but he wrote The Disciplined Trader and another book later on. But he talked about markets in this really almost ethereal sense that markets, that the price now might be the absolute limit for someone who's just been stopped out, and then actually someone else sees it as a perfect opportunity to buy, and how the markets just never stop and they're always going on and you're completely irrelevant to the markets and he talked about it in such a way that I think, because I hadn't traded before, it made absolutely no sense to me. And I was thinking, hang on, I want to hear what my stochastic needs to be, what my MACD needs to be, all of this sort of stuff. But actually this guy really summed up markets perfectly. So it's The Disciplined Trader, and it's just about how we all view markets differently, depending on what our position is, depending on what our bias is, and how little of success in markets is to do with things like indicators and everything like that. So yeah, those would be my two. Mark Douglas, thank you very much.
You'll love this one.
Okay.
Favorite technical indicator?
Favorite technical indicator? I would say it's not.
So you can use.
Actually, I'd say so. Mine, it's not an indicator, but it's a trend line. Yeah. Okay. So if the market is going up, I'd use that. We'll go with that because I go with the trend. But also, I'd say if I had to use one indicator, I would use probably one of the simpler ones, an RSI. So I know it's simple overbought, oversold. No, I don't. I'm actually, trend following, moving averages. Yeah, I mean, we could sit here and go through 50, couldn't we? Be good and bad with all. But for me, trend line is the thing my go-to thing.
Favorite economic data release?
Oh, wow, it's a difficult one, that, isn't it? I mean, there's the Bank of England interest rate is always a hot watch, isn't it? And there's the non-farm payrolls, who can...
None of them.
No, I think what's interesting, I mean...
Do you trade off data?
No, but I think it's really interesting to watch because they go through... times when they're hot or not, So for example, the last couple of years, obviously, inflation data has been really important, and interest rates tied in with that. 5 years ago, payrolls was really important, and they're still important now, but perhaps less important. What I think is always fascinating is how the market reacts to it. We'll often see, and I don't trade over them because I think it's all a bit of a coin flip, but we often see this headless chicken thing where the data comes out, so the payrolls come out and it's plus 200,000. Oh, this is fantastic, the first hour. Oh, actually, no, it's not that fantastic after all. And you'll often see
numbers.
Yeah, you see it go back to where it was before. So I don't have a favourite one. I like seeing how the market reacts. And I think it's, again, something I've learned over the years. It's important to appreciate these things fall in and out of fashion. So what's important today might not be important in 5 years' time.
Favourite market to trade?
I would say the S&P, so the US broader stock market index. A couple of reasons for me. I think, like a lot of people, my pension is getting important now because I'm that age, and a lot of my pension is S&P exchange traded funds. So for me, I watch it anyway. I think there's always, it's the biggest stock market in the world. It's very rarely dull, so that's always a good thing. And because I'm based in the UK, it opens at 2:30 in the afternoon, so I can have a really civilised morning.
You can have a lay-in.
Yeah, before I need to go out for a walk, watch a bit of telly, before I need to actually engage my brain. So I think the S&P, if you were going to start off again, I think trading one or two markets. I started trading the FTSE because I was based in the UK when I started trading. I think the FTSE is a lot of the time quite an awful market to trade because it doesn't trend like the others. But I think our bias is we start off trading the market wherever we're based. But for me, I'd say if you're thinking about what to trade, I would definitely have a US stock market index like the S&P or the NASDAQ or the Dow on my list. And I think they're fascinating markets, great trends over time. Whether that continues, who knows? But really, really good markets, tight spreads, all that stuff.
One market you avoid to trade.
One market. Oh, I tell you what it is. That's it. Natural gas. Natural gas. I mean, fantastic market from a trend point of view. And I have traded it a bit over the years. But this year in particular, I've probably only done about 4 trades. Whenever I've bought it, it's gone down. Whenever I've sold it, it's gone up. And natural gas is a beast of a market.
So we're going to create the David Jones inverse.
Absolutely inverse indicator. Because most markets, if you have a trend and it dips back, that for me is a buying opportunity. Natural gas is like, oh yeah, I'm going up. Oh, now I'm going down.
Yeah.
It's just the sudden reversals. And I have found it, perhaps over the last couple of years, for me, it definitely doesn't suit my style. If you look at the chart of natural gas, what looks like a small move over a week or two, it's like a 50% move. It's been, again, at the time of recording, it's been trading pretty sideways all this year, but in a massive range, more than a 50% range. And I just find it a very difficult market to trade. And I'm sure other people out there love it. Yeah. And again, it shows.
It is one of the most popular ones with retail participants.
Because of the volatility, I'm sure, isn't it?
Most memorable market event.
Most memorable market event, I would say, was the financial crisis, probably, with Lehman Brothers going bankrupt. I'll tell you why I remember it, because I had the day off work. So me and my mate...
Was you trading on your day off?
I had some trades on, right? Ah, dear me. This is my biggest loss ever, actually. But I had some trades on, and I had a day off work. It was a Monday. I think it was a Monday morning when it all happened. And I had some trades on the S&P. And I'd recently moved house and I had a bit of a steep run up to the garage. And at the time I had a car that was quite low to the ground. So me and my mate were building a ramp, right, a temporary wooden ramp.
On your day off?
On a day off. This is the exciting life I lead, you see. So to get the car into the garage, and I could and I remember checking my phone when the US markets opened and thinking, oh dear, I've just lost quite a lot of money, really. So yeah, but I mean, I was working for a broker through that whole financial crisis. Fascinating time to work through, obviously, back 2008, 2009. Back then, but it was, it was just absolute mayhem, wasn't it? I think back then when all that.
I mean, I wasn't.
You wouldn't know, no, you would have been at school probably, but yeah, it was, crazy time.
One word to describe your trading style.
Relaxed.
I like that.
Yeah.
That's a very different answer to what we've had on the show previously. I like that. If you were to have a trading nickname, what would it be? Well, we just used to call you DJ.
I bet there's a few from my past employers. Lazy, I think. Lazy.
Your nickname would be lazy.
Oh, I think it would be now. The way I trade now is very lazy. Yeah,
okay. So your trading nickname is Lazy. Lazy Jones.
It would be Lazy Jones now. Yeah, yeah.
We could put that as the title of this episode. Lazy Jones. If you wasn't a trader, what would you be?
I was in sales. I was in software sales, before, and that's what got me into trading, And again, I think with sale, I mean, it's not obviously directly comparable to trading. Yeah, and I did sort of a sales role, obviously, when I was doing the work I did for brokers, was very much customer facing and explaining stuff, and trying to get them to give us business. So I think with sales, again, you have that. It's very results driven, isn't it? So I think if you're the sort of person who likes to get instant feedback of how things are going from a work point of view, so I'm not one so much for sort of sitting around and perhaps thinking. I'd rather be out there trying to get business. So I'd probably go back to flogging software or something.
I was going to say day trading or swing trading.
Well, do you know,
do you know what I mean?
Yeah, I do. Do you know what? And over the years, I have discouraged people from day trading, and I still would do. I think, again, going back to the beginning of our chat, when people start trading, they think it's all about the next 5 minutes, the next 10 minutes, all that sort of stuff. And, I think you've got even less of a chance of making trading work for you if that's your time horizon. But because I don't work full time anymore, because I've got so much more time on my hands, I have started day trading this year, again, the S&P. So I still do the swing trading stuff over a few days, few weeks. But I've started day trading the S&P because it gives me the excitement through during the day and the feeling of I'm actually doing something rather than just looking at the chart for half an hour and
So
going
do you need that excitement, that thrill, you know?
I think as human beings we do, and I think again it goes back. It's interesting that with trading, it's maybe a dopamine hit as well, isn't it? It is that excitement, and I think if you put a trade on, and so I go back to the three trades I got: S&P, dollar index, FTSE, something else, Bund. 3 of those I've had on for a week, right? And they're going okay, and they're going in my favour, but there's no clicky for me to do during the day. So I'm just like, all right, they're going all right. What to do? So I think like a lot of people, I think you've got to balance it with like the devil makes work for idle hands. So it can be dangerous sitting there and just clicking stuff. But I have come up with a day trading approach that suits me this year. It's not vastly profitable, but it is heading in the right direction. So for me, I do it for a bit of stimulation throughout the day. But if I could only pick one approach, it would be the more medium-term approach. And I think for most of us, particularly those of us who still have jobs and who are still working, that's a much better way of doing it rather than trying to jump in and out all day long.
3 tools you can't live without when trading.
3 tools.
A trend line could be one.
A calculator is one. So if my stop is going to be 300 points away, I know I risk losing £300. I need a calculator to tell me that's £1 a point.
Or you can use the Onyx market risk calculator built into
or
the
we
platform.
can use your risk calculator. So in all seriousness, that's important for a couple of things. To work out the size of the trade, it's pretty easy, and to work out I've got certain criteria when I need to move my stop loss, and the market's got to get to a certain point, blah blah blah. So spreadsheet. So I am by no means a spreadsheet genius. I can do the basic, like adding up stuff, but that's about it. So I think it's really important to record your trades.
So you journal, but you do it via a spreadsheet.
Yeah, actually, you're right. When I say I don't do it, but I do it like that, and I do have a little note. So my day trading, for example, at the moment, I've got 2 approaches I use. So I put a little note whether it's approach. One's called P and one's called F. Right, so it's like so then I can see after a month, okay, how's that approach doing? What went wrong? And if I do a trade, like I did something wrong the other day, put a little note why I thought it went wrong. So that I think is really important because again, it's too easy to stick your head in the sand with the trading. Yeah. And you put 500 quid in an account, you lose 150 quid, you think, I'll just chuck another couple hundred quid in there. And you don't really keep track of how well or not you're doing. So that absolutely keeps me honest. And what's the third thing? Coffee. I was going to say coffee or Amazon Alexa or other speaker to actually play something calming. I used to listen to talk radio during the day when all these nutters ring in with their opinions, and I had to stop and start listening to Classic FM just to be more calmer in the background when it comes to trading.
Calm environment.
Yeah, something like that.
Mood lighting.
Little fish tank. All that.
Stress ball.
Yeah.
Favourite trading quote?
Favourite trading quote? Well, actually, the one you said is always a good one. The market can stay irrational longer than you can stay solvent. I think that's always a good one. And also just stuff like, the market doesn't know you exist. Yeah. I think perhaps in the beginning and perhaps later on, there is a tendency, or there can be, to personalize the market and think, oh, they're going to move the market there to take my stop out. It's doing this, doing that. No, it's understanding that we are irrelevant. So I think it's any quote that sort of puts that into perspective to make us realize it's not, the market hasn't got a vendetta against us. It just is, and then we need to choose how we interact with it.
One sporting event that you'd like to go to that you haven't been to yet?
The Welsh football team winning the World Cup final. So when that happens in the next 20 years, I would like to be at that sporting event.
And to wrap things up, one skill that every trader should master.
Discipline. I mean, I think that's what makes the difference between being profitable and not being profitable. The downside, the unfortunate thing is, even if you are disciplined, you can still lose money. You can be the most disciplined person out there, but if you're selling up trends and buying down trends, it's never going to work. But I think we have to, again, it all sounds a bit zen and a bit philosophical, but we have to get control of ourselves, because we can't control the market. The only thing we can control is how we interact with the market, whether we buy, sell, or do nothing. So I think for me, you've got to have discipline. I think a great analogy to this is, in theory, trading's easy, right? You go with the trend, you manage your risk, and blah blah blah. It's easy, but as we all know, it's not that easy. But look at diets. I've been trying to lose at least half a stone for like 10 years, and it's easy. Stop eating cake and move around a bit more. Yeah, but we don't, do we? That's
hard
the thing.
As a trader.
It's hard when you get older. It's hard when you get older as well. But it's one of those things. I think in theory trading's easy, but it's not. But absolutely, I think if we don't have control of ourselves, it's probably never going to work. If you're just sitting there, and you log on every day and you randomly trade whatever's moving, it will be fun and exciting, but you're probably not going to be profitable. So the key word, which I'm sure plenty of people will have heard lots of times before, doesn't change, is discipline.
And that's a wrap for today's episode. David, thank you very much for coming.
Thanks very much.
Honestly,
It's been fun.
Really do appreciate your time. And once again, please do like, share, and subscribe. See you next time.
Hello and welcome to the North Sea market on close window. So the theme this week has really been weakness in dated Brent. And as we can see, we've got a record low in the officials assessment of the dated Brent physical differential. We went below -$1 yesterday. Today could be even weaker because the 40s curve has been pushed even lower. We've seen Midland has been setting the curve up till now, but 40s could well be setting. So make sure to keep an eye on our report and our publication of the dated assessment and physical diff later on our Twitter account. Now, talking about the 40s curve, if we look yesterday, we have ENI offering a 6 to 8 40s cargo at 35 cents below dated. They did withdraw that and it didn't trade. However, today we had the same cargo offered by ENI down to -35, and TOTSA lifted that cargo. So it's down to -50 cents, and they lifted. So it's even weaker today. So expect the 40s curve will come down further, perhaps even compete with the Midland curve to be most competitive in the basket. We also had this VTOL offer at 35 cents overdated for a CIF cargo. Now, freight has also been becoming more and more expensive, so that could also be very competitive. It could be very, very low on the curve, pushing down. Midland, we had BP bidding a couple of times. VTOL sold another cargo to them, so that was a 24 to 28 cargo that was traded at 10 cents overdated. And again, that's CIF, so you've got to take into account the as Midland is naturally CIF, so you have to take into account the freight cost. So again, we're looking at a very depressed Midland curve again. However, compared to yesterday, it's pretty similar to the trade we saw for a few days later, 28th to 2nd of December. So it's a little bit weaker further forwards. But in terms of price action today, what we've really seen is a significant sell-off in Brent flat price. So if we look at the chart here on Flux, we've gone all the way back down to just about under $63 as of this evening, as of just after the window. And we have, as you can see here, during the window, a pretty significant drop, even right here during the window. That's compared to much, much stronger yesterday. So yesterday we were coming up to $65. So if we look here, you've got a significant drop off throughout today's trading, and it's been consistent as well. So really, this is a weak day in terms of overall market, but the prompt Brent spread is still at 25 cents. So we've had a significant sell-off in flat price, a further weakening of dated, and really the spread hasn't quite reacted in the way that you might expect. It's still holding up relatively well. However, there is contango coming in, particularly WTI structure looks very, very weak. At the front, we saw the prompt spread even drop into contango briefly this morning. The January-February spread in WTI futures is down to just a few cents. And the other important news is gas oil. Gas oil cracks have come off significantly today. So we saw heating oil get to over like 41.50 or so yesterday on the crack, the prompt crack. It's come down significantly today by $1 or so. Likewise, gas oil and also the Asian market as well. So significant weakening in the gas oil market. We heard Al Zor from sources telling us that they will return to production on the 9th of December. So there is expected return of production of diesel, and that's contributed to the significant decrease in gas oil cracks. But that's all for today. So as I say, make sure you look at our Twitter account for the final dated Brent and physical differential assessment, because it could be an interesting one.
Bye.